Oh, what's up, guys? Girls, how are you? I'm Justin. Welcome to the Ivy League live stream. We got a big day in store for you guys today. Powell testimony. Powell's testimony with the House, and I think it's the House, and then we go off to the Senate. So I hope you guys got your sleep. Excuse me. Whoa, whoa. My charts, like, I don't know what's going on here. Sorry. So I hope you guys are doing good this morning, guys. If you could like, share, and subscribe, please. Could you please share this for me? I got to work on, expanding it out. So we got a lot of things to go over this morning. We're gonna see what stocks are leading, what's our gappers, where do we want to be this morning? Okay, so we're gonna go over a few things like that, and we're gonna get prepared for the day. All right, if you guys have any tickers yourselves, post them in the chat. Okay, post them in the chat. That way we can all work together and we can all become better together and know where, we said yesterday that we were looking for, Bitcoin and stuff to start going to the upside. We were pretty early on that. But again, thank you guys for joining us. Just want to wish you guys the best of top of the morning. Powell comes on at 10 a.m. Okay, Powell's on at 10. So what I'm going to do is, and I was behind, I'm sorry. I got my coffee, trash, litter. You're going to have a bunch of news run through, so I'm going to try and listen to that. I thought I had more time. I was up at 5:30 this morning or 6. I think I got 4 hours of sleep, which is plenty. So let's get to it. Enough wasting time. It looks like the spies want to hold up here. We'll see. It looks like it wants to, but it may just become resistance. I might have to make a cup of coffee here in a minute. So what I'm going to do is I'm going to run through my charts. If you guys have any questions or anything that I can help you guys with, please post it in the chat. And we're going to search and see what stocks do we have leading. So I noticed yesterday, look at CRM, guys. CRM actually had a breakout day. I'm not sure if there was news or anything. So we had, see, this is hard. This is hard to do. This is hard to sit here and go through. Man, the spies are going to have to, like, this might be it. It might be. It's hard to say. So look what I'm seeing on the SPY. I'll show you. Okay. Look at this. No, maybe. Yeah, it looked more like that could be a thing. So, yeah, hold on here because, yeah, right there. Because it's showing me on these charts. Okay, so see, it looks like it lines up. So, on the charts I have over here, that you guys can't see, on the monitor I have over here, looks like that perfectly lines up. 436, 437. You see, there's a difference, and they're both on the same time frame, 5 minute. Yeah, so that's what I'm watching for. We'll see what happens. So I want to see what the SPY does if it holds up. Again, so with Powell coming on at 10 o'clock, I don't expect there to be much movement up until then. What we really want to see, engage. What's his demeanor? He's going to have an opening statement. Um, oh, wait. Okay, yes. I just want to make sure that everything's working. Like, is he going to be hawkish? Is he bearish? Like, is this going to be a political showdown of just, Democrat this, Republican that, and not, you know, do what they need to be doing? And I stated this yesterday on the live stream last night. So we'll see. Okay, yes, it is working. We do have, today is Wednesday. Today's Wednesday. We have a little bit of data this morning, I think. You have NBA mortgage applications that came in under. They're gonna like that. They're gonna like that. So what I'm gonna do is I'm gonna run through. If you guys have any questions, just ask me. Whatever it is that I can help you guys with, and I'm gonna run through and get things going. I want to see what the top gainers are, so I could also go here. Percentage gainers, scan. These are. Was this for yesterday? I guess this is. They're not going to include pre-market in here. Ford, Dino Dice. Are you hungry now? I guess my little girl's going to want to get up and eat, and I've been trying to get her to get up since I got up this morning. Unity. Come on. You want to come eat? So we're going to go over the SPYs, the Qs first. We'll go over Tesla, AMD, NVIDIA, Microsoft Shop, things of sorts. Alright, so get your pen and papers ready. I want to watch CSM today. I want to see if this thing... I want to see what this is going to do. Because it's there. It's got to make its decision. Alright, it's got to make its decision. And it did hold it. It did hold that area. Looks like it's rejecting this morning here. So we'll just have to wait and see and find out, okay? Alright, let's get it, guys. Let's get it. We're going to start with the... we don't even have to go to... We can go to the daily just to know what we have exactly going on here, but... I want to see if we can get back down to 430. All right, what I'm going to do real quick, I'm going to make myself a cup of coffee and I'm going to feed her real quick. She's going to be nonstop. She's been trying to get up, or she's been trying to get me up, I guess, at 4:30 this morning. And I guess she's going to decide to eat because we're live, and that's how things work. So this is a 5-minute chart of the SPY. Let's put up, we can throw up Tesla over here. Just give me 5 minutes. I do. Oh, look at Tesla, gang. What's going on here? Hello. What's up with our level 2? Or is this just... Okay, that was a little bit dramatic, huh? I thought that there was an actual move going on there. Well, it got to our target. Oh, yeah, we still got one more left. So we'll see if it can get there. Hell, it might get there today. Alright, guys. I will be right back. Again, if you guys have any tickers, post them in the chat. Whatever we have moving, like, let's, I'm not telling you guys to do it all, but I only have 2 eyes, guys. I only have 2 eyes. If you guys want to ask me about a trade, what do I think about it? Where do I think it's going to go today? Where is it take profits? Where's the stop loss? Ask away. You'd be surprised what, you might be surprised. I will be right back. All right, team, we're back. We're back. All right, so what I wanted to get into real quick would have been the leaders. I want to help you guys get through the day. This is my goal. All right, not only come up with ideas. So what's been leading? All right, Tesla. We know that we have our levels. All right, Nvidia. All right, Microsoft, MSFT. So, listen, what's gonna, how can we help gauge what the market's gonna do, if it's gonna hold or not? Okay, you guys want to watch these stocks. Seriously, you guys want to watch them. Okay, I'm gonna make a short real quick, because if these start to pull back, I mean, look at UNH. It's pulled back. Okay, it does look like it's trying to work its way to, it's trying to angle itself and make higher lows. All right. So that has pulled back. Let's just look at JP Morgan, for instance, as well. It's kind of in an uptrend also, but your big cap tech is what's really leading the market. Okay, so we want to watch what Tesla, Nvidia, Microsoft, what are they going to do today, and what does that do to the SPY? What does that do to the Qs? All right, so I'm going to run through these real quick. If you guys have any questions, please post them in the chat. Any tickers? Let's get it, team. I'm ready. And like I said, I'm here. I may be quiet. Just I'm gonna go. I want to run through these. I want to run through a list of these real quick. So look at that. It's already at 440. Isn't that insane? 440. I want to see us hold this 437. I don't want to see us break it, but if we do, again, we know we have a gap fill down here. All right, we know we have this gap fill. Where's our targets? You have, see, it's not necessarily a gap fill, but you did wick right off of this 433 level here. I could put another, I might as well. I'm going to put, because we're going to have some minor levels on the way. And if for some reason Powell gives us the downside, you guys are going to want to have these, even these minor levels are going to be, at least you're going to get areas of pullbacks on them. Doesn't mean that it has to revert and not, and just go flip right back to the upside. But these are going to be areas of minor support that once broken, you're not just taken by surprise. And just going to put that there because that's where the gap up overnight happened. Okay. So what I'm doing is I'm going to go through these and then I'm going to go on to individual stocks because I want to lay out the land of the overall market, and then whatever the overall market I feel is going to do is setting up to do, whether it's from Apple or whatever, then that's going to help me gauge on what I want to do, what I want to be long, and what do I want to be short. Thanks again for joining us. This is the Ivy League live stream. I'm Justin. If you don't know, I'm here to help people become better traders. Okay, we don't ask for any money. We don't ask for your information. I think, which is the most important part that gets overlooked. Was a lot of these people are all they are data brokers that know how to trade, and they just want your information because your information makes them money. All right. Again, thank you guys for joining us today. If you did, if you guys have any questions, post them in the chat. All right, so what I'm doing right now is I'm getting my support and my resistance just to have my range. I have support 1, 2, and 3. All right, I'm just getting it wrote down. These turquoise lines are the high, low, and close. All right, that way I have my range. Dude, I have no idea what's going on with this. No idea. Um, but again, anyway, I just giving you guys a heads up. That's what I'm doing. So again, if you guys have any questions, start throw them in the chat, baby. Throw them in the chat. Let's get it. I just want to let you guys know the type of information you guys are going to get. Okay. This Coinbase rally, guys, again, I don't want to stress it, but you guys could have been here and we called this out Friday. You could have already been long Riot, BTBT, Coin. Well, not, I wouldn't be long Coin. You could, but, you know, MSTR, Mara, Riot, Bito, BITO. So we called them out Friday. The question is where's the next one going to be? I want to look at banks. Like I want to. Where's the next one? Where's the next rotation? Check Rivian. It still can't get over that level. It still can't get over it. And it shouldn't, man. This thing shouldn't get over the level. I mean, even with the news yesterday, you didn't even have a breakout in volume. Look at that. Look how light that volume was compared to the previous day when you didn't have any volume, you know? So, that's all I have to say about that. So, again, we have MicroStrategy, all that shit, Coinbase, Shop, AMD, Semiconductors, Micron. I do want to watch Taiwan Semiconductors because I think it is trying to break down. Say what I mean. It's got this last little bit of effort right here that it's gonna hold. I think if it breaks, hello, that's the last line of defense. 102.82. 102.82 is the last line of defense, and this thing is going to either get sold off or make a bounce attempt and have a shakeout to the downside. Shake them out. We'll go over the daily because I think the daily is also a little bit important because it might just be so overextended, just like the rest of them, that it's above all major moving averages, and it may not be much there. So we're gonna put that. Like I hate having all these lines. I really do, but they're necessary. In the morning you had a slice off. Now notice right here is where the buyers were. See if they're still there. We want to see if they're still there. So I'm gonna keep my eye on this. And again, this is gonna be my last line of defense right here. Roughly right there. So, yep, double top up here at 104.80. So what I want to know is, what are y'all watching today? What do you guys have? I only have two eyes. I got a few. I want to. It's just I got up early and I thought I had more time than I did, man. It's crazy how just trying to go through things and it's like there's like not enough time. It feels like there's never enough time to like run through all the things you want to run through. It looks like same thing for Apple. Like this is, look at that. It's been a 1, 2, 3, 4, 5 day down. Well, I'll say 4. 1, 2, 3, 4. This necessarily wasn't a down day. 4-day downtrend. Just take notice of stuff like that. What the hell is this here for? I can see that. Oh, look at that cup and handle, guys. Let's look on the daily. That's actually pretty nice looking on the 4-hour, surprisingly. And you know what's funny about that? Oh, look at this gap. We do have a gap on the daily. Apple actually loves to put in cup and handles. The last time I seen an intraday cup and handle was on Apple. It was 2020. It was in the spring, summer of 2020. And it put in an intraday 5-minute cup and handle. Look, it's got like a minor reverse island reversal here, guys. You see this? It's actually pretty funny, isn't it? There's your island. Gap down, consolidate, gap up. You break out. Now reversing to retest it. So we'll see what happens here with Apple. It might be a long. We might be setting up for a long. You know, you have to wait and see what happens today. But again, I'm not arguing with the chart. That's all. I'm not going to argue with the chart. I'm just going to do what the chart tells me to do. I have my stops. You know, that's all. That's the only thing I control. I can control how much I lose. I can't control how much I make. Look at that. Isn't that pretty? It's actually not bad. It's actually a clean pattern. That's actually a really clean cup and handle. It really is. The thing that I wanted to and you do kind of have it. Okay, you do kind of have it. What you want to see is an increase in volume on the upside and then a decrease in volume on the sell-off to get your increase in volume on the way up. All right, so you have it. Look at the increase in volume. All right, let's put it. What happens if we take the? So I'm gonna add Apple to the list. Believe it or not, I am adding Apple to the list. It's just. See, I have more of an island reversal here, but it shows it better with the with pre-market on. It's hard to say, man. It's so hard to say. It's gonna be hard to say. We'll just see. We'll see what happens. But what also is telling is look at the tight consolidation on the way down. You know what I mean? How it's just straight down, and it's not like curl, 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 uptrend, uptrend, curl. Like it's going diagonal. So I'm a buyer. 102.80 roughly. Worst case, if this is going to be a cup and handle, you want to be a buyer at 100 flat, 101. That should be, see the handle, because it's on an angle to the upside. All right, you want to, the handle might not have to come down as far. Like a normal cup and handle will have, it'll come down like 3/4 of the way, a little over half. I guess my little girl is just going to start all flipping ready this morning. I love her to death, but goddamn. So it may be there. So, and as you see, what are we doing? We're putting in, we got another little tail in here at 10. What is this? Just above 102.80. Is that? I thought I said 101.80. Come here, turkey. Hi. You say hello. Hi, baby. Yeah, okay, yeah, I'm gonna watch this level as if it breaks. I'm just gonna keep my eye on it. This might be a long today. Just putting it out there. Maybe swinging Apple. I might be swinging Apple. This looks like a good area too to be long. Is there anything I'm missing? Let me bring up the 15-minute chart. See if we have some divergence. Negative MACD. You are putting in lower lows on the MACD. So only time will honestly tell. All right, only time will tell. You do have you did put in a higher high or a lower low with the higher low on the RSI. You know, these are all just little things that I'm looking for. You kind of have an inverse head and shoulders there, but not really. It's ugly as hell. I wouldn't consider it one. So you kind of just want to line all those things up with your analysis. She's just being hella needy right now. So I'm just going to sit on your lap, Dad. That's fine. Microsoft is another good one too, guys. MSFT. I've been watching this for a few days now. I love you, darling, but no. I mean, I was kind of wanting it to hold that level up here at 399. Come on. All right. Let's see. You have actually a nice little double bottom there yesterday. Still in a downtrend though. I can't get my thoughts together again this morning. I want to know I mean, I know obviously we have Bitcoin and stuff like that. We called that out early Friday. Let's look at Tesla. Just want to see. I'm just running through. I'm going to come up with my best ideas. Tesla might want to pull back to that 264 area. 265. Minor support there. So we got to figure out. I got to figure out what I'm going to be trading today. If I'm going to trade the overall markets or if I'm just going to be trading in individual stocks. I want to find something weak. Line it up with something strong. It could be a small trade there on CRM. It had a nice day yesterday. I don't really trade FedEx. Let's go here. Exact Sciences and Rivian selling back off. Oh, Spotify. So what happened with Spotify? Shares of Spotify music streaming service rose about 2% at pre-market after Wolf Research upgraded Spotify to outperform. Okay. And it doesn't look like FedEx is doing anything to me. It's fucking flat. So why would you have it in the top gainers? Or like market moving? It's not doing a damn thing. Ain't nobody messing with FedEx. Ain't nobody messing with FedEx. You know, they're not trading it. Come on, CNBC. Oddly enough, let's see. What'd they say? Spotify? Is that what it was? Yeah, because I had it written down. This thing's just in a small uptrend. It looks like something that it's more buying. It's not giving you no real like trend or follow through. Of course, that may just be how it trades, but I'd much rather. Let's see here. Biden labels Chinese President Xi a dictator. That's what the fuck he is. He's a dictator. What a fucking retard. He's such an idiot, man. He's such an idiot. Seriously. Markets is a tactic, part of communication strategy. What is a part of my strategy is I want to be long stocks that have relative strength, and I want to be short stocks that have relative weakness. The only strategy that I really need. This sucks, gang. I don't know. So I guess what do I feel is the best? I mean, I guess I still want to watch TSM. Obviously, we talked about that. It's also got somewhat of a cup and handle. Maybe we look for the long on TSM, try and swing that. It's setting up just like Apple. So that's a top idea. Let me write this down. I need a bigger boat. It's not enough room. Top. And that's just right now. I don't know what's going on in small cap land. I'm going to be looking at obviously Coinbase and stuff like that. Let's see how they're doing this morning too. I should look at I need to bring up the dollar. There's so much I need to do. So much. Let's go. Boom, boom. Dude, look at these yields rise, guys. So, fun fact, if you don't know, there's never been a bottom put in before the low in the 2-year. If you don't know what I mean by that, what that means is, look at the 2-year. The 2-year so far has topped out in March. The SPY bottomed in October. So it's a sign, and we're still going, still creeping higher. I don't expect it to get. It could get back up to 5. It's hard to say. I don't think it will. I think this might be about it for the run. Maybe you get up to 5 again, possibly. But look at that. That's a beautiful pennant. It doesn't get any better than that. That's so clean. That's such a clean pennant. Just like how we had in the dollar a couple days ago, or last week. All right. Look, Red Book year over year came in above last month's expectation, or above last month's. What a rise. Wow. So what do we have right now? We have TSM. All right, we're going to be looking at TSM long, 102.75 area. Let's pull up the 15-minute or hourly. Yes, this is our. And if it breaks, we're out. You know, let's see. Let's dissect it. All right, you had a lot of buying here, a lot of buying there. Where is it at? Oh, funny enough, 102.85. We're right at our target. It's kind of funny, isn't it? So you gotta break through this level up here though at 105.16. So we want to be long from 102. If it gives it to us, 102.71. Let's pull up the 15-minute chart. Make things a little easier. I'm really curious if this gives us the move today. But even if we get some upside, I mean, we got to break 104.75. We got to get past that 105 area. Let's see. I'm on a 15-minute. I mean, there's a lot of nice setups. It's just, you know, they're not really. There's another. Look at that, actually. Look at that 104.35. His mic is so screwed up this morning. I mean, somebody could just tell him that his stuff is screwed up. Again, guys, if you could share this stream, like and subscribe if you guys find this information valuable. A lot of these stocks are putting this in, or putting in this price action. I thought I just had. It looked like it matched up a little bit. We're gonna look at 104.33. This is going to be our. This is going to be the line in the sand. I feel like we break above 104.35 is our first area that will become resistance. So it's going to be a minor level. All right, it's going to be a minor level. I'm going to write all this down. I think you guys should do it too. If you guys are, we need to know our ATR. We need to know. There's a lot of stuff that we need to know. Where's the VIX? I know it looks like I got lines all over my screen, but they're there for a reason. All right, they're there for a reason. This was yesterday's open. No, this is where it reversed from. So this level is going to be important. This 104.36. Okay, that's going to be Friday's low. Friday's low is what we want to look for to see if we can break above it. If we get the upside. All right. Long right here at 102.80. That is my game plan. You do your own research. If it breaks, it breaks. It looks like, you know, it's trying to hang in there. It's trying. We're gonna I'm gonna watch it. I don't need to second guess myself or the move. I'm just gonna let the chart tell me what it wants to do. And 104.37 is the line in the sand. Let's see here. Oh, they fixed his mic. Hooray. What is this? 102.80. 102.80. Okay, the line in the sand for resistance is up here at 104. This is still a nice move. 104.37. 104.37. It could also. Nah, I still like that because you have a really nice double bottom here. So I looked this. I want to see if it comes to test this 104.35.36. So R1 is for resistance 1, like it's your first line of resistance is going to be at 104.36. 104.36, and then we have 105.20. 105.22. I don't think we get there today. 105.22 support. It's also got an island reversal in it too, guys. It's a little awkward setup, but you know, Apple, TSM, they're all putting in the same pattern here. I think I spent too much time on that. I got my levels. I'm gonna watch it. MSFT. What's it doing? See, it's kind of also got the same thing going on. I love how everybody's calling the crypto rally out now. We were on that shit Friday. We were on it Friday. Good luck today, guys. Good luck today. We're winding down. It's close. I might put CBS on for the bell. Let's do it. Of course, my headphones are in the out in the car. We have to watch if the market goes down, okay? You want to be short bounces. Just don't be short right off of the bell and expect like a massive downside because we're probably going to consolidate. Well, we're going to make a move because you're going to have buyers that are already sitting, whether it's at VWAP, certain areas right off the bell. You're going to have your market imbalance, your market on open imbalance. And that's going to cause, that's where you get your first minute or two movement from, which is the market on open imbalance. I'm sorry. And don't listen, you guys want to short bounces. All right, get used to, making the market work for you and you not work for the market. If I want to be short Microsoft, where do I want to be short? I want to be short up here at either 338, and it proved to me that it's going to turn that prior support and the prior breakthrough resistance here. I want it to prove to me that it's going to become resistance. Now, I can always not necessarily step in front of it. Look, you had your double top right here. Beautiful level. It broke it yesterday. Put in a double bottom. Where is it going to go? It's got negative MACD, negative RSI, so it is oversold. That's about all that I see with this thing, is that it's oversold. So you could get some upside. All right, there's a technical brick wall here that you broke above and couldn't hold it as support. So it kind of plays in hand. That makes me think about Apple and TSM. All right. Microsoft. So Tesla is pulling back. They said they didn't get a downgrade, but they got an equal weight something. I don't flipping know. I just wish we had like some more new. We have Powell, but I was hoping to get like just something, I guess, I'm going to go out and grab my headphones, my AirPods, I mean. Treasury yields rise as Powell reaffirms the Fed is not done hiking. Wait, what? When did testimony? U.S. Treasury yields were higher Wednesday as investors digested Federal Reserve Chair Powell's testimony before Congress and assessed the economic outlook. So I guess that's the pre-written statement that was released. I wonder if we can get that. I mean, I'm sure we can. Where's with more than two basis points at 3.7. 2-year traded at 3 basis points higher at 4.7. Yields and prices move in opposite directions, and 1 basis point equals. Oh, well, we know that. At least I do. That's so crazy to see yields up. It's just crazy to see yields up here at like U.S. 1 month, 5.1%. Like, that's insane. That's crazy. You haven't seen that since 2008, 2007. And we got there within a year. Financial Committee on Wednesday that more interest rate hikes are likely ahead as central bank continues to fight its inflation. That comes after policymakers decide to pause their rate hike campaign, which had been ongoing since March of 2022 at their meeting last week, but not without noting that further rate hikes are likely. 2 more increases of 25 basis points each are expected this year, according to the central banks. Investors also considered what could be next for the wider U.S. economy. Digestion, Tuesday housing starts and building permits figures for May, which both came in above previous forecasts. No key data is expected Wednesday. Elsewhere, UK inflation, blah, 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 blah. Blah, 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 blah. So, I was going somewhere with that. I actually had a really good idea in my head, and then it just left. It ran off. Oh, there we go. Banks. That was one of them. That was part of the idea. Pfizer RSV vaccine for older adults on slightly less effective after 18 months. Okay. House Democrats release wave of bank reform bills. The banks didn't do anything wrong. Come on, look at you with your little pearls and everything. While you got all the peasants out there talking about vote for me, do this and that. Come on, Maxine Waters, just stop it. You just playing the fool, bro. And I feel bad for some of y'all out there. You're getting played. You're getting played. House Democrats, led by Republican Maxine Waters, introduced 11 bills to regulate the financial sector in the wake of several bank collapses. We didn't have several, we had a few. The bills are specifically focused on preventing the kind of actions that led up to and followed the failures of. All right, so this is why it is important for you guys to start voting the correct people in. All right, bills are specifically focused on preventing the kind of actions. Bro, SVB had a board member of the federal government. The Fed, a Fed member was on the board of SVB. Like, what? What? Let them go. We need a free market. Let them go. Shit happens. But here's the thing that they're not telling you. The thing is, back in 2018, Powell gave regional banks the game plan for the extended forecast. Guess what? He told them not to buy long duration. There was a forecast that the federal government gave the banks, and then guess what? COVID happened. Like, let's be real about this shit. You don't need to regulate the banks. The banks should regulate themselves, not the government regulating the banks. Get these people out, guys. Seriously. Give people an education. Say, hey, listen, you put your money in the bank and it's over $200,000. It's uninsured and things happen and things go wrong. Don't put all your eggs in one basket. The banks can fail. So you knowing that as a depositor, you would know to not put yourself in a stupid situation. That's all it comes down to. That's all the regulation you need. Self-responsibility of the people, not the government's telling other companies what to do. All right? Because it's ridiculous. And then what happens is you don't have regional banks and then they leave your cities and you wonder why. Because they ain't making no money. They're not making money. They're in it to make money. There's payroll, electric, the building, everything that comes along with it, the insurance. So this type of shit just cracks me up. It's not that it's past. It's not that it's past. All right. I'm not a banker. I'm not going to sit here and act like I'm a banker, but I'm going to tell you right now. I do know that there's a federal, a person that is on the Fed, okay, that works for the United States of America, who's also on the board of SVB. What? There was you had a person in office. And they still let it happen. Like, come on. What is regulation going to do when you already had insight? You had I want to say an inside job, but that's not what I'm getting at. It's just hard for me to explain what it is that I want to get out. I've explained it to you. What is regulation going to do that couldn't have already been done? It's so stupid, and you get played. They play these people so much. It's so funny. Look at her miserable look. Look at her. Like, you can just see the selfishness. You know what I'm saying? Let me just throw my $80,000 pearls in my ears and just feed y'all a bunch of shit. Come on. Come on. You're either coming in or you're going out. I had to get that off of my chest because I can't look at this face, guys. Look at this face. This is the face of selfishness, I feel like. You know, let me just feed them the crumbs. And this is where they get, this is the person, these are the people when you say they want to get in office just for money. There you go, right there. Right there. So what's regulation going to do? Because you already had a member of the federal government on the board of SVB, and they still let it happen. All right, they didn't forecast COVID. They didn't forecast the Fed. It was not in the game plan for the Fed to go from 5 to 0, from 0 to 5 in 12, 13, 14 months. All right, shit, that is the free market. And guess what that does? That will allow easing in the future. They go under. Let it be. The depositors are insured up to 200,000. They have more than 200,000. Oh well. They decided to put it in there. It's on them. It says it right on the bank teller, so it's not like you haven't been told. Just open your eyes. I just like look at that miserable look. I'm sorry. I can't stand Maxine. Like, I really can't. She might be great outside. She might be a good person, whatever. She might be this, she might be that. But I know she's playing the fiddle. She's playing these people. She plays people so much. Let's get it, guys. All right. Again, we got to watch what Powell says. It'll probably be, let's see. It'll probably be, I don't know. Honestly, I don't think the market's going to move that much leading up to Powell. This is my support area that I wrote down. Actually, I wrote down for the SPY was 435.28. 435.28. Yeah. This is my area right here. But you may start to get a little bit of support in here. Sorry to go on a tangent, but I had to. That shit gets me so hot, man. So hot. She is, dude. It's like not even that she's evil. She's just got this selfish, like she just feeds the little peasants what they want to hear and gets them all riled up. And then she got, like, I'm telling you, bro, these pros, I'm going to tell you right now, are probably good $80,000. I'm going to tell you that right now. She probably got a $250,000 watch on, talking about we need to regulate the banks. What? What? You're going to tell me you're going to try and regulate the banks when you had a federal board member and then they decided to not do anything about it? It's because they couldn't do anything about it. So how about you just educate people in school or let them know when they put their money in the bank that anything over $200,000 is not insured. It's as simple as that. The bank fails, and guess what? There's another bank that's new opportunity. So that's just how I feel. That's a free market, Again, though, the most important thing is this guy right here, Powell, told them They told them the plan back in 2018. Don't buy long duration. Like this was all planned in 2018, and then things went sour with COVID. So it is what it is. This is how you get. This is how you don't get overextended. This is how you don't get overextended by having some of these. Like, we have just had a huge expansion from 2008 until now. Like, it's like, go outside. At least where I'm at, there's so many people. It's insane. It's insane. There's so many people. There's just so much going on. I mean, keep it that way, and then learn the hard way. Like, it'll fix itself. Like I said yesterday, when there's not when things are just overextended and there's no buyer to be had, and the sellers are left holding the bag, it is what it is. So either the Fed handles it or the market will handle it. That's what I'm getting at. Either the Fed raises rates, slows things down in moderation, and then we get on to our next expansion. I just couldn't do it with this. This just got me. I can't fucking stand her. Can't stand her. And of course they put her there. Also expressed to compromise on banking legislation. Again, stupid. It's so stupid. So what are you guys looking at? Germany's biggest bank is going to offer custodial holding of crypto. That's pretty crazy though. We were on this move pretty early. I'm a little upset I didn't take it, but not really. I really don't care because I know if it really gets going with some momentum, it's still gonna be opportunity there. I'm looking for, if not today, I'm looking for movement tomorrow. Not just in crypto, but in the S&Ps and the Qs. Like today, I might focus on. There's a few, like I said, there's a few stocks that I'm looking at. Like, it's so weird that, like, what we're putting in here. You have this, like, island reversal in like, Apple and shit like that. So it's putting in a bullish setup. you have this. Now, I have to take it off. I said it earlier. I don't know if you guys were here or not. But there's a bullish setup happening right here. All right. I don't know what happened to it. I don't know what happened to it. Maxine Waters put in a bill and took it away from us. There was a reverse head or an island reversal setting up here. I thought I had Apple up. Could have swore I had Apple up, but maybe I didn't. Maybe I had the wrong ticker in. Fuck, what was it then? I know Taiwan Semiconductor. Excuse my language, I'm sorry. That's so nice. So I want to see, again, I want to see if TSM can hold this level here at 102.75. If it does, I'm taking the long and I'll probably swing it. I will probably swing that position. I didn't even know that I had this up here. I don't really use CNBC. So what is my plan? I just oh, look at this, guys. After I watched the video last night. So again, BITO, BITO, or however you want to play crypto, MSTR. I want to pull back into like BITO 1596, call it $16. Give me the pullback. Give me the pullback into this area, and I will look for a long, unless it just continues and it just this. You've already gotten an increase in volume, so let's see. Let's actually go to a 5-minute chart. We have just 2-3 minutes, guys. I gotta set this chart up. I want to show you guys real quick though the Dow. So yeah, pre-market. Look at pre-market volume, guys. All right, pre-market volume is stepping up. There's a lot of selling too, because they got in early like we did. So keep it, the volume is there today, obviously. It was so funny getting off the stream yesterday. Everybody and their mother was talking about Bitcoin and stuff. I didn't hear a single person talk about it Friday. I didn't hear a single person talk about it. So you know what we got to do? We got to find the next one. We got to find the next idea that nobody's talking about. And get in early. I want to know what it was that I looked at. So the volume's good, guys. The volume's good pre-market. So we should get some volatility there. I don't think it was AMD. I could have swore it was Apple. I guess not. What was I looking at then? That's so weird. That's so weird. I thought that I had Apple up, and I guess not. I don't know. Shit. So, Taiwan Semiconductors, Microsoft. We can look at Meta. Alright, Meta's got to get back up here. It's almost around all-time highs. No. Here. Come on. Come on. Trying to hurry up. We got 1 minute, guys. Good luck today. You guys need any... Oh, MetLife. See what I mean? I'm like, what the flip is going on here? It's not good. Alright, I'm going to put up the SPY, and I'm going to get ready. But look, the Dow. Real quick, the Dow. Look at this. Look at the Dow. This is beautiful. At least yesterday it looked really good. Looked really good yesterday. Look at that hold yesterday, guys. On this pennant. Okay, see how we came up, broke out, pulled back, tested it. Bang. You want to see if we can get an extension. You want to see if we can get a long there. Good luck today. Let's get it. Again, TSM, AMD, Tesla, Microsoft, TSM. I'll have it up. Just watch the screen. All right, I'll go as we get it. We'll go through it, and I'm looking at BITO. There might be a nice bounce right there, guys. Still light volume, so just don't get shaken out. You can have a whipsaw type of action. I'm so fucking pissed, man. Fucking Christ, man. Boss, we're putting in a flag here on the SPY. Okay? We are putting in a bear flag here on the SPY. 2 minute. It could. you know, I think it's going to break. I really do. I think it's going to break. It's got to get some legs there. It's got to get the legs. This doesn't have it, I don't think. I think we hold. I'm going to get bugged by my little girl. I'm just irritated right now. Haven't even gotten the day started, and it's just one of those days, I guess. It is what it is. See if it comes in. Nope. Wow, I've never seen I was gonna say because it won't surprise me if it tries to go up and out. This is so weird. This is such a weird pattern. I've never seen this before. I've literally never seen like a square like that. But you could tell how it was like fighting that trend line on the downtrend right here, or the uptrend, and it was also at resistance, and it just wouldn't break. Just wouldn't break. Wouldn't budge. Where's pre-market low? I'm gonna put pre-market low in, or an area of resistance at pre-market. Just so irritated this morning. I don't even know why. I just am. My little girl just keeps running in and out, in and out, in and out, in and out, in and out. And I'm like, yo, you got, like... Probably gonna wait for Powell's testimony before I get anything. Again, if we're gonna short Microsoft, I said short the bounce. Alright, we want to short the bounce. If we're gonna short it. If we're gonna short it. I gotta find something that's fucking moving, man. Like, I don't want to be playing this Microsoft shit if there's no reason to be playing Microsoft. Like, but there's hardly no news this morning. Like, just frustrated, that's all. I'm just frustrated. And there's the fake out on the SPY. There's the failed breakout. You failed to break up past pre-market lows. That's a bull flag. Tried to break out, couldn't do it. See you later. I will probably step in down here at yesterday's lows and see if we can't put in a range and give us some upside. because I just think that it's, you know, the market's not going to. I guess, you know, Powell, they do have they do.
Resuming trade now after a circuit breaker call now for Hotel India. $2.15 at the high now.
Alpha Hotel India. Oh, I already have this thing fibbed? Huh? That's hilarious. That's hilarious. Alright, looks like we got a small cap in play, guys. The volume's there. The volume is there. Alright. Looks like we got a small cap. It's already halted. Looks like Spy's trying to put in a failed breakdown. I don't know. I think it's really a hit or miss on what the Spy does here. All right, because it could just revert right back to where we open when Powell comes on. I don't know. Maybe the market took it that we know what we're going to get. So you could be short here on the Spy. Look for a point or two. Just don't want it to. I just don't want you to get caught in a rip higher. Shut the fuck up. Not y'all. I'm not talking to you guys in chat. It's just the type of shit I'm on right now. There's that nice fucking wick tail. Shake them out. Look at that volume. Bang. Let's go. We took that long there on the Spy, just so you guys know. I want to see if we can at least test VWAP. It may break, but that's okay. Lower day yesterday. I'm taking it. Alright. We are long the Spy at 435. It'll probably break. I don't want to fight the trend. Look at that increase in volume as well. Alright. So, do not trade that. You will lose money.
Tedros says preparing for very high probability of El Nino event in 2023 and 2024.
Wait. Hold on. Did I not get filled? Hold on. Hold on. Did I not get filled on that Spy? Yo, I didn't get filled. Ha! I didn't get filled. You gotta be kidding me. It's probably a good thing. Not really, because I like to stick to my... Oh, man. What the fuck? So, I would have been profitable right there. Would have been a nice little scalp. It's only a 20 cents, 30 cents. But I didn't get filled.
ASCP. Night scope.
See if we get another entry on it. We'll see. I want to find something.
To be featured at
There's the bounce, guys. You gotta watch what we do here. As soon as I go to it, it halts. Shat.
At the highs now, $2.56.
And they're coming up to our target on the SPY, but you know, they trying to do us dirty. That's crazy. No, so I did get filled. What's going on here? I'm taking some off, guys. What the fuck? Dude. I took that off right there on that wick. What the fuck is going on with it? What the fuck? Alright, well there's a piece off, guys, on that tail through VWAP. That was just a small little green trade to get things started today. Didn't think I had it. Didn't think I had the entry. Look, we're coming back to get resistance. Or turn this into support. Let's turn this into support. Let's grind a little higher. Let's grind a little higher. I don't like the volume. I don't like the sell volume there. Don't like it. There we go. Let's go. Let's go. This thing might... Watch, this thing might bounce around. That was a failed breakdown, guys. Where's our targets? Where are we going? Where are we going? Ask yourself that. Look for your targets. Are we going to turn this into resistance? 437? That's a $3 move, guys. That's a $3 move if we can work our way back up to test this 437. Yesterday's close. Where's yesterday's close at? Yesterday's close was up at, yeah, 437. But this is the area you want to test during market hours for resistance. So I would keep your eye on it. Maybe Powell takes us there. I don't know. I'm not a mind reader. I write down my targets. I write down my buys and my sells, and I just stick to the game plan. I could have got screwed there, guys. I could have been sitting in a trade and not knew I was in it, and that was a failed breakout to take advantage of VWAP. So we'll just sit here and watch it. Again, I just feel like we might just sit here and wait for Powell. They've gotten the pre-written statement. We're going to have Powell up live. I'm going to work on that. We have AH, AMD. Yo, that was a close one, gang. That was a close one. Holy shit. I bought 15 calls for this. I bought 15 calls there. And it didn't show up. Yo, it did not show up. on my order. That was insane. I cannot. That's never happened before. Seriously, that's never happened. Look at AMD. Crushed. Getting crushed again. There's no saving this thing. It's done. Put it to sleep. It's still got a little bit of this. It's still got room, I feel like. You guys see why I put that pre-market low in? Look at it. It wicked right to it, lined up with VWAP. It was a nice target area. Long 435. And we're out at 4, what is that, 80, 90? I mean, we wicked it. We were able to get out on that wick. But, so, you guys are going to want to start, like, you guys want to get used to moves. Like, that was such a fast move is what I was, like, really looking for. I was really looking for a bounce. When we get into a regular market and you're only moving $1 in a day and shit like that, like, you guys are going to want to think about that stuff. Just green trades. Guys, we got to start watching this area in AMD. If it starts breaking this area, guys, I want to be short AMD. I want to be short AMD. If we break this area here, I want to be short into the gap. I guess that's red. I don't know. Look at it. It fucking cracked it, guys. Watch AMD, guys. This is a big one. We could potentially get this thing to the downside fairly well. Fuck. There's another. The SPY's trying to bounce again. If it holds this level, guys, watch out. Especially if it holds. Also, you want to give it a little range. It's not an exact price point. But yesterday's low. Fucking AMD, man. Excuse my language. I apologize. Come on. Come on. Come on. Come on. There goes the SPY. SPY broke the level. Alright, let's see here. So AMD might... Look, guys, it's actually cracking it on lower volume. I don't like that. So we might want to look for some support down here. This is the last leg. If it gets down to 115.81, it's the last leg. Look how low the volume is, guys. You would think that this thing's got some big volume with it. It looks... Give me the MACD. Alright, so we do have it. Look at the MACD, guys. Right there. That's the low of the MACD. You put in a new low. Right here. Put in a new low. You got a higher MACD. Again, new low. Higher MACD. So look at the SPY. It's trying to. I feel like it's trying to hold up a little bit. Start up on a para now, yeah. I don't know why I got that song in my head. I guess a little green trade will put me in a good mood. So we got back the little bit of loss in Rivian yesterday, and we're profitable on that bounce on the SPY. It was an AMD 113 puts, just got out. That's what's up, man. Can I ask you a question? What made you get into puts? What made you get into puts right there? The volume is awful right now. Volume is sad. Look at this. This is the lowest volume. But that's what's up, man. I'm happy for you. I would just keep that stuff in mind. Look at this volume. It's horrid. H-O-R-I-D, if that's how I can't spell. But horrid. That is some ugly volume. What does that mean? Maybe the buyers are just waiting for this nonsense to stop and they want to buy it. I don't know. Me no know. But I do know the volume is sad. So where is the volume at? That's the question. What's the IWM doing? Sorry, guys. IWM, new low. I need a bigger boat. There goes the SPY breaking the level. But watch for yesterday's close right here at this turquoise line, dotted line. Spotify selling off. RSI, look, we're putting in a new low on the SPY, but the RSI is putting in a higher low. That's strength to the upside. It's telling you there's a low volume sell-off, that there's not much real selling depth behind it. You want to get cute? You could try and buy in front of that, but it might not work out well. They might just slam it in your face and shake you out. And then you sell because it breaks it. And then as soon as you sell, it rips to the upside. Psychology is a funny thing. You could time it. You can literally time it. Look at IWM. That might be the volume short. So we're seeing this all over. The volume short because, again, they're waiting for this testimony. They're waiting for the testimony. Let's look. See what I tell you guys. It's going to break it. Watch. It's going to break it, and then it'll rip to the upside, and somebody's going to get caught in it because they're in a trade they shouldn't be in, or they're oversized and they can't handle it. Isn't this funny? I'm telling y'all, bro. Listen, I know the market. I know the market. I know the market. Doesn't mean that it's going to test back up, but if I do, I might take a short here. Hard to say. But it might also test back up here, I feel like, and actually break it. Because you're like, oh, so look at the break and retest. It broke this level. It's coming back to retest it. Let me take a short. What I tell you, I told you you would get a nice wick and a reversal right there. Watch if yesterday's low becomes resistance. Oh, watch out. I need to put this up. And I was kind of right yesterday. So yesterday I said I was wrong when I said that I was looking at, that I thought that I was looking at my numbers wrong. So we broke. We are starting to get into the gap. We have 2 minutes until Powell. I'm going to get this ready, guys. It's game time. It's almost game time. We're going to get our boy. What the happened here? Oh, 2 hours. Yo, what? No, 5 minutes. 5 minutes. I talk like that because I used to work with a Spanish boy, and he used to be like, me no. He would talk like Spanish and shit, and he got me talking like it. It's just hilarious. He said it's funny. My boy Javier. My boy Javi. We'll keep it at that. He said, "Cop pull me over." I said, "Me no know. Me no speak English." Oh shit. 5 minute. Boom. I'm gonna get Powell up. Also, I gotta get my headphones real quick for us. Look at the uptick. Look at the advanced decline line. Okay, stocks advancing versus stocks declining. There's more going up than there is going down. That's what that means. Look at the bounce. I told you. Watch for the bounce. I told you this. And we're at the section. We're at the part of the book where I told you. Oh, look at the break and retest. It's gonna break, and it broke it. So now the support's got to become resistance. It doesn't have to do shit. All right, doesn't have to do shit. Now you're gonna think you're gonna be cute and get in front of there and short, and it's just gonna rip higher and test VWAP again. Shake out just for a loss. All right, die by 1,000 cuts. The market don't want your ass. That's what's gonna happen to somebody. All right, or they, who knows? You know, I'm just saying. I know the market. Look, it's this is the anticipation. Gotta love it. Gotta love it. Market's getting a little antsy. Let's go. I gotta get Powell up here, guys. I gotta get Powell. 2 minute, 5 minute. What the is a 5 minute doing up there? I don't want no 5 minute. AMD still going on low volume. That's crazy. That's insane. I gotta run outside, guys, to grab whatchamacallit. I gotta go outside to grab the goods. I gotta grab my AirPods so we can hear this Powell. Powell a lot. Let's get it. June 14th. I don't want no old shit. Just give me the Fed site. Come on, just give me the Fed site. Oh my god. Nope, don't want. Everything's just a flippin' mess here. Testimony. Chair Powell, let's go.
SBEV, Splash Beverage enters distribution agreement with North Carolina's Coastal Beverage. That's Sandy Bravo Echo Victor, SBEV.
Nah, man, I want the Fed to cover this shit. I don't want a third party. It is the Fed, I guess. I guess it is.
FOXO getting a pop here. Foxtrot Oscar X-ray Oscar. FOXO. 38 cents, up 22%.
So with inflation remaining well above our loan. So guys, this is his previous written testimony. Okay. This is why the market's selling off, and we're getting an increasing volume there. All right, we turn this low into it. Let's go get into some 430 puts. I just. All right, we're getting some. Let's go, guys. Yeah, it's all good, man. Listen, wait for the test. Wait for this. Wait for this 9 EMA test, man. You're going to get a bounce back. If the stock is truly strong in the direction, it will give you more than one opportunity. I promise. All right, I promise. 435, 435, 435, and we're gonna look to get to 430. Watch, you could get a bounce right before he comes on, but again, I haven't had a chance to read this stuff. You gotta see what he said about what was in the pre-written statement that they didn't like. Okay, and this is what it takes to know, like, to say, hey, I should have held my puts. Well, if you were able to bring this up with inflation remaining well above our longer run 2%, blah, 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 market conditions remain tight. Has significantly tightened the stance of monetary policy, raised our policy interest rate by 5 percentage points, blah, blah, blah. All that shit. So, there's so much news coming through, I can't. Alright, it's 10:05, let's get it. Let's go. I don't want it to be behind.
$6.11 now off the lows down 42% after that complete response letter from the FDA. Shares holding on the breaker.
Alright, I'm grabbing my headphones real quick. It's on, guys.
Consumers and job creators share, and I share their anxiety as well. The rapid rise in interest rates, coupled with knock-on effects of the bank failures, have led to signs of a credit crisis.
You guys can hear it. There you go.
This would have a damaging impact to consumers and job creators alike. To top it off, Vice Chair for Supervision Michael Barr is undergoing.
I'm just upset I wasn't able to read the release. I didn't know when it was coming out.
Interesting that he mentioned in the press even yesterday. Is a
and
approach to stress tests
Pay attention to this volume right there.
If reports are accurate, he's pursuing a massive increase in capital standards for medium and large institutions.
I'm gonna grab a
This
bite.
would limit banks' ability to lend money, exacerbating the looming credit crunch and starving families and small businesses the capital they need.
Well, that's
Financial markets will
quantitative
also bear
tightening,
this
bud.
as they will be
That's what
forced to
happens.
absorb nearly $1 trillion
Somebody's got to do it.
This has led many to believe the Fed may be called on to help, perhaps through its repo or other facilities. Clearly, our economy is in a precarious position, from inflation to a potential credit crunch to substantial balance sheet risks for financial institutions. There's a great deal of uncertainty on the horizon. Uncertainty from the Fed supervision and regulation is the last thing the well-capitalized banking system needs now. Following numerous supervisory failures and a new vice chair for supervision,
I want to retest a 435. Hold on, let me see here.
it's become clear that Congress
We may have already done it, but I want to do it on a longer time frame. Because, guys, you can still flip the script down here at 433, so be careful. You're not out of the woods yet. You're not out of the woods.
Thank you for being here today, and the chair now recognizes the ranking member of the full committee, the gentleman from California.
435.
For an opening statement.
Thank you, Chairman McHenry.
Inside EV.
Chairman Powell, welcome back. First, I'd like to start by acknowledging that the Federal Reserve made the right
She's such a
decision
hoe.
to pause interest rate hikes. As you know, since last November, I've cautioned against any approach to monetary policy.
And you know what? Let me take that back.
The Fed's maximum employment mandate and results in a recession with millions of people.
I can't talk about her and then me talk, you know.
Strong job growth thus
So.
far. Experts contend that this trend will not persist with more rate hikes, especially in light of new challenges. For example, the recent bank failures have resulted in the banking industry further restricting credit, making it even more important for the Fed to move with caution.
That's not why.
Progress that we have made
It's because short-term rates are low or higher than long-term rates.
latest consumer price index data. In fact, it's been months, 10 months, since the passage of the Inflation Reduction Act, and inflation has successfully been cut in half. Every
Yeah,
single
right.
member of Congress voted
Yeah,
against the
right.
bill and chose to cozy up
ALPX out there at
to
third
the wealthy
meeting.
tax cheats instead of working with Democrats to bring down costs for middle-class families. However, the only way we will fully combat inflation is to address the primary driver of inflation, soaring housing costs. Congress must invest more in fair and affordable housing.
Yo, my boy. He's got a picture with her and Sam Bankman-Fried from FTX.
On the rise. So far, there's been 29 straight months of strong job growth. In fact, a record 13 million jobs have been created since President Biden took office. Democrats are working to build on this progress and grow the middle class so that everyone can share in this economic growth. Republicans, however, just can't seem to get their houses.
What I tell y'all,
on the hills.
here we go. The Republicans just can't. She couldn't leave the other side out and worry about the man that's in front of her, the Federal Reserve. Just couldn't do it.
Less than 1%
Start voting for the people that will go in and actually do their fucking job.
appraisal fees and title insurance. Instead, they're fighting about gas stoves. In fact, just a week ago,
Look at the rip to the upside. There you go, guys. There you go. There's that 435 test that I was talking about.
House floor
435 test.
times in 20 years. Lastly, as we continue to monitor the banking system following the recent bank failures, the Fed must act to correct the supervisory and regulatory failures identified by our committee's oversight. Committee Democrats recently introduced 11 bills, including 3 of my own, to strengthen the safety and soundness of our banking system and hold executives.
So, is the banking system not okay, or is it okay? Everyone's saying that the banking system's fine. There's nothing wrong with it. So why would you have to do that? So which is it? Is there issues with the banking system? Is there not issues with the banking system? Please tell me. I'd like to know.
Since
Why do you have to make reform and legislation?
With that,
Um,
I yield back.
but yet Yellen is preaching that everything's fine. There's nothing wrong with the banks.
Mr. Barr,
Like, come on, which is it?
monetary policy for 1 minute.
We expect proposals from the Fed's Vice Chairman for Supervision that could increase capital for financial institutions as much as 20%. Our already well-capitalized banks withstood the COVID shock and severe Fed stress tests as the economy is facing headwinds from the Fed's own rapid rate hikes. Now is not the time to be engineering massive new regulatory changes or hindering regional banks, which have already been under stress. New onerous one-size-fits-all regulation by the Fed needs proper vetting and transparency. I would ask you today to commit to providing us with analysis done so far by the Fed on the Vice Chair's new proposals. I also respectfully ask that the Chairman revisit Section 1107A1 of the Dodd-Frank Act to observe that the Vice Chairman for Supervision is authorized only to develop recommendations for the board.
This is why you don't want to front run a move and then it rip on you. Look at this. Look at that, guys. Now, this is a 15-minute chart, but this is why you don't front run a move. I mean, you can keep your stops tight and stop yourself out, yeah, but you don't want to do that. That's not putting yourself in the right side of probability.
Financial institutions monetary policy, Mr. Powell.
Right side of probability would say, hey, it's been resistance. You just V'd right back up, technically. As much as it doesn't seem like it should be resistance, it may break it. I don't know. Because usually if you go, you have all these tails here. I'll let you guys listen to this. I'm sorry.
Continue to be more of a soft landing than a disaster for our economy. While there is certainly more work to be done, but in the immediate term, we can reflect with satisfaction on the historically low unemployment, 11 straight months of slowing inflation since the passage of the Inflation Reduction Act. However, I recognize that the necessary...
Why was it there to begin with? Why was inflation there to begin with?
Including on the fraction of our banks that chose to ignore the Fed's clear forward guidance on that interest rate hikes were in the pipeline.
Watch VWAP, guys. 5:39. I'm watching on the SPY.
I look forward to discussing how recent policies have performed.
It was news on Amazon, by the way, is why I had that up.
Strong economic rebound. Thank you, and I yield back.
Today, we welcome the testimony of Honorable Jerome
FTC
Powell,
sues
Chair of the Board of Governors
Amazon.
of the Federal Reserve System. Chair Powell, we thank you for your time and being here. We'll recognize you for 5 minutes to give an oral presentation of your written testimony. Without objection, your written testimony will be made a part of the record. Chairman Powell, you're recognized.
Thank you, Chairman McHenry, Ranking Member Waters, and other members of the committee. I appreciate the opportunity to present the Federal Reserve's semi-annual monetary policy report.
Chairman Powell, if you'll pull the mic closer. Thanks.
Oh, don't do that to him.
Focus on a dual mandate to promote maximum employment and stable prices for the American people. My colleagues and I understand the hardship that high inflation is causing, and we remain strongly committed to bringing inflation back down to our 2% goal. Price stability is the responsibility of the Federal Reserve, and without it, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. I will review the current economic situation before turning to monetary policy. The U.S. economy slowed significantly last year, and recent indicators suggest that economic activity has continued to expand at a modest pace. Although growth in consumer spending has picked up this year, activity in the housing sector remains weak, largely reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment. The labor market remains very tight. Over the first 5 months of the year, job gains averaged a robust 314,000 jobs per month. The unemployment rate moved up but remained low in May at 3.7%. There are some
Watch out if we put a reverse head and shoulders in here. You have your left shoulder, head. This could be your right shoulder.
Has moved up in recent months. Aged 25 to 54. Nominal wage growth has shown some signs of easing, and job vacancies have declined so far this year. While the jobs to workers gap has narrowed, labor demand still substantially exceeds the supply of available workers. Inflation remains well above our longer-run goal of 2%. Over the 12 months ending in April, total personal consumption expenditures prices rose 4.4%. Excluding the volatile food and energy categories, core PCE prices rose 4.7%. In May, the 12-month change in the CPI came in at 4.0%, and the change in the core CPI was 5.3%. Inflation has moderated somewhat since the middle of last year. Nonetheless, inflation pressures continue to run high, and the process of getting inflation back down to 2% has a long way to go. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. With inflation running well above our longer-run goal of 2% and with labor market conditions remaining tight, the FOMC has significantly tightened the stance of monetary policy. We've raised our policy interest rate by 5 percentage points.
AMD's finally broke.
And have continued to reduce our securities.
I might swing. I might put a swing position on with the stop up here at 115.
Demand in most interest rate sensitive sectors of the economy. It will take time, however, for the full effects of monetary restraint to be realized, especially on inflation. The economy is facing headwinds from tighter credit conditions for households and businesses, which are likely to weigh on economic activity, hiring, and inflation. And the extent of these effects remains uncertain. In light of how far we have come in tightening policy, the uncertain lags with which monetary policy affects the economy, and potential headwinds from credit tightening, the FOMC decided last week to maintain the target range for the federal funds rate at 5 to 5.25%, and to continue the process of significantly reducing our securities holdings. Nearly all FOMC participants
By how much?
to raise interest rates somewhat further by the end of the year. But at last week's meeting, considering how far and how fast we've moved, we judged it prudent to hold the target range steady to allow the committee to assess additional information and its implications for monetary policy. In determining the extent of additional policy firming that may be appropriate to return inflation to 2% over time, we will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity,
And I missed that entry.
economic and financial development.
I was hoping to get maybe,
Continue to make our decisions meeting
I don't know. I don't know what I was looking for. But that was it right there.
implications for the outlook for economic activity and inflation, as well as the balance of risks. We remain committed to bringing inflation back down to our 2% goal and to keeping longer-term inflation expectations well anchored. Reducing inflation is likely to require a period of below-trend growth and some softening in labor market conditions. Restoring price stability, again, is essential to set the stage for achieving maximum employment and stable prices over the longer run. Before concluding, let me briefly address the condition of the banking sector. The U.S. banking system is sound and resilient. As detailed in the box on financial stability in the Monetary Policy Report, the Fed, together with the Treasury and the FDIC, took decisive action in March to protect the U.S. economy and to strengthen public confidence in our banking system. The recent bank failures, including that of Silicon Valley Bank and the resulting bank stress, have highlighted the importance of ensuring that we have the appropriate rules and supervisory practices for banks of this size. We are committed to addressing these vulnerabilities to make for a stronger and more resilient banking system. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you.
Thank you, Chairman. I now recognize myself for 5 minutes. Chairman Powell, as I laid out in my opening statement, inflation continues to be broad-based and persistent, both of which are concerning. Last week, the Federal Open Markets Committee decided to pause rate increases. And at the same time, the committee alluded that it would raise rates more later in the year. And so how should the FOMC's posture at the June meeting be interpreted? Will the committee continue to raise rates later this year? What's the thinking of this? What are we to understand?
Thank you, Mr. Chairman. So you're right, of course. We did decide to maintain the federal funds rate at its current rate at this meeting. At the same time, participants submitted personal forecasts suggesting that almost all of them thought there would be additional hikes. And I just want to say those two things are entirely consistent. The point being that the level to which we raise rates is actually a separate question of the speed with which we move. Earlier in the process, speed was very important. It's not very important now. The sense of the summary of economic projections and the decision really is just that, given how far we've come, it may make sense to move rates higher, but to do so at a more moderate pace. That's really it. You know, we were at 75 basis points for several meetings, then we were at 50 basis points, then 50 basis points, 25 basis points at 3 consecutive meetings, and now we're moderating that pace, much as you might do if you were to be driving 75 miles an hour on the highway, then 50 miles an hour on a local highway, and then as you get closer to your destination, as you try to find that destination, you slow down even further.
Okay. So it is more data is necessary for the Fed to make these decisions, and that's one interpretation, but thank you for a broader view there. I also want a broader view on this question of the vice chair for supervision is performing his own personal holistic review of the Fed's regulatory framework for bank capital and liquidity. In an interview yesterday, he discussed some version of a new type of stress test even, striking complete confusion in his description of it. And at the same time, we have testimony from you, even from the Vice Chair of Supervision, saying that we have a sound banking system that is well capitalized. You will sit in judgment of this proposal that the Vice Chair for Supervision will bring to the full board on this holistic review of capital. There are a lot of discussions about the amount of capital he's talking about, the concern that this is pro-cyclical at a time where our economy with higher rates is, you're measuring what's happening in the broader economy, and at the same time we're going to have a major piece of capital required by financial institutions, which will further restrict lending. So how can you tell us to think about that, given your seat on the Open Markets Committee and as a Fed governor? How would you interpret that?
So I guess I would say you're right. There are a significant number of proposals that are kind of in the works. They haven't been finalized, let alone brought to the board yet, and so I can't really get into specific details today.
Well, we'd like your thinking, Chairman Powell. That's what we'd like.
What I can share is principles and how I will think about this. Regulatory proposals go to the board. Every person on the board, that's 6 governors now, has an obligation to evaluate and vote on those, and I'm one of those people. I also chair the board. So a couple things I would point out. Just first that, I think regulation should be transparent and consistent and not too volatile, and particularly as it relates to capital requirements. I do note the central importance of capital. We want banks to be resilient to shocks. We want them to be able to lend in good and bad times. We want, in particular, the GSIBs, the 8 largest banks, to have very high levels of capital and liquidity. Indeed, we spent years raising those levels over a long period of time, and I think there's broad agreement, as you point out, that capital is strong. And the question there will be what sorts of increases will be justified. That's what we'll be looking at. The other thing is to point out the trade-off between higher capital. The benefit of it, of course, is to have stronger banks that can lend and maybe survive more kinds of crisis environments. But there are costs as well. And I think it's going to be, as always, a question of weighing and balancing those costs. And that's what I'll be thinking about. The last thing I'll say about that is just we benefit from having banks of all different shapes and sizes in our system, and we want to be careful not to regulate the smaller banks to the point where really their business models are challenged for all but the largest banks.
Well, this committee would expect...
That's exactly what I said this morning. The regulation for these smaller regional banks is not going to be good for smaller communities. You think you have ghettos now? Yeah? Throw some regulation on these regionals and see what happens then. You ain't gonna be able to have shit.
Thank you very much. Chair Powell, at this committee's last hearing on digital assets, my Republican colleagues proposed a stablecoin bill that would create 58 different licenses with federal
But that's okay, because the one talking right now, she don't give a shit.
of the licenses. The remaining 56 licenses can be issued by each state, territory, and DC with little or no federal oversight, regulation, and enforcement. This proposal takes state preemption into a whole new level. It effectively allows every state to preempt another state. DC-based coins, for example, would be sold to individuals nationwide, and New York or North Carolina regulators could do nothing to protect their own residents, while even the Fed would be severely hamstrung in providing any oversight. I've argued that we should allow states to be part of this process.
The residents take care of themselves.
With a role
This idea that somebody else has to take care of you needs to go.
payment, stablecoins issued by non-banks in order to ensure that consumers are protected. Such a framework is similar to our dual banking system, and it would ensure that non-banks and banks are treated the same. We should also bear in mind that payment stablecoins are a new form of currency intended to allow individuals to pay for things with them. As such, do you agree that it is important for the Fed, as our central bank, to have a chance to approve or decline any state licensed non-bank entity before it starts issuing payment stablecoins nationwide?
Well, first of all, let me say we appreciate that we've been able to offer our views on these things to your staff and also the majority staff, and we appreciate the consideration that's given to our views. We do see payment stablecoins as a form of money, and in all advanced economies, the ultimate source of credibility in money is the central bank, and we believe that it would be appropriate to have quite a robust federal role in what happens in stablecoins going forward, and that leaving us with a weak role and allowing a lot of private money creation at the state level would be a mistake. But nonetheless, again, I do appreciate that we've
Hey, y'all see that? What up? What's going on now? What's up?
This question that I have for you is a bit unusual. Diversity is because those things that have not been discussed, issues of people of color, etc., have not been.
Oh, here we go. I told y'all the race car was going to come out. Here we go.
Our nation celebrated Juneteenth, which is recognized as a national holiday for the first time since 2021. The holiday celebrates the day in Texas heard
Everybody smile.
years after the proclamation was issued. To this day, Black Americans grapple with enduring economic inequality that has its
Talk about it.
evidenced by the black-white gap in net worth and home ownership rates. My bill, the Federal Reserve Racial and Economic Equity Act, would require the Federal Reserve to carry out its duties in a manner that supports the elimination of racial
So why didn't they carry it out at SVB
income
and FTX?
access to affordable.
Look at you.
Now, the Fed has a number of duties to pursue maximum employment in the monetary policy, to supervise banks for compliance with our fair lending laws, and to ensure the Community Reinvestment Act is administered in a way that puts an end to discriminatory redlining practices by banks. Do you agree with me? And Atlanta, Federal Reserve President Raphael Bostic, among others, that the Fed has a role to play in addressing racial economic inequality as it carries out its work until Congress passes this bill. What steps will the Fed can you take to address racial and economic inequality?
So we do consider inequality in the economy as part of our thinking decisions, but ultimately,
Does that include poor white people? Does that include poor Spanish people? Poor Asian people? Huh? Or is it just African American coming from the African American? If she's African American, I don't know if she is or not. All right. Looks like you're doing all right, and your color didn't stop you from doing what you wanted to do in life. Okay? So the decision made by individuals, you can't make this excuse that because you can't tie everyone's decisions that they make in life, whether they're good or bad. Some people make good decisions. People make bad decisions. Of course, you had to throw the race card in there, Maxine Waters.
Mr. Hill of Arkansas for 5 minutes.
Can we get this type of rhetoric out? What the? You got Jerome Powell and real serious shit going on here, and she's going to talk about racial inequality. What the hell does that have to do with interest rates and the Fed balance sheet and the Treasury General account? What you should be worried about.
Despite COVID-19, with a 20% plus unemployment rate increase and a 9% output gap, they've remained stable through government shutdowns. They've remained stable through severe stress testing. And maybe more importantly, just in the last few months, since the first week of March, you've seen strong capital come into play as we've grappled with the reality of a 40-year increase in short-term interest rates and that impact on banks. But as the chairman said, Michael Barr continues to say he wants to increase capital requirements on certain financial institutions. And in March, you testified that you said, I will do everything I can possibly do to bring people together, meaning on the Board of Governors, in consensus and have a capital framework that could be broadly supported. So to what extent have you and the other governors been involved in this so-called holistic review by Vice Chair Barr? Has he briefed the other members of the Board of Governors thus far?
Yes, and we've all been briefed by staff, really, on the proposals, but as I mentioned, they're still somewhat in motion. But yes, we've been briefed.
So you would say those proposals are still under consideration and that there's no final decision that's been taken by the board?
No, well, no, once the proposals really do settle down and are written up, they'll come to the board for a full discussion and a vote.
Has the Fed board reconstituted now the Committee on Supervision and Regulation, the membership of it?
Oh,
who's on that committee now?
So that committee is chaired by Vice Chair Barr, and it also includes Governor Jefferson, and it includes Governor Bowman.
When you look at capital in the U.S., and I look at the globally significant banks here versus other places in the world, would you say that the U.S. banks, the U.S. G-SIBs, are better capitalized than their global peers in Europe or in Asia?
So we're certainly at or near the top of the league table. I think there are a couple other jurisdictions that also have broadly similar levels of capital strength, but yes, we're at the top of the league table.
I looked at it this morning, and U.S. G-SIBs have 11.3% capital without any kind of modification compared to their European competitors at only 9.9%. So would you say that we're better capitalized than the European banks, the European G-SIBs?
I hate to call out the other jurisdictions, but I would say our banks are very strongly capitalized and also competing quite successfully globally outside the United States.
Yeah, I agree, and I think we've strengthened capital, we've strengthened our supervision, notwithstanding the problems that we saw this spring, which we've talked about ad nauseum here. But that capital standard does make American banks, I think, stand out. And wouldn't Basel, the so-called Basel III holistic reforms, wouldn't it be...
You guys know what Basel III is? I'll have to get into that later if you don't know what it is.
Capital up to American standards?
So I think they are bound by the same, no one's bound by these, but they have agreed to follow the same standards, and I think they're going through the same process we're going through.
Same topic, are the FDIC supervisory process and the OCC supervisors, are they involved and engaged with Vice Chair Barr in looking at this, quote, holistic review of capital adequacy? In other words, are they providing their input to the Vice Chair for supervision in their own views on this topic?
On the regulatory proposals that are relevant to them, yes, I think on the capital.
What did I tell you guys before? Right here. Look for the reverse head and shoulders. See if we start to rally here. This is how you got to trade. You got to look to see what patterns are setting up or possibly setting up. Like, you don't know
see change.
but you want to just,
I think frustrating.
try to, what is it telling you about the future? I look like it was putting in a really nice reverse head and shoulder here.
Oversight board should now base their decisions on size as opposed to activities. And for several years now, we've had an activities designation and a cost-benefit analysis. Do you think the activities designation gives supervisors more discretion at FSOC to select who should be deemed under their supervision?
So I actually think that
In other words, is size alone, should we be looking only at size, or should we look at cost-benefit analysis and activities? And my time's expired. If you'd answer in writing, I would appreciate it. I think this is an important issue. I yield back, Mr. Chairman.
We'll now go to Ms. Velasquez of New York for 5 minutes.
Thank you, Mr. Chairman. Chair Powell, at your press conference last week, you stated, and I quote, "The committee is completely unified in the need to get inflation down to 2% and will do whatever it takes to get it down to 2% over time." Some analysts have interpreted this statement as the FOMC's willingness to trigger a recession in order to get inflation to 2%. How would you respond if this is a fair and accurate interpretation?
So our statutory goals are price stability and maximum employment, and we are dedicated to using our tools to achieving those. In the case of employment, we still have historically low unemployment rates and from our inflation target of 2%, and we're very focused on getting back to 2%.
And how does the FOMC takes into consideration the impact of rising interest rates on LMI communities and small businesses when determining monetary policies?
So we only have one interest rate to raise or lower. It's not true, but mainly one main interest rate to raise or lower, and it applies to everyone. But I would say that inflation hits LMI communities and people generally at the lower end of the income spectrum much harder than people in the middle or at the high end, because high inflation can get you into trouble right away if you're living on a fixed income just to cover the basic necessities. So it is for the benefit of those people that we must get inflation under control. It's for the benefit of
That's who I preach for, the people that are on fixed income, that are retired.
keep that in mind as we are strongly committed to getting inflation back down to 2% over time.
If you're poor and you're retired, that's ultimately what he said, is who it hurts.
Hard time accessing loans. The same with small businesses. Chair Powell, Vice Chair Barr's report on the Fed's review of Silicon Valley Bank states that while there was regulatory tailoring conducted in response to S2155, there was also, and this is the part that really concerns me, a cultural shift at the Fed under the direction of the previous Vice Chair for Supervision, Randy Quarles. According to the report, this shift included pressure to reduce burdens on firms, meet a higher burden of proof for a supervisory conclusion, and a need to accumulate more evidence than in the past. As chair,
AMD done. God damn it. I thought about getting in, but I just didn't want to get caught chasing. This could be an all-day event. Look at this gap. Excuse me, I'm sorry.
And also regulation for banks of that.
Shit.
And I'm committed to learning the right lessons
I mean, the volume only picked up. If you really look at it, I mean, the volume's
but
still picking up.
were you aware of the cultural shift?
I can't really characterize it that way. Certainly, I was aware that we were trying to avoid excessive regulatory burden. That
So
is
you
always
disagree
an
with Chair Barr's report in that respect?
I'm sure that the people who wrote the report were accurately reporting what they heard from back in the day.
How often were you meeting with Vice Chair Quarles?
I reasonably frequently. We sat quite near each other.
And never discussed the cultural shift?
I didn't say that. But I don't remember it. The way you're describing it is not what I recall. I recall Vice Chair Quarles talking about things like focusing on the really important issues and not getting diverted into other.
So the way it was described by Vice Chair Barr is not what you recall.
Well,
So what
I had no part in.
steps-
I said I had no part in preparing the report. I'm confident that the staff who worked on the report reported accurately. Well, I think we're taking significant steps now. We're, as you know, under Vice Chair Barr's leadership, we're looking carefully at these events and asking ourselves, what do we need to do with supervision? And I think there is a point to be made that there are situations in which we need to be more forceful and more proactive. Not in all situations, but in some. In regulation, I think we're learning that we need to update our thinking around liquidity regulation, which was based on a certain speed of bank runs, which now looks to be outdated.
My time has expired. The gentlelady's time's expired. We'll now recognize the gentleman from New York, Mr. Garbarino, for 5 minutes.
Thank you, Mr. Chairman. Chairman Powell, thank you for being here. I just want to start off by asking a few yes or no questions. Was the Silicon Valley Bank failure a result of a liquidity issue?
I'm sorry.
Was Silicon Valley Bank failure a result of the liquidity issue?
Among other things, yes.
Signature Bank failure, the result of a liquidity issue?
Yes, I mean, that's not, there's also a lot of very bad management decisions being made here.
But liquidity. First Republic, was that a failure result of a liquidity issue also?
Among other things, yeah. I mean, I wouldn't say just liquidity.
Well, all right. Were any of them a failure of having too low capital levels?
So let's go to Silicon Valley Bank. The issue that triggered the run initially was the presence of significant losses in their securities portfolio.
Yes.
And that is that is a capital issue.
So they had too low a capital, the requirements. So what?
They weren't required to, as you know, they weren't required.
No, the depositors left because rates were finally paying a yield that seemed at a reasonable rate. So they took their money out of the bank. Because again, the banks are not insuring this money up over $200,000 or more.
Any of these other banks or all banks together, would that have stopped these banks from failing?
No.
That's an unknown.
Right. You can't make right.
I think it might have helped. I think it might have helped, but
How much then? Increasing it by how much?
No. It still doesn't matter. You're talking 5% risk-free
the main issue there,
treasuries. Money's going to leave and go there.
supervision to require them to follow up, and really the liquidity regulation was just not appropriate. We needed to have.
Yeah, man, dude, the volume's still increasing. Just get some. Go buy one or two. If you've had a trade on it, I mean, look, or at least wait till we get a bounce. See if you get a bounce back up to 114.30. Look at the volume. It's still increasing. The volume's still there. You have until 110. There's still $2-3 to catch. 112.99 we're at now. You don't want to get. It's not like it's going to completely reverse. It might go up, but it might just consolidate through lunch and then sell back off. You just listen. You can't look at it that way, bro. You can't. Because of the simple fact the volume wasn't there this morning. Yes, it finally broke, but this is the level that it really decided to get liquidated. I mean, again, I don't know what Tesla's doing. I don't know what Nvidia's doing, if they're selling off too or not.
So I understand.
This guy's a fucktard. Look at this flag. You got a flag here on Tesla. That's a nice setup.
Think that an increase is necessary at this time. That an increase in capital.
Look, Nvidia is selling off as well. There goes Nvidia. So look for more downside in AMD.
Proposal turns out to be in the end, and given my
TSM. If this thing's down, I'm going to be hot. It is down, but it's not down as much as AMD.
You just also said that credit is tightening. Won't increasing capital requirements further tighten credit?
Yep.
over time, I mean, the thing about capital requirements is if we put a proposal out this summer, let's say, it'll be quite a while before that proposal is,
Implemented.
among the years to come into full effect. So I would think, whereas interest rates, for example, have immediate effects on financial conditions and then reasonably quick effects on economic activity, capital requirements are
Powell's a little dovish today. Not dovish. He just explained. You could tell his mood and everything. I need you guys to really think about what it is that these people, this guy, the other guys, the other women, the other girls, Maxine, all of them, what is it that they're trying to get at? Like, what's their rhetoric? Like, what is it? What does the questions have to relate to what is it that they're trying to do? Are they just trying to continue with expansion? Do they not want to have a slowdown? Like, and when I say a slowdown, it's not like everything comes to a stop. You know?
These increased capital requirements at any level would have a further tightening on lending. And if that happens, and I'm hearing from everybody, if that happens, it's going to be a real disaster. So I think.
Well, that's hypothetical because the real disaster hasn't came. How do you know? Why is there a disaster? What is the disaster? Because by the time you even think about it being a disaster, rates will already have came down. And the lending would have already picked back up, and then you're looking at not a disaster, but
People in my district are misunderstanding 101 along with me. In May of this year, unemployment remained at 4% for the 16th consecutive month, and at 3.7%. This means that unemployment remained at or below 4% for the longest stretch in 50 years. In the U.S., the job openings rate has fallen by more than 1.5 percentage points from its peak, while the unemployment rate has crept slightly lower. In other words, the job openings decline, but so does joblessness. And I'm wondering if there was any expectation that this would happen.
I would have personally waited for the test of the 9 EMA. Look at the gap here between the 9 EMA and the stock. It's going to put in a bull flag. It's going to consolidate. It's going to pull this down, and it'll probably meet right around here, around 11:04, roughly. Maybe a little bit sooner. What is this? 2-minute candle. It's 11:45 right now. I still think 11 o'clock, 11:04. Okay, and then that's when you want to buy. Like it's a nice double bottom here on the SPY. Higher RSI, higher MACD. This is a bullish setup on the SPY. If the SPY goes up, watch out for AMD. Nvidia Tech, they might follow suit. But you don't have far to go. You gotta plan your entries and exits. Look at this. Let me see here. Can't just jump in. Like, I'm letting it go. I'm not getting in it. It is what it is. I missed that move. This was my entry. I don't even want it. I don't even want to look at it until it comes back here or consolidates, comes back up here at 114.40. So, what I'm trying to say is this stock can go up here. It can go up here, and it still be right on the direction, but you have to give it all the way up here to come back all the way down here, and then to make further downside. It's like, just watch. You got to use the SPY, the Qs. The SPY's putting in a double bottom right now, possibly. It looks like it's actually trying to put in a bear flag, but we'll see. This is a 2-minute chart or a 1-minute chart now. There's the 9 EMA. See how they connect? It consolidates. It pulls the 9 EMA down, and they meet. It's just I don't know. I just want to teach you guys to get good. Like, this is not a trade you should be taking. I'm just saying it's getting liquidated. Okay.
In spite of the fact that there is some
Like, I'm sure you're going to get a bounce,
jelly-like movement
consolidate at launch, and then finish off to the downside. I don't know, but I'm just saying the chances are there.
go out and
There's the bull flag. This is going to be it. Look at the volume. You're starting to get shorts to cover. You really got to use your volume bars. They tell you a story.
loans, even with the interest rates rising.
Look at that.
If that con- if
They're covering. They're taking pieces off. They've had all this.
are constantly
Any more, they're going to start getting greedy. Yes, they have this as their target. I know they have it on their charts. It's a huge level. It's the gap fill. You got to see a rejection here. Let's see where the 3 minutes at. It's going to be a little bit wider. So it's going to consolidate a little bit. See how it consolidates? 3, 6, 9, 12. Takes about 12 minutes until it meets up. 3, 6, 9. It's just so extended. This is a decrease in volume on the way up, which is telling you there's still, so far, there's room to the downside. It's going to consolidate. So it may pop up. It could come. If it comes back up here, I'm getting in. If I come back here to 1435, 1430, I'm getting back in AMD.
Gentleman's time's expired. The gentlewoman from California, Ms. Kim.
Powell said housing inflation will come down significantly this year and next year.
And Chairman Powell, thank you for joining us. I appreciate your comment to price stability and commend your efforts to reduce inflation and make life more affordable for all Americans. Thank you for that. The 10,000 small businesses survey of 2,000 small businesses found that 77% were concerned about their ability to access capital. So with that in mind, do you think it's appropriate for the Federal Reserve to increase capital requirements at this time? And I know this was discussed earlier, but what specific analysis has the Fed conducted so we can determine the impact of this warrantless regulatory action on small businesses and other marginal borrowers?
So with capital standards, it's always a trade-off. The more capital means a more stable, more sound, more resilient banking system, but it also at the margin can mean a little bit less credit availability, and also the price of credit can be affected. And there's no perfect way to assess capital. It's not 100% capital, so it's somewhere in the middle.
Thank you. There are estimated about 1.5 trillion of commercial real estate loans that are maturing in the next 3 years. And declining demand and the prevalence of work-from-home policies are putting a strain on commercial real estate market. The bulk of commercial real estate loans are held by smaller and regional banks. So is the Fed thinking about policies that could provide time for commercial real estate loans to be refinanced? And could an increase in capital requirements reduce liquidity in the commercial real estate loan market?
Is it just me, or this volume is still low? Look at it compared to all the other half-hour bars.
Supervisors are very much engaged with
It just feels like it's still low. It's not like you have a big volume bar up here. It's crazy. Oh, Powell said playbook. See how important playbooks are? The Fed uses it. It's a playbook. Gotta have a playbook. Gotta have a playbook.
So the next question has to do with the board process and procedures. What are those procedures that govern consideration and potential adoption of matters like the proposals that Vice Chair Barr is about to present to the board?
So on regulation, as opposed to supervision, on regulation, the Board of Governors votes on regulatory proposals, and it's a majority vote. We now have 6 voters, so when there is a proposal, it will be briefed carefully, and then we will have we'll have a meeting, or it can be done actually virtually, and probably will be that way, as most of our meetings are, and then we have a vote. That's on supervision. It's different. Most supervisory matters are really under the authority of the Vice Chair for Supervision under the law. So most of them don't have to go to the board for a vote.
So what percentage of the governors must vote in favor?
Majority.
The majority of them? Okay. The California governor, prior to the depositor bailout for SVB, reportedly identified that he had been in touch with the highest levels of leadership at the White House and the Treasury. The governor also, on Sunday, March 12, when the bailout was announced, issued his own statement praising that action. There have also been reports that the governor and his wife, with respect to their business and perhaps other interests, may have had depositor interest in SVB. So when the Federal Reserve Board, the FDIC board, and Secretary Yellen, in consultation with the president, recommended invoking the systemic risk exception for SVB, and then decided to provide blanket insurance even on uninsured balances, did the Fed or any others, to your knowledge, perform any conflict of interest due diligence?
No, I mean, we were in an emergency situation on Monday morning. There was going to be, and there was a run on banks that looked, that
So
had
looking back,
high
do you think
depositors.
there was
So we carried out our
Yeah.
duties, and I'm actually pretty sure we did the right thing.
And you don't think there was any conflict of interest, even looking
I
back?
have nothing.
from
I have absolutely nothing.
What is there a conflict of interest on? He backstopped the banks. That's all it is. They did a great job.
Texas, Mr. Gonzalez is recognized.
Thank you, Mr. Chairman and Ranking Member. Thank you, Chairman, for being here with us this morning. The June Federal Open Market Committee report indicates inflation in the U.S. and abroad continue to ease but remain elevated. In response to the FOMC, that has the proposed interest rate increases up until June 14th recommendations to pause interest rate hikes for the first time this year, research has shown that the effects of monetary policy decisions, like raising interest rates, can take on average 42 months to be realized fully in the United States, meaning we may not fully understand the effects of this first increase in rates of March 2022 until next fall. With that in mind, how have our recent tightened monetary policy...
This market could creep higher. You could blink and look, like turn your head and look back, and an hour or two goes by, and the SPY's back up at 437, 438. So keep an eye out on what the SPY does.
So you're asking how it would affect the dollar?
Yes.
So first of all, the Treasury Department has responsibility for the level of the dollar and the stewardship of the dollar as a currency. We don't actually comment on that. We don't look at any particular level. It's just another, to us, it's a financial condition. A stronger dollar means certain things, and a weaker dollar means certain other things.
Continues to be a concern here in this committee. Also, Chairman, as you're aware, the Federal Reserve's core mission is to keep employment up and inflation down. Although I understand the calls for climate-related financial risk management from my colleagues, we should be focusing on the economic state of our country. The credit of the U.S. dollar is at jeopardy, and as you know, we've had global pressure recently, and we need to be sending a clear message that the world can rely on the full faith and credit of the United States dollar. We should be focusing on mitigating the calls to reduce dependency of the U.S. dollar. Monetary policy changes implemented in the U.S. are likely to cause a ripple effect throughout the global economy. With that said, would you agree that monetary policies to directly address climate change should be made by Congress and not the Federal Reserve, and implementing monetary policies and supervisory tools to exclude energy leaders from capital and financial...
This is what I'm talking about. What the fuck is wrong with this motherfucker? What? What does any of this have anything to do with what is going on? You just wasted 5 minutes, guys. This is the shit I'm talking about.
Thank you, Mr. Chairman.
What?
Thank you for being here. Really appreciate it.
Let me find out what state he's from, so I can just go, just go laugh, and just look at. It's going to tell me a lot about the people of that state,
With respect to climate
or he got over on them. One of the two. You just sat here
you guys have a big enough
about monetary policy, and you went on and on about something that is totally irrelevant. It has nothing to do with what is at hand. This shit cracks me up, guys. This is what I was talking about last night. It's a joke. I feel like this guy might.
Questions already on
Hard to say where his Reddit.
capital, etc. Look, some of the current
Swear to-
views are that continuous raises of bank capital will increase costs to our economy anywhere from $50 to $200 billion. What's your view of the current desire or mode of Vice Chair Barr to fully implement the Basel III capital standards?
Well, I think that's the next thing. Vice Chair Quarles was working on that. It didn't get completed for various reasons, but that, I think that's an international capital standard that we should go ahead and complete. As to the right level of capital, that's a discussion we're about to have.
Are you guys at the Fed, are you guys kind of concerned about the fact that now it seems like the European regulators are starting to pull back from that? Like they're starting to think about capital standards being too much for European banks.
Nope.
They're starting to receive
Christine Lagarde said more.
kind of a handshake agreement in years gone by.
Maybe on cap.
I'm not hearing that exactly.
Right. I'm not either, bro.
Overall, just with respect to capital, I mean, let's take a step back. Obviously, since 2008, 2009, we have, in my view, aggressively gone through this process of increasing capital standards and capital requirements.
He said, I'm not hearing that.
Do you think that's been a net positive to the overall banking environment, or do you believe it's been a negative to the overall banking environment?
I think it's been a net positive, and as I pointed out earlier, U.S. banks have competed very, very successfully through this period, despite what were pretty significant capital increases that we put in a few years back. So it really has led to a very strong, and also made it well through the pandemic period, I thought, and I think that was a pretty good test. So even though the government did do a lot to support the economy, still, I think that those capital hikes that we made in the last cycle come through looking pretty good.
Do you guys at the Fed, do you have a view of, I say you guys because I know you're the chairman, but there's other members as well. Do you have a view of the concern about community banking in the United States, or a lack thereof of community banking? It has been shrinking quite significantly over the past 10 to 12 years.
Very, very much so. It's a focus for us. We understand the importance of community banks, that they provide a different service and a really important service to smaller businesses and communities. And community banks have been consolidating for 30 years now, so it's really a secular trend as people have moved to bigger cities and things like that. But we don't want to do anything to move that along. We think that the world's not a better place with fewer community banks, and we try to keep that in mind in all of the regulatory and supervisory things that we do.
Do you think that federal regulatory policy, in part from Congress, has led to a supercharging effect of diminished community banking in the United States?
It's probably been a factor, but I do think there have been important demographic factors.
And she's talking about what's right and what's wrong. I still can't get over it. It's just so funny.
That also has led to consolidation. You can look back, though, look back 30 plus years, and you've seen a very steady
Amount of money that was handed out to people. Literally, actually, it was just him taking other people's money and pretty much just taking it, doing what he wanted with it, and giving it to all these people.
Look, I don't disagree with your conclusion. I'm just concerned about the trajectory. I think just having larger financial institutions, larger banks overall, with a diminishing smaller community bank infrastructure is detrimental to lending to small businesses, mom and pop businesses. It also could be parochial. I started my career in community banking, so it's a heartfelt situation.
But yet, you just said you're here. This idea that you're hearing them talk about capital requirements and this and that. What?
Custody bank balance sheets, and by extension,
I don't know, man.
Model. Are you guys at the Fed?
Just because you're a bank teller doesn't mean that you have experience in this type of industry.
The gentleman's time has expired. The chairman can
respond to
in
that.
writing.
Okay, fair enough. Thank you, Mr. Chairman.
The gentleman from New York, Mr. Torres, is now recognized.
Thank you, Mr. Chair, and thank you, Chairman Powell. As you know, the U.S. has foreign adversaries, particularly the CCP.
This is going to be a non-event, so it's 11 o'clock. Let's see what happens. There is no
The federal
de-dollarization.
reserve currency is a very important thing to us. I think the reason we have that status is largely due to our great democratic institutions, the rule of law, and the fact that we have, generally speaking, had strong levels of price stability. And I think that the dollar will remain the reserve currency as long as those things are in place.
Well, I want to explore that answer because commentators often speak of the dollar as the world's reserve currency as the cause of America's economic dominance. Do you think of it as the cause of America's economic dominance or as a consequence of it?
To me, it's more of a consequence. And also, there tends to be an equilibrium where one currency becomes the accepted global standard, and that has been the dollar for some time, and I expect that it will be for some time, continue to be.
It's often said that the Fed has a dual mandate of maximum employment and price stability. Do you view these mandates as equally binding upon the Fed, or does one supersede the other?
They are perfectly equal under the law.
And I'm curious to know what it means in practice to have a 2% inflation target. The latest pause notwithstanding, does it mean the Federal Reserve will continue raising interest rates until the 2% target is reached, even if doing so comes at the expense of maximum employment as well as financial stability?
No, it doesn't mean that. It does not. So the way we think about it is most of the time the two goals are aligned in the sense that if you're achieving one, you're achieving the other, and if you're a little bit off, the other one, they move in the same direction. Today's situation is unusual in that we are overachieving, in effect, the maximum employment goal, but we are far from achieving the inflation goal. So in our system, we have a constitutional document, and what it says is that when that's the case, you look at how far you are from the goal, and you look at the speed with which you would move back to the goal. And so that would tell you today that we should focus heavily on inflation, but as it becomes closer, as the two things become more aligned, then they go back into perfect equality under the law.
So the Fed engages in a delicate balancing act between employment and inflation.
Yes.
To what extent do you factor in financial stability, safety, and soundness when raising interest rates?
So you're right. We do have a financial stability mandate, but we try to.
Well, you have a financial stability mandate with respect to your role as a bank regulator. But when it comes to
also just generally, we're the lender of last resort. Central banks were originally created to support the financial system in times of stress and to make sure that you don't get into times of stress. So I would say that, sorry, what was your question before that? It was,
to what extent do you factor in safety and soundness when setting interest rates?
Sorry. So we really try hard to use our financial stability tools for financial stability purposes and our monetary policy tools for monetary purposes. The reality on the ground is much messier than that. They're very much entangled, and one affects the other. So the separation is not at all perfect. But we do think of these as separate things with separate tools.
Do you think that the Silicon Valley bank failure revealed a deeper tension between the safety and soundness mandate of the Fed as a bank regulator and the mandate of the Fed as a administrator of monetary policy?
I would say no, and I'll tell you why. Interest rate risk is one of the most basic banking risks. We supervise for it. Overwhelmingly, U.S. banks did manage their interest rate risk. Silicon Valley Bank didn't, and even though we were, the supervisors were pointing that out to them, they just didn't take. The bank didn't take action quickly enough. So I would have thought that you can say that it was interest rate hikes that caused portfolio losses, but it was management that failed to hedge against those losses and failed to hold appropriate liquidity.
In the pre-COVID world, we had the best of both worlds, low unemployment, low inflation for decades. Do you believe that we could return to that best of both worlds, or are high interest rates a new normal in the American economy?
So we will return to 2% inflation and maximum.
There it is. We will return to 2%. It's just when.
Do you suspect it's going to settle at a higher level than we've known historically?
I think it's really hard to know. It's a great question. We talk about this a lot. The people who argue that they will move it back down just point to the fact that it was really global factors that drove rates down in the first place. Maybe the truth is somewhere in the middle.
Gentleman's time has expired. The gentleman from Nebraska, Mr. Flood, is recognized.
Thank you, Mr. Chairman. Chairman Powell, I'd like to discuss the continued efforts to unwind years and years of quantitative easing and what it's done to our Federal Reserve balance sheet. If you take a look at the size of the Federal Reserve's balance sheet since the 2008.
Oh, he gonna bring it. I feel it.
Alarming increase from around 800 million to today's 8.3 trillion in assets. Back in 2018, you did start the work of winding down the balance sheet. You managed to offload roughly 700 billion assets between the beginning of your time as Federal
This is
Reserve
important.
and August of 2019. The problem was, shortly after your efforts began, we had another major economic shock, the COVID-19 pandemic, that caused the Fed to once again return to quantitative easing as a form of economic relief. Pretty soon, the Federal Reserve's balance sheet had increased another $4 trillion in size. That's how we made it to the balance sheet level that we are at today. I understand you have started working to shed some of the Federal Reserve's balance sheet, and I appreciate the work. That being said, the scale involved here, to me, is startling. My concern, Chairman Powell, is that efforts to shed assets from the Fed's balance sheet have never been anywhere as quick as efforts to build it back up. Our economic cycle does go through recessions from time to time. It's not always boom, but some bust too. If we continue a pattern of rapidly building up the Federal Reserve's balance sheet in bad times and slowly shedding assets in good times, we're going to see the balance sheet grow significantly over time. Chairman Powell, is this a concern of yours? And to pair with that question, long-term, how can we avoid an environment where any effort to unwind the Federal Reserve's balance sheet is undone anytime there's an economic shock?
It is a concern, and that's why we are, this time the balance sheet roll-off is much faster than it was back in the first episode. We also know more. We hadn't grown our balance sheet like that, and we hadn't shrunk it before. Now we have experience with that. So we are moving back down to a level that will be appropriate for our new framework. By the way, we won't go back to a framework where we were dealing with scarce reserves. We like the administrative rate framework that we're in now. But it is
Let's see if we start holding this level here and possibly start to curl up. It's 11:17, so it's either going to it might happen this afternoon. If it happens at all. I don't know what's going to happen.
The idea, and that is, you find the number, but the idea is that it's smaller than now. It's a place where reserves are abundant, and also have a little bit of a buffer on top of that so that we don't accidentally run into reserve scarcity. Demand for reserves can be volatile, and you don't want to find yourself, as we did a few years back, suddenly finding that reserves were scarce, even though we didn't see it coming, and we then had to put more reserves into the system at a time when we didn't want to be doing that. So I think you want to have a level where we have ample reserves plus a buffer, and that'll be a percent of GDP that we get down to, and we're moving in that direction pretty smartly.
Chairman Powell, realistically, how quickly can the Federal Reserve unwind its balance sheet? What's the threshold beyond which an asset sell-off by the Federal Reserve?
Realistically, they could do whatever they want. And he's not selling them. They let them run off. And they just don't reinvest them after they expire.
In the middle of that process. Now we will, it's an empirical question. You're going to find a level that is still ample, plus a bit of a buffer, and that's how we're thinking about it.
Thank you, Mr. Chairman. I would just reiterate my concern on this issue. I fear that having the Federal Reserve backstop so much of our economy through the holding of treasuries and mortgage-backed securities is not sustainable long-term. Thank you, Chairman. I yield back.
Gentleman yields. The gentleman from New York, Mr. Horsford, or Nevada, Mr. Horsford is recognized.
Thank the chair and the ranking member for holding this important hearing, and thank you, Chair Powell, for appearing before the committee today. Before I begin, I'd like to ask permission to enter into the record editorial by the Las Vegas Sun entitled "Economy Infrastructure Thrive When Dems Have the Reins," dated June 16, 2023.
Without objection.
During this time of increased economic uncertainty, it is more important than ever that the Federal Reserve fulfills its dual mission of maximizing employment and supporting price stability. There is no doubt that it is difficult, and the needle that has to be thread is very specific. However, the human cost is simply too great for us to get this wrong. Sometimes we need to be reminded that there are real people behind the economic data and that the actions taken by both Congress and the Fed have real consequences for everyday Americans. Everyday Americans who want to know that myself and my colleagues are dedicated to creating an economy that actually works for them, which is why I was pleased.
Not really. I'm not really dependent on y'all. I like a free market. I actually want less of you. So this idea that you come up with on your own to think that you are to control and make your being as a government think that your job is to take care of other people, well, you're wrong, my friend. You're wrong.
Continues despite the multiple concurrent shocks that continue to reverberate throughout the global economy. And I believe our economy remains resilient thanks to the historic investments that were included in the legislation passed last Congress and signed into law by President Biden.
That shit ain't got nothing to do about any of this. Here we go. It's just funny how you can read people, you know? They say don't judge a book by its cover. Well, we could be spot on with this. And this goofy bastard here behind him, what did we say? The one guy was probably going to get real, ask some good questions, and be there to talk about what he should be talking about. And he did. Funny how that works, right?
Here in America. Just last week, Treasury Secretary Yellen was before this committee and described how the transformational investments from the Inflation Reduction Act are ushering in a renaissance of domestic manufacturing.
Tell him about that Treasury General crowd, how much liquidity that's going to suck out of the economy. Bring that one up.
While reducing our reliance on goods imported from abroad. As I indicated in the editorial by my hometown newspaper, the Las Vegas Sun, remarks that annual investments in manufacturing construction has more than doubled its pre-pandemic levels. Furthermore, when we narrow the focus to the region, including Nevada, the U.S. Census Bureau estimates that in just 2 years, private manufacturing construction increased almost tenfold. So if we want to rebuild the American middle class, we must do so from the middle out and by investing in modern infrastructure and modern manufacturing facilities.
He is such a dumbass. He's such a dumbass.
Time and again from my constituents about the cost of housing being one of their biggest pain points. The Monetary Policy Report points out that housing services prices have risen a shocking 8.5% over the 12-month period ending in April, and in my district, it's even worse. So Chair Powell, at a time where it has become increasingly difficult for working Nevadans to purchase a home, I worry that rising mortgage rates will put working families even further behind.
Not really, bro. You're looking at it all wrong. Actually, bringing the home down to higher rates will actually bring the house down. They lower rates, then you can refinance at a lower rate, and you've made a home affordable. So this idea that rates are stopping people, no. That the price of the house is what is causing that. Again, whoever elected this stupid goofball, yeah, he doesn't know what he's talking about, Powell. He was all over the place. So we got Nevada. There's the other one. I'm going to write down these states.
Pandemic, it had been harder to get materials and things like that. So there's certainly a need for more housing. I think during the pandemic, you had people wanting to live in houses rather than downtown in apartments because of COVID. You had low rates, and so you had 2 or 3 years of very, very high price increases.
What you need is higher rates to kill the demand for people to purchase a home because they don't want to pay so much in interest. Then that also in turn brings down the home price. You pay a higher interest at a lower home price, you refinance a few years down the road. Like, that's how you make homes affordable if you're poor. How about you worry about trying to make people not poor? That way they can afford homes, not have to sit here and worry about interest on a home. Like, he was all over the place. That's bad. So bad.
That will begin immediately while you are still focusing on bringing inflation
back to the Fed's 2% target. Excessively high capital requirements will constrain credit provision to the economy, costing jobs, incomes, opportunities, and living standards. As my colleague Mr. Garbarino pointed out, a 1% increase in capital requirements could potentially reduce GDP by up to 16 basis points based on the Basel Committee literature. On January 21st, 2021, 30-year fixed-rate mortgages had an interest rate of 2.77%. Now, for the same loans, individuals are looking at a 6.69% interest rate for a 30-year fixed-rate mortgage. For the median home, valued at $436,800, the difference from less than 2.5 years ago to now equates to over $300,000 more over the course of the loan. For the median household making around $71,000 a year, that extra $10,000 a year out of pocket in mortgage costs is crushing. Some areas like my district are even harder hit due to the high cost of living and the lack of housing. Combine that with inflation at or above 4%, and these factors are taking a real toll on the average American family, including in the Hudson
Well,
Valley.
you got to think about who you continue to let come in here, along with the people that are already here that are multiplying, having kids and shit. There's too many people here, and yet you guys want to just bring more in. I mean, I'm all for it, but, you know, excessively high population has a toll on things like that.
Standards for Americans, and effects would begin immediately, independent of any proposed phase in timing.
I do think that, as I mentioned earlier, there is a trade-off between safety and soundness and availability of capital, and you want to get that balance right.
But respectfully, you said, you have testified that there was more than enough capital in these banks. So where are we unsafe and unsound that we would require more capital requirements?
Well, as I mentioned, that's the question we're going to be asking as we review the proposals when they do come forward. We don't have a proposal in front of us at this point, and I think as I mentioned, any increase in the capital for the large banks would need to be justified. I don't know that there will be much in the way of capital increases proposed for banks other than the very large banks, but we'll have to see.
So you don't believe regional and community banks will face the same requirements?
Very different requirements, I would think, as they do now.
But you're not looking to increase the requirements on them?
We'll have to see what the proposals turn out to be. Honestly, they're still to some extent in motion, and once they're out, we can have lots of conversations about the specifics, but until they are, it's tough to do that.
And you'll commit to providing this committee with all such analysis before any proposals come out?
I think there will be a proposal that comes to the board sometime this summer, and the board will vote on that, and we'll obviously share whatever analysis we have.
Are you concerned that any significant increase in capital could significantly jeopardize the Fed's efforts to rein in inflation?
Powell's just waiting for the pizza. He just wants the pizza. I can just tell. He's just there for the pizza. He hates this shit. Like, he knows the stupid ridiculousness that goes on. That's crazy. 30K. Do I see anything? Yeah, I see AMD. And like you said, Bitcoin going to 30. But dude, I'm not getting an AMD. I made a small scalp this morning. What I'm going to wait for is a SPY to see if it holds this level and we start going higher. Because if we don't start breaking this level, I'm gonna probably swing along, you know. But we are putting in lower highs. I'm giving the market a little bit of time. Like I said, I'm looking for Thursday. I'm looking for Thursday to be the day. But that's crazy, bro. I mean, it's not crazy. That's we expected it. Our target's 4,500, 40 grand. Wow. You could have backed that AMD short up with a long, bro, and hit them both ways. You got to start thinking like that. You know, go long what is strong and go short what's weak. That's crazy. We never got the pullback. I was wanting the pullback.
Press office, and we had newspapers. My job would be to clip out the articles and paste them on a sheet.
Like I said, I'm gonna gonna pay attention to, because
last concerts, and I was just so disappointed that I missed that concert. But was excited to see that from public reporting that you were at the most recent Dead and Company show.
yes, Powell plays the guitar and shit.
This version with John Mayer and enjoyed it, but we weren't here. How was the show? Did you like it?
No, it was terrific. What can I say? So, it was great. I've been a Grateful Dead fan for 50 years. So
I've found one universal truth. I like people who like the Grateful Dead. So having said that, I have limited time, but do you want any time to
This is another goofball.
that you had?
Another goofball.
Here so far today?
Do you want? No. What?
time to offer, but I'm fine with the answer.
Right. Right. You fucking goofball. Excuse my language. I'm sorry. I just gotta call him out.
My constituents, they're very concerned about this economy, worried about cost of
Oh, that's okay because Jerome Powell, like he says, he's got the tools to help fix that too. So we're just gonna continue this economic cycle of just one extreme to the other. Things get bad, we just cut rates. Things get really well, we jack them up.
Chair Powell said the economy is very strong.
concerned about the economy in a way that they can really understand where this economy really is heading.
So I guess I would say this economy is very strong, and what's driving it now is just a very strong labor market. There's still significant demand for workers. There are more job openings than there are unemployed people. Wages are moving up, and that's really what's driving the economy forward. People's disposable incomes are coming up. Inflation is moving down gradually. The thing that troubles people, and I think the thing that accounts for the surveys you see where despite a historically strong labor market, people are still concerned about the economy, it's really inflation. So this is our job, is to bring inflation down. The way we do it is by raising interest rates, and while that can be painful, what it does is it gradually slows down demand so that supply and demand can get back into alignment, and so that we can have inflation running at 2%, and people can get on with their lives and basically not have to think about inflation. That's what the definition of price stability from one standpoint is, just that people can live their daily lives without thinking about inflation all the time. We want to get back to that place, and we're on a journey to get there. We have quite a ways to go, but we're making progress.
And I've always wondered.
We have quite a ways to go, but we're making progress. Quite a ways to go.
Do you think that's something we could handle as a legislative body?
I wouldn't want to comment on that.
That's a safe answer. All right. And I do want to just join on the chorus with a lot of my colleagues on both sides of the aisle here about capital requirements for banks. I brought this issue up with Vice Chair Barr, with Mickey Bowman, and in your written questions for the last time you were here, I didn't get a chance to ask questions because my seniority here on the committee. But you said you answered in writing, and you said we've got to be mindful of the trade-offs associated with adjusting capital levels, as it could, quote unquote, cause banks to reduce the availability of credit or to pass higher costs of credit on to consumers, end quote. And you also said that, quote, capital and liquidity levels at our largest, most systemically important banks are at multi-decade highs, end quote. My constituents sent me here to lower costs for working families, so increasing borrowing costs really hits them hard. As the Fed considers new capital requirements, how do you intend to strike that balance between the trade-off that you talked about in your written response?
So that is the balance. You said it very well. So stronger capital requirements mean we have a stronger banking system, means it's more resilient to downturns and crises and things like that, so banks can continue to lend during even stressful times. And so that's very important, and we put a high value on that. And yet, of course, we know that at the margin, the cost of capital goes up for banks, and the cost of credit will go up. So it's a balancing thing, and there isn't any one simple model or answer. So you just have to make a judgment call based on that, and that's what we'll be doing as these proposals are made and then assessed.
Thank you. I yield back.
Thank you, Mr. Nichols. I look forward to joining you at the next concert with the chairman. We'll see how that works out. Chairman Powell, thank you very much for taking time to be with us here today. Recognize, first of all, that you get, I think, politely said, feedback from every sector on how you're doing your job. You are charged with two mandates. Primarily among those are price stability and combating unemployment. As my colleagues have discussed today, the labor market is clearly very tight, and you should be credited with succeeding in maximum employment and being a partner in this. Unfortunately, as we've also heard, and as the country is experiencing, we haven't collectively been as lucky in terms of price stability. Core CPI is still over 4%.
Look at those tails, guys. I might take a long on the SPY here.
Given the economic uncertainty on how the Fed will bring inflation to its 2% mandate, can you quickly touch on how the bank capital requirements Vice Chair Barr is proposing? And I'll be specific here. My Main Street businesses, especially farmers, family farms,
We're at 437.
Iowans back in my
Let's go, 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 go,
go,
go, go, go, go, go, go, go, go. Go, 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 go. Go, 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 go. Go, go, go. Shit.
I don't think so, particularly in the near term. So, first of all, many of those people will be dealing with regional and community banks, right, rather than with the GSIBs. But even with the GSIBs, though, as I mentioned, the phase-in for higher capital process of publishing and then getting comments and evaluating those comments and then coming to a broad agreement and consensus.
Well, I missed it. I don't know if I have to.
Over what time period that takes time, and so it will not be important during this period of the next year or two when we're getting inflation back down to target and the economy's kind of normalizing. I don't think the capital the capital changes will have much of an effect in the near term.
So, Mr. Chairman, let me ensure that I'm hearing you correctly. Then, Vice Chair Barr is engaging with small businesses throughout the Midwest right now on potential knock-on effects.
God damn it! I hope you guys got along there on the SPY.
Economic studies have found that these knock-on effects will increase borrowing between $50 and $200 billion. As we look to cut this in half, is this the right thing to be doing?
He called it out at the open.
The inflation rate.
It's just weak. I mean, you kind of just have to. It's just been weak. That's all. Look at the daily chart. What's it been doing? Look at this. You know, it's been a weak stock. Right there. Look at the volume, man. Come on. Look at that volume. That's more than just selling pressure. And it's just consistently been red. Again, all you did was fill the gap. So it's not over yet, you know. Call that AMD at open, did you? Like, did he call it out like to go long? Did he call it out to go short? I just wanted to look for this gap fill, and it looks like that's what you got, you know. I don't. Fuck. There goes the SPY. Damn it. I don't know why it didn't. This is the second time I did that to the order. Like, now it's wanting to accept it, but I just had the opportunity. There's 25 cents going by right there.
Yes, I do.
On that SPY long.
It's not an absolute thing.
No, what did he call out? Did he call out a long? Did he call out a short? It honestly, the volume was kind of low, and it just didn't. It ramped up because there's no buyers. There was no buyers that stepped in. And look, the SPY's starting to turn around now, and you're starting to see AMD start to turn around a little bit.
The existing threshold before the law was modified was $20,000. That is how far this administration wants to peek behind the curtain of what my constituents are spending their money on. And $600 in Iowa doesn't go a long way. The equivalent of a PlayStation or paying for your kids' dance classes. I'm a dad of 6. I digress on this, but I do want to know specifically, for my constituents back home, the thoughts of creating a central bank digital currency that tracks individuals. If the Fed were to offer a direct individual accounts to citizens, wouldn't this be a direct threat to the financial privacy of many Americans?
Potentially, and that's why we would not. It's not something we support. We would not support, accounts at the Federal Reserve by individuals. That would not be. If we were to, and we're a long way from this, if we were to.
Come on, give me the pullback, please. Boom, double bottom. Give me the pullback. God, I want to be long the SPY.
For exactly the reason you point out.
I'm very happy to hear that. I think that's a good partnership with the individuals there and a respect for Americans across the board. With that, I yield my time and recognize the gentlewoman from Colorado, Ms. Peterson, for 5 minutes.
Thank you, Mr. Chairman, and thank you, Chair Powell, for being with us again today. I come from Colorado. I was in the legislature for 10 years, and when the pandemic happened, I was part of being one of the, unfortunately, elected people during that time, that difficult time. When I think about what our country was going through a few years ago, where our economy was almost in free fall, completely shut down. Our local governments were, they were slashing their budgets, they were laying people off, and what that moment meant that we had to do in stepping up at the national level to infuse dollars to save our country's economy. So my frustration here is that we continue to talk about inflation as if it was spending just to spend money, instead of acknowledging the urgent crisis that this country and this world was in, and what we needed to do in the moment to make sure that we were able to recover, keep our small businesses afloat, our local governments, and ultimately recover much more quickly than others.
Why don't
So,
you know what I was thinking too? Why don't you ask him what they thought, why they called it out short as well? I'm sure he may not have known that it was going to, unless you're swinging it like, and
recovery is by far the strongest of any country. And I would say
the thing is like this, like once you have a major level like this at 115, that's why I have this thing like really thick. You see how thick it is? Because if that level breaks, then we're going to fill this gap. And that's ultimately what it comes down to, and it's been relatively weak. But again, you don't know if it's going to, curl up or whatever with the rest of the market. But again, it's overextended. The probabilities of it would be to go to the downside, and that's all it is, and that's all trading is a probability. What are the probabilities that this will happen or that will happen?
Doesn't that also include tax cuts?
Let me see.
Billions of dollars of tax cuts that we couldn't afford that went on our rising debt.
in terms of today's inflation, though, I think if you look, to your point, you look around the world, there has
I would like to know their thesis on why they called it out early. Too. That's what I was saying. I would like to know their analysis on why they would call AMD out short this morning. Because if I go,
inflation is coming down. We'll look back on this
and I don't know if that's just an expectation of Powell, but this morning you didn't have much volume at first. This is a 15-minute chart, mind you. So
It's hard to believe where we were a few years ago and where we are now.
I mean, you do have a little bit of pre-market volume, but not really. So why don't you ask them that? If your boy called out AMD short, ask him why. Why was he short? I mean, look at this volume. You know what I mean? Look at the volume here. Now, I bring up the volume because you want to know the days that it's going to have continuation. You know? Like, look at that. Look at that itty-bitty fucking volume there. You know? Look at that volume. So, I'm kind of curious on why they would, like, what makes AMD is only in play because of semiconductors, but I don't know. I like to play things like because of news or like, like Bitcoin before it's like gonna start on a whole new rally. Shit like that. I mean, they made the right decision, don't get me wrong, but it's just how do you make your mind up pre-market other than, let's see here. And pre-market did not break this double bottom that it put in yesterday, so you don't know if it's going to break. I don't know, I'm just kind of curious. Damn, that's crazy already.
So I'd like to know if we are provide these pathways looking at the needs of the
I might be looking for my long hair on the spot. It just sucks. We're going into lunchtime because volume's going to dry up. So maybe I'm going to see if we can get in here. I'm going to look and see if I can take a position, or if the market gives me a position to take VWAP long.
Thank you, Mr. Chair. Ladies, time has expired. I now recognize the gentlewoman from Texas, Ms. Dela Cruz, for 5 minutes.
I thank the chairman for holding this important hearing today. It is critical that this committee continue to explore how the Biden administration's ill-conceived policy and regulatory approaches are harming our nation's economy. And thank you, Chair Powell, for appearing before us today. I'd like to lead off with a question that I posed for Vice Chair Barr when he recently appeared before this committee. As representative for a largely rural district where my constituents, of which 86% are Hispanic, heavily rely on smaller institutions or community banking institutions for their financial needs, I am concerned about Mr. Barr's focus on factors that aren't necessarily material to the recent bank failures.
Like that tail that was off of there, if we can hold it.
Silicon Valley Bank seemed to go out of its way to advocate for higher capital levels as a cure for the recent bank failures, instead of the failures of regulators and bank mismanagement. In fact, one of your other colleagues, Federal Reserve colleagues, Governor Bowman, echoed these concerns in recent remarks when she said, "The unique nature and business models of the banks that recently failed, in my view, do not justify imposing new overly complex regulatory and supervisory expectations on a broad range of banks. If we allow this to occur, we will end up with a system of significantly fewer banks serving significantly fewer customers. Those who will likely bear the burden of this new banking system are those at the lower end of the economic spectrum, both individuals and businesses." Just a couple moments ago, Rep. Donalds asked you a couple of questions, and your response was that you mentioned how important community banks are and that you are keeping them in mind with all that you do. As I speak with my local community and regional banks, they say that the increase in regulation and in capital requirements will really hurt them. With that being said, what I find as being an outsider in politics, new to the political arena, I find that people here in Washington, people who hold leadership positions, are often out of touch. And so I want to ask you, Chair Powell, do you personally bank with a community bank?
I have over time, not currently, but yeah, the last mortgage that my family and I had was you would like the story, I can tell you someday, but we had a very large bank which sort of failed at the last minute to come through with our mortgage, and we went to the local community bank, and they knew my family, and they knew the house, and they were able to give us a mortgage without difficulty within a few days. So I have very positive experience with community banks.
So with your relationship with community banks in the past, how do you feel that increasing regulatory burdens would have consequences to these community banks?
So I really think that the things we're looking at are not about community banks. They're about the very largest banks, and to some extent, banks in the Silicon Valley Bank range is sort of $100 billion to $250 billion. So that's far larger than I would consider a community bank to be, under 50 and probably under 10 billion in assets. So those are not the focus of the regulatory reforms, I believe, that are going to be proposed to the board for consideration this summer.
And I will also hope that be true, because, as I said, in my district, we have a lot of community and regional banks, that would suffer with increased regulation and capital requirements. And so with that, I have very little time, so I will yield back to the chair. Thank you.
The gentlelady yields back. I now recognize the gentleman from California, Mr. Sherman, for 5 minutes.
I want to comment on one success story. Several years ago, there were $16 trillion of LIBOR instruments, where the amount the debtor was supposed to pay the creditor was to be determined by the London Interbank Rate. And as of June of this year, that rate will no longer be published. Something happened unusual here in Washington. A year and a half before the LIBOR hit the fan, Congress acted. You published your regulations in February, and the problem is solved. I want to pick up on the ranking member's comment that it's critical that we deal with housing. There's a lot we can do in Washington, but we also need to get cities to allow the construction of apartment buildings and condos. Someone has talked about the de-dollarization. We need to compete against the euro and against the yuan, but one place where Congress can act is with regard to crypto. The crypto billionaires have told us they want to displace the dollar. They're working for de-dollarization. And when billionaires tell you they are trying to hurt your country, you should believe them. There's been a discussion here as to whether it's the pandemic or Washington, D.C.
I'm going to make some coffee in a minute.
We have a perfect test case. Our annual inflation rate is now at 4%. The European Union, where Mr.
Good
Powell
old
is not president,
Sherman.
and Mr. Powell is not head of their Federal Reserve. The European Union is, in May, had 7.1% inflation. The unemployment rate in the United States is 3.7%. The European Union is at 6%.
Don't worry. They'll get theirs under control too. Christine, they're just behind us. That's all. They're a few rates behind us.
In the European Union, only 3.1%. I think it's pretty apparent that our policy has turned out to be actually better than Europe's policy. Banks and bank regulators have said, oh, how could we possibly have anticipated the inflation and interest rates of 2023? Today we have 4% inflation. That is almost exactly the average inflation rate over the last 50 years. Much lower than it was in the Reagan administration when we had...
He's leaving out a very important piece there. It's not so cut and dry. This is the politician for you. You got to remember, okay, this Basel III and things like that. Listen, when these governments were giving you a check, the banks, they had to make new laws because the banks could not take it because of the Dodd-Frank Act, okay, where a bank cannot get too big. So they had to make changes to the laws to accept all this capital that the government in D.C. was giving you in forms of checks, okay? And you have all that money go to the bank. And then a year and a half later, it all gets removed. That is what they're talking about. They could not forecast that. So don't listen to this little Sherman. Don't listen to the Shermanator. It ain't so cut and dry.
Why are they well capitalized? Because of our regulation. And I do want to focus on whether our banks really are well capitalized. Mr. Powell, are our banks well capitalized if you value their assets at today's fair market value, where we have experienced higher interest rates and the value of the debt declines? And are they well capitalized even if you assume that depositors are not just going to leave their money lying in the banks, but that the obligation the bank has to its depositors is valued at full face value, but
we are coming right into that zone where I wanted to be a buyer. So let's see what happens. We tried to go green. Can we hold?
Well, that's the problem. Our capital requirements are not hide the facts that are unpleasant.
Right.
If you don't hide the facts, are we well capitalized?
Traditionally, though, as you know, traditionally, rising rate environment has increased the deposit franchise, which more than or at least offsets any portfolio.
So we're well capitalized if depositors are continue to be lazy and stupid.
The gentleman's time has expired.
Yeah, just listening to you. You apparently think they're lazy and stupid, but if you try to give us an explanation of the banks not being prepared for this, no, they couldn't be prepared for that at all.
As you know, when the COVID-19 pandemic started, the Federal Reserve began a round of quantitative easing, referred to as QE4. Like many COVID policies, this program dragged on, not ending until March of 2022. To conduct this program, the Federal Reserve expanded its balance sheet with short-term interest-bearing liabilities on one side and long-term interest-bearing assets on the other. And this was at a time of historically low interest rates. When predictably, expansionary fiscal and monetary policy sent inflation to the highest level in 40 years, the Fed was forced to raise interest rates rapidly. Now, going back to one of my colleagues' questions about the bank losses and the result of that being poor management and failing to hedge against the interest rate environment, is that a fair summation that management and failure to hedge is what caused some of the bank losses?
Certainly, many banks managed the interest rate risk that came along through that technique.
But some did not, is that correct?
Some did not.
In October, the Fed suspended its remittances to the Treasury due to losses. Mercatus Center estimates that the lost revenue for the Treasury will result in $760 billion over the next 10 years. And so it does concern me that Treasury is blaming banks for mismanagement when you yourself had to stop remittances and will suffer losses. Now, when the Fed prepared its
That's the thing, too, that they're not talking about. The Fed has an assload of losses right now, but the Fed doesn't have to sell mark to market and take the loss. But if they did, the Fed is at a huge loss right now until maturity.
Or did the Fed not understand its own risk in correlation to the interest rate environment?
Well, so what we do, we remit all of our profits, right? And in the era of QE, those profits were enormous. We remitted something like $1.2 trillion in profits to the Treasury Department because,
Come on, Spy, you can hang on. It's okay. You can hang on. Just get your little support. Get your little support, put it in your pocket, and move on up.
That's what was happening in the QE era. As we now enter an era of raising rates, that'll turn around a little bit. But ultimately, though, we don't manage at all for fiscal reasons. What we're managing to is maximum employment and price stability, and we're using our tools to achieve that. So we don't think of ourselves as trying to attain some kind of fiscal goal one way or the other.
But what about as far as, I guess I'll ask this question. When you look at, the roughly $700 billion in blow to the Treasury, how's that going to impact the President and Congress's kind of economic plans and policies going forward? I mean, is it going to impact negatively?
It doesn't affect spending, right? It doesn't affect, Congress appropriates money, the executive branch spends it. It will mean that more borrowing has to take place, and that could raise rates very marginally at the margin. But that's how it would affect the budget, but it wouldn't be a major effect on the budget.
Guys, if you guys really think about this picture in a nutshell, this image to what she talks about, this picture is pretty deep. I'm telling y'all, this picture right here is pretty deep. This shit goes deep. Right here. The white man is stealing from the people, and she best friends with him.
And I have concerns. Future raises and impact.
Stop being played a fool, guys. You know what I mean?
Your average homeowner. And the people that pay that or bear the burden of that are your lower income and your middle class families.
That just, this picture speaks volumes. It really does.
Silicon Valley Bank, and which is supervised by the Fed. Again, I get back to when you look at the interest rate increases, why there was not more warning or hedging from you as the impact it may have on the fiscal system, the financial system, and the banking system, because as we well acknowledged, both sides of the aisle, that there was some poor management, but the regulators and the communication from the government was lacking. And Mr. Chairman, I am out of time. Mr. Powell, thank you for being here, and I'll yield back.
Thank you, Mr. Eagles. With that, the chair recognizes the gentleman from Massachusetts, Mr. Lynch.
Thank you, Mr. Chairman, and I thank the ranking member. Welcome, Chairman Powell. Good to see you again. Chairman Powell, I heard some of your comments the last couple of days about the Fed seeking a softening in the labor market. And as a former union president for the ironworkers, I always took a dim view of a softening of the labor market because it, reduced bargaining power and that sort of thing. But I do admit that right now, unemployment rates are historically low all across the country. I think Massachusetts, the Fed numbers at 2.8% unemployment. Arkansas, even less. Alabama, even less. So I understand the need for your position. But when you look at the Black and Latino unemployment rates in some of these major cities, they're double that. And I can't help but seeing this as an opportunity to perhaps redouble our efforts to pull workers who aren't traditionally have strong connections to the job market and make things happen. At the federal level, we fund about 25,000 job training programs. And according to the GAO, we don't do a very good job. I think the average program produces about 3 workers per year. But I am aware of the work that the Boston Fed is doing with the Gateway Cities program. Susan Collins is running that in the Boston area. And the Fed actually helps us with data and coordination, and cities like Brockton, Massachusetts, my district, but also Fitchburg and other more rural areas, the Fed comes in and actually provides a great amount of expertise and has done wonderful, wonderful work. And I'm just wondering, are there other tools in our toolbox that the Fed could use to help? You could soften the labor market by adding workers as well. And I'd rather see that on the supply side than simply restrict credit and squeeze companies into a position where they have to lay people off. And I'm just wondering if there are other tools that you think might be available to us to accomplish that.
So I'll say 2 things. First, what the softening that we've seen so far in the labor market has been around job openings declining. It has not been around unemployment increasing. We've seen some wages moderating back toward more sustainable levels. You'll remember well the labor market before the pandemic, where we had 2% inflation and a really tight labor market with no inflation, and a lot of the gains were going to people at the lower end. That's where we all want to get back to, because what we have now is a very tight labor market, but inflation is so high, it's eating up the wage gains that these people make. So we need to get away from that. In terms of other tools, I visited East Hartford, which was another one of those cities, and I agree with you. We're not spending taxpayer money on this. We don't have the authority to do it. We convene people who have private sector funds, and we focus on a city. And I was really impressed. I don't know if you sound like you visited one or more of these cities. It's amazing what you can do.
Yeah.
But as a convener, really, rather than as an agency that has the authority to spend money on people. But so we do think about these things. We think that the most important thing we need to do for working people is to get inflation back under control, because it is people at the lower end of the income spectrum who suffer most immediately and worst from high inflation.
Yeah, I just think there are deeper structural problems in the limitations within our workforce. You know, I met yesterday with IBEW Local 103 in Boston, and you know, I talked to new electrician apprentices, mostly women of color, who they're working days, their husbands are working nights, and it reflects in that very, very low unemployment number, which is, I mean, you're getting around 2%. It's really people who are in between jobs. Those are the people that are, so there's no real reservoir of unemployed workers there that you can rely on. And I do appreciate the way the Fed came in, and the Boston Fed came in and big-footed the situation in Fitchburg, where they brought a bunch of people together and they accomplished a lot without spending federal taxpayer money. So I'm going to continue to try to find ways that we could use the resources that you have available. Mr. Chairman, I yield back.
Thank you, Mr. Lynch. The chair recognizes the gentleman from Georgia, Mr. Loudermilk.
Well, thank you, Mr. Chair. Mr. Powell, good to see you again. Thank you for being back here. I want to continue a dialogue that you and I had about FedNow. And I also want to continue voicing my concern that this product is a solution to a problem that the private sector is already addressing. The RTP network is already capable of instant settlement with a much greater degree of connectivity than FedNow will have at launch next month or in years to come. And my concern is also that the Fed has an undeniable advantage over the private sector in the payment space, as it can clear transactions through Fed master accounts. Furthermore, the Fed already has options to improve transaction speeds through existing services. For example, the Fed has discussed extending the operation hours for the National Settlement Service since 2015. So first question is, why not respond to industry demand by improving existing services instead of launching a new one that can compete with private industry?
Well, we, as you may remember, we surveyed all of the banks, not just the large banks who stood up RTP, which was a very positive development that we supported. And overwhelmingly, the smaller banks wanted us to set up FedNow. This was a very overwhelming view among smaller banks. They wanted a Fed alternative to RTP. So we set it up, and I would agree with you. That does not a reason not to work on the efficiency of our other payment services, and I hope we're doing that. I mean, I know we're doing that.
So we had also discussed in the past about setting up some guardrails to protect customers from accidental or fraudulent transactions. And we know that's a big issue across the entire financial services sector. And in response to that, you know that the banks already have procedures for customers to report unintentional transactions, and FedNow will come up with a suite of features as well to help institutions investigate and remedy any unintentional or fraudulent transactions. However, with real-time settlements, this becomes a whole lot more difficult than just debiting the account that received funds by mistake. Can you elaborate on how you're going to handle this protection?
Yes, and of course RTP faces the exact same issues. I mean, it's a problem with real-time payments. You just have to have very high, extra high levels of security around the payments, who the payee is, and that sort of thing. And we do think we can master that and build that in, as any faster payment.
Do you have any ideas of the direction that you're looking to go? How are you going to be able to resolve those? Or is this just something you're beginning to look into?
No, I think we've built very strong safeguards in. I can't give you the technology answer,
okay,
but we'll be happy to supply that.
Yeah, if you could supply that, I appreciate it. Just a couple other questions. Will the Federal Reserve itself use FedNow for real-time payments between banks and in the system?
I'm sorry, will it?
Are you going to use the FedNow for real-time payments between banks within the system?
Yes, I mean, that's what it's for. It's supposed. Right. It's an interbank payment system that allows banks to offer real-time payments to their customers.
Okay, so with that, I'm going to divert just a little bit. I've dealt with in the past at state level with government competing with private industry, and we run into this problem where the government has an undeniable advantage. In this case, it had to deal with internet services, where city governments had gotten involved in internet servicing. and started competing against private providers. And the issue came that the city governments were undercutting the private providers because of the poll access fee. So we passed legislation in the state of Georgia that required that any municipal government that provides a service that competes with private industry has to assess themselves the same fees. So with that in mind, will transactions between Federal Reserve banks be subject to the same rules and fees as other banks? Are you going to charge yourself the same fees that the private industry and abide by the same rules as the private industry?
I don't know the answer to that. I will say I wouldn't advocate, in the payment space, there are many, many instances of a government-operated payment system operating side by side with a private sector one. It was not something I would advocate broadly for in the economy. You think about ACH, you think about Fedwire, there are private sector and public sector payment utilities operating next to each other in the United States and around the world.
Okay. Thank you. My time's expired. I yield back.
Gentleman yields back. The gentleman from California, Mr. Vargas, is now recognized for 5 minutes.
Well, thank you very much, Madam Chair. I appreciate the opportunity. I want to thank the ranking member, too. Thank you. Mr. Chairman, I've always had great confidence in you. I told you that personally. Now that you're a deadhead, though, I'm not quite sure. Especially after 50 years. But anyway, again, thank you very much for being here. I appreciate the service you've done for our nation. One of my colleagues was talking about the difference in inflation rates in the United States and Europe, on both sides, actually. One of my colleagues on our side talked about that. And I was wondering if you saw the headline today in the New York Times about the UK inflation rate. And you saw that they're running, I think, at 8-something%.
Yes, I did see that.
Yeah. And you were asked a question by a gentleman on the other side of the aisle that when the Biden administration took over, what you could buy for $1 now cost $1.16, and that was hurting consumers. And you said, and I want to quote you, "I strongly agree." But the question obviously inferred that inflation was the fault of the Biden administration. I mean, that's the whole point of the question.
That wasn't the question I answered, by the way.
That's right. And I was going to say that, I'll give you an opportunity to answer that, because you later said that the pandemic was the issue all around the world. So is the Biden administration the cause of all this inflation?
So just to be clear, the question I answered was, is inflation hurting people? It was nothing to do with the cause of the inflation. And
but it's inferred, Mr. Chairman, when you say that this has happened during the time of the Biden administration. I think the question clearly infers that.
I think you understand the question I was really answering. So I guess I would say again, people are going to be unpacking the causes of this inflation. Many academic careers will be built on new ways to look at this. Former Chairman Bernanke delivered a paper with a colleague just a couple of weeks ago at Brookings on this. And I just think you see inflation everywhere in the world. There's a common factor here, which has to do with the pandemic. There's also a room for fiscal policy. There's a room for monetary policy in the explanation. And I just think it's very hard to unpack that. And it's not up to us to make a judgment about, we don't render judgment on fiscal policy. We don't support it. We don't criticize it. We take it as something that arrives at our front door. No matter who is president, no matter what fiscal policy is, it's not something we play a role in commenting on or criticizing or praising.
I wanted to give you an opportunity. I appreciate the answer. I wanted to give you an opportunity just to make sure if there was any confusion about that, the confusion was cleared up, and I think you've cleared it up. Now, I want to answer a question that you didn't answer, that you passed on. The question was if Congress should be in charge of setting the federal rates fund. I can't think of a worse idea. The only worse idea, I think, might be another idea that was set forward earlier, that maybe we should be involved in supervising the banks, Congress. We can't even figure out appliances here, for God's sakes. We closed down the government over appliances. We can't even figure that out. I don't know how in the world we'd be setting rates and how in the world we'd be supervising banks. Again, I think you guys can do a tighter job of supervising banks. I mean, I do think that and you guys have admitted to that with the Silicon Valley Bank, and I hope you do, and I know you're looking at these regulations. It was brought up that since 2008, 2009, the capital requirements have gone up, and the banks generally have done well in the stress test. What was the law that caused the capital requirements to go up?
It was a combination of Dodd-Frank and also the Basel Committee.
Of course.
Agreements.
And those are the two things that I've heard from colleagues on the other side. They just keep beating up. Now they don't do it as much, but when I first got here, now that's the CFPB. But that was the choir again, once again, just saying it's the terrible banking. But the reality is it probably saved banking in the United States, and I appreciate it. Lastly, I would just comment this, and you don't have to comment. I'm just going to make this comment. Obviously, your focus is narrow and should be. But the notion of climate change is important. I do think that it's affecting the economy. I do think that it's affecting our world, and I do think that we've had our head in the sand for way too long on this issue, and we have to do something about it. Obviously, that's not your mandate, but obviously it's important. I hope we do something about it. We don't have the courage to do that in Congress. And that's why I think others are doing it for us, but we have to do something. We see the bigger hurricanes. We see these things happening, and it's because of our participation in making it happen. Thank you very much.
Gentleman, time's expired. The chair now recognizes the gentleman from Oklahoma, Mr. Lucas, for 5 minutes.
Thank you, Madam Chair. And Mr. Chairman, it's good to see you as always.
You as well.
Many of my colleagues today, of course, have expressed their concerns about the upcoming Basel III revisions, and I hope you'll continue this dialogue with the committee once the joint rule is proposed and open for public comment. I'd like to follow up with a topic we discussed back in March. I'm sure you're keenly aware of how important it is for banks and companies to manage interest rate risk. Participating during the last several years, the Silicon Valley Bank made that very clear. Could you speak generally to how hedging interest rate risk is an important risk management tool for U.S. banks and companies?
I think you see the reality of it here. When rates go up, banks are encouraged by their supervisors and their own internal personnel and risk committees that they need to manage that risk. And most U.S. banks did a good or adequate job of that, I would say. But it's a fundamental risk of banking, one of the most basic risks along with credit risk.
Exactly. And on that point, I've heard concerns that the Fed's Basel III revisions could increase costs for derivatives end users, whether hedging interest rate risk or commodity price risk. I'm optimistic that these concerns will be addressed. Having said that, these revisions to capital requirements do not exist in a vacuum. The SEC is proposing major changes of their own. Last week, I asked Secretary Yellen if Treasury is coordinating with the Fed and SEC on economic analysis necessary to understand the potential consequences of U.S. banks implementing both significant market structure changes and increased capital requirements associated with market activities. The Secretary responded that the Fed is, in fact, coordinating with Treasury on this analysis. Are you aware of this coordination, and have you personally been a part of these conversations?
I have not been a part of those conversations, but I do understand that that's correct.
Okay. Chairman Powell, I'd like to follow up with you on your conversation with Congressman Gonzalez from earlier today. You have assured this committee that the Fed is not a climate policymaker, and I appreciate your commitment to this. However, I'm concerned that the Fed's regulatory toolkit would be utilized in a way that would, in effect, require the Federal Reserve to make policy decisions on climate change. We've seen other U.S. financial regulators embark on significant climate rulemaking, such as the SEC. Chairman Powell, are there principles you keep in mind when ensuring that the Fed doesn't give in to, shall we say, political pressure around things like climate change?
There are, and for starter, one would be that we don't see it as at all appropriate for us to tell banks what legal businesses they can lend to. That's not our role. We don't allocate credit. So what we do is we supervise banks to make sure that they understand and can manage the risks that they're running. And we're thinking of that as our point of contact with climate change in the sense that it's another risk that over time banks need to be able to analyze and assess. So, but fundamentally, though, as I mentioned earlier, Climate change is going to be a very important issue for a long time, and it needs to be addressed principally by, by elected people, because it has enormous distributive consequences, and and we don't have a mandate to deal directly with climate change as a policymaker. It does arise in connection with bank supervision, but that's not the heart of bank supervision. That's just a small part.
I very much appreciate those comments, Chairman. On another topic, I'd like to discuss the Fed's balance sheet, which currently stands at around $8.5 trillion. As you know, the size of the balance sheet more than doubled as the Fed worked diligently to stabilize markets during the height of the pandemic. Now, as the Fed begins to reduce the balance sheet, could you explain this process and describe the levels of securities that the Fed would look to maintain in the long term?
So the way the process works is securities mature, and they roll off our balance sheet. And that's the way it works. And there's a cap for MBS, mortgage-backed securities, and also for treasuries, so it doesn't get too large. And if you hit that cap month upon month, it works out to roughly a little less than $1 trillion a year in shrinkage, which is a whole lot faster than what we did in the last cycle. But then again, the balance sheet is that much bigger. In terms of the level, we're thinking about a level that will allow us to operate our abundant reserves regime with enough of a buffer on top of it so that reserves won't accidentally become scarce. I can follow up more with you on this.
Thank you. My time has expired, Madam Chair.
Gentleman yields back. The gentlewoman from Ohio, Ms. Beatty, is now recognized for 5 minutes.
Thank you, Madam Chair. Thank you, Chair Powell, for being here today. I have 2 questions I'm going to try to quickly get through. The first question on the U.S. dollar dominance is kind of a follow-up to Congressman Torres's question. Chair Powell, in the National Security Subcommittee, which I'm the ranking of, we've been discussing the importance of preserving the U.S. dollar's status as a global reserve country. Can you share with us the current status of dollar dominance as it stands today, and whether there are risks to the strength of the U.S. dollar in the international financial system? And if so, what are some of the risks?
So the U.S. dollar is still the dominant reserve currency in the world, and that is principally thought to be as a result of our liquid capital markets, the rule of law, strong democratic institutions, price stability over the years, critically open. Money can come in and out of the United States without all sorts of legal restrictions and things like. All of those things are necessary to provide the world's reserve currency. We have them. There's not another economy that does have all of those features. So as long as we are a country of rule of law and relative price stability and strong democratic institutions and open capital accounts, we can continue to be the world's reserve currency. History shows that this is not a permanent status, but it is a lasting one. And I think in the case of the United States, as long as we maintain those characteristics of our government and our country, then we can continue to be the world's reserve currency.
Okay, thank you. Let me go to another question that will not be foreign to you. You know, as the former chair of diversity and inclusion, I asked you and others of your colleagues, and let me just say for the record, Madam Chair, that Chair Powell was always on point, went out of his way, in my opinion, to make sure that there was fairness and equity for all people. In light of that, I'd like to follow up with Congresswoman Waters' comments, and maybe Congresswoman Velasquez, maybe what she was talking about. Several of our colleagues here in the Senate, the person who preceded you, it had been stated by many of us that we thought through banking deregulations, he was enabling risky banking practices and failing to combat lending discrimination, which for some thought it might have perpetuated racial inequities. A few weeks ago, Chairman Powell, on June the 7th, to quote, you said that we understand at the Feds that our actions affect communities, families, and businesses across the country. And everything we do at the Fed is in the service to our public mission. So could you maybe elaborate, or the time ran out with Congresswoman Waters on, is there anything you'd like to share with us that you do at the feds that would dispel that there are things that you're not looking at that causes one or members of Congress to think that it is perpetuating racial inequities?
Well, as you know, we do consider, we call out disparate economic characteristics of different demographic groups, including by race, and we want those facts to remain present in the room as we're making our decisions. We try to think of maximum employment we do think of it as a broad and inclusive goal, meaning we're not just looking at the aggregate level. I think it's important to keep those facts in your head as you think about monetary policy. I will say, though, that we have one federal funds rate, and we don't really have tools that address distribution and historical inequities and things like that. Really, the Fed is not an agency that has those things. The best thing we can do for everybody, including in particular low and moderate income communities, is to maintain price stability and over a long period of time, and on top of that, a very, very strong labor market. Those strong labor market conditions are the single biggest contribution we can make on this area.
Thank you, and let me end by saying I appreciate your comments that you said you realize that high inflation imposes hardships as it erodes purchasing powers for food and housing from the least of us. Thank you so much for being sensitive to everyone.
Gentlelady's time's expired. Chair now recognizes the gentleman from Michigan, Mr. Huizenga, for 5 minutes.
Thank you, Madam Chair, and Chair Powell, good to see you again. I wanted to follow up on an exchange that we had back in March, this past March, where we were discussing the parameters highlighted in the Federal Reserve Board's legal opinions that outlined how asset managers can operate without being deemed, quote, in control of a regular bank or a bank holding company. Letters from the Fed's legal division also include certain commitments made by these asset managers to ensure the same result. However, it's no secret that this percentage of ownership held by asset managers will constantly fluctuate as shares are purchased and sold on a daily basis. With the ever-changing ownership structure, someone must ensure asset managers are complying with not only these opinion letters, your opinion letters, prepared by your own staff, but also with the statutory and regulatory framework that the letters outline. So, Chair Powell, I'd like to ask you again, is the Fed taking any steps to assess or monitor whether Vanguard, BlackRock, and others are complying with these commitments made in November of 2019 and December of 2020, respectively? Is that ongoing?
Can you give me 1 second?
Okay.
Sorry, that's a very specific question. I didn't know the answer, but so I would say this: we're broadly monitoring the situation. I don't know that we have a particular focus on the asset managers.
Okay. Well, those were opinion letters put out by your folks, outlining very specific things that could or could not happen. And back in March, when I brought this up, and now again today, I'm looking to find out who's actually minding the store on that. And so it's a little concerning that we don't have an answer on that. I guess we'll continue this conversation, and maybe you can answer this: what division at the Fed is responsible for reviewing and monitoring an asset manager's compliance with these opinion letters issued by the board's legal division?
So it would be the General Counsel's office. We don't have any reason to think that they're not in compliance, by the way.
But nobody's checking.
Well, we'll check, but
okay.
I think we know what we're going to find.
I'd like to know what you're going to find, not what you think you're going to find on that. So thank you. I'll be following up with a letter to include some more detailed questions on the topic, and I assume you will commit to getting us a timely answer into that.
I think we offered your staff a briefing on this, by the way.
Yes, and there was a briefing, and let me be clear. appreciate the cooperation that has happened. We've also had some other briefings. There's been a number of briefings that we've requested, and frankly, your division of government has been more helpful than others, shall we say. So I'm going to quickly pivot to a committee's investigation of the SVB, the Silicon Valley Bank failure. Your staff has been working to get us some answers on our outstanding questions. You did your own report. Now it's our turn. And can you appreciate that our committee is conducting its own independent review of what happened in March?
Yeah, very much so.
Okay, thank you. Will you commit to producing the interview notes and allow us access to the staff who participated in the interviews conducted for the Fed's own internal review of the bank supervision report?
I'm not in the middle of that discussion. I don't know where that stands, so I don't want to make commitments that I can't back up. So I'll be happy to understand where that discussion is and try to work with you.
We're going to be following up for sure on that. When Vice Chair Barr concluded that a, quote, culture shift, his words, happened, do you know if the Fed officials spoke with examiners of other banks, or was this conclusion made solely after the review of SVB? In other words, did they find some systemic problem throughout the Fed?
The thing is, I didn't play any role by design in the preparation of the report, and I'm reluctant. I think I know the answer, but I don't want to guess. So we can give you a 100% clear answer on that, but I'd rather not speculate.
All right. Well, along with the FDIC and Department of Treasury, you invoked the systemic risk exemption, the SRE, for both Silicon Valley and Signature Bank, guaranteeing all depositors would be made whole. For example, regulators could have used orderly liquidation authority, the very tool Dodd-Frank was intended to resolve the, quote, too big to fail institutions while protecting taxpayers. Why was the decision to use SRE made, and do you think that we've now lowered the bar to use SRE in future bank failures?
I hope we don't have to face that question again.
We all do.
As long as I live.
But has a new bar been set?
I would
No
say
pun
this,
intended.
though this happened with no warning on in the middle of the night, Thursday night, and less than 12 hours later, we're on the phone with the FDIC, and they're deciding to close the institution and to haircut uninsured depositors. So it was an emergency situation over that weekend. We could see that there was an electronic run building up, and we did what we had to do to address that, and I think successfully.
Gentleman's time has expired. Chair now recognizes the gentleman from Illinois, Mr. Foster, for 5 minutes.
Thank you, Madam Chair, and to Mr. Powell for appearing. Now, wars have historically been associated with elevated levels of inflation worldwide, although the relationship is complicated and wars can have impacts on both supply and demand. Higher inflation may just be one of the many prices that the humanity pays for the decision to go to war. Now, we don't have boots on the ground, but there's no doubt that in terms of supply disruption and military spending, both Europe and the U.S. are effectively at war in support of the freedom of the people of Ukraine. So my question is the 2% inflation target a realistic and appropriate goal during a time when much of the world is effectively at war? Or should the 2% goal be thought of as a goal for normal times, with policies being put in place that will return to 2% when the war is over, or at least when we've decoupled adequately from the Russian economy?
2% is our goal, and it will remain our goal. It's a medium-term goal, so we're using our tools to get the inflation level back down to 2%. We're not considering changing it because of the war in Ukraine, and I don't know that that's playing a particularly important role in inflation today, although when energy prices and commodity prices went up at the beginning of the war, it certainly was.
Yeah, well, and certainly it's an important factor for Europe still.
Yes.
The disruption particularly. Well, just more generally, you have been trying to deal with this question of how you balance your dual mandate. And so whenever you're trying to optimize simultaneously two different things, the first step is to put them into common units. And so just to be specific here, let's say that you're missing your unemployment goal by 1% and you're missing your inflation goal by 1% in the opposite direction. At some point, do those two cancel? Is 1% in one goal equivalent to 1% in the other, or do you need a 2% missing of the unemployment target? how does you know, what are the, I guess this must be implicitly, there must be that coefficient there in the Taylor rule and things like this that try to predict your behavior. But what internally, how do you view the difference between a 1% unemployment missing of the target versus a 1% of inflation?
The Taylor rule is a pretty good place to start there. Same coefficient on both
Now,
variables.
is that really true? I don't know. I'd have to go look at it.
In the original Taylor rule.
Okay.
But,
because it's not it's a coincidence if the coefficient is 1. Because you could choose a quarterly inflation target or an annual or a decadal inflation target numerically and get very different numbers. So
it's also, there's a significant amount of research about, you know, the relative social costs of inflation and unemployment, and you wouldn't want to ignore that research either. So I think there'll be a lot of judgment in this. At the current moment, it's not a question because we're obviously the labor market is extraordinarily strong, and we're very far from our inflation target. So we don't have
you're
that
getting
conflict.
complaints from business that the labor market may be too tight. At least it's viewed from the Taylor rule point of view, that there is a penalty that you pay when the unemployment gets too small. There is a target you're trying to hit.
But both
Okay,
sides
both
are calling
right.
for tight policy, though.
Yes, that is correct at present. But there, you can certainly foresee times when they will be in tension, and they historically have been. And so you're saying that pretty much it's a 1% on both. That you
I think that's a starting place. I think it doesn't lend itself to that level of precision.
Yeah, well, it's either that or you have to face questions like you've been facing for the last decade. and just how do you balance this? Let's see, in terms of the internet or electronic runs on banks, it seems like that's a new thing that's going to have to inform bank capital and liquidity providers. The first question is, if you get a significant electronic run on a significant sized bank, is there anyone but the Federal Reserve that can provide that emergency assistance? Or do you pretty much have to be the only line of defense against the big internet runs?
Well, I think regulation and supervision can play a role in that as well. And
that's in stopping the run from starting, right? But
yes.
But part of that stopping the run from starting is knowing that if it starts, that there is someone or some entity that can stop it.
We're the lender of last resort, and that is something that only the central bank can be or do. But I would say changes to regulation to assure that you don't have this mismatch between runnable liabilities and available cash to fund their running. That's something we can address and will address through regulation and supervision.
Thank you. Yield back.
Gentleman's time has expired, and the chair now recognizes herself for 5 minutes for questioning. Welcome, Chairman Powell. I'm going to start asking about the FOMC, the Federal Open Market Committee's latest forecast. It predicted that core inflation will fall below 3% within a year. This forecast has been the exact same for each Fed meeting over the past 2 years and has been wrong each and every time. Why do FOMC participants continue to make the same forecast, sir, and what data are they reviewing to make this forecast?
In the world of economic forecasting, we don't really have any advantage over private sector forecasters who've been at this. There's a number of private sector forecasters that are well-resourced, and the data are all public. We don't have private data. That's not how this works. And I think essentially all forecasters have made the same mistake, which is at the beginning thinking that the supply chain problems would be resolved quickly and workers would come back to work quickly and things like that. It's just been, inflation has consistently surprised us and essentially all other forecasters by being more persistent than expected. And I think we've come to expect that and expect it to be more persistent.
It just seems that we moved way past the whole transitory thing, and for 2 full years now, they've been saying it's going to be under 3%, and clearly they've missed that. So it was just a little concerning to me if there was something that we're missing. Let me move on. In your press conference last week, sir, you stated that, and I quote, "The conditions we need to see in place to get inflation down are coming into place." what conditions are you seeing that show that we're moving in the right direction? Because I can tell you, my constituents are still feeling great pain of this inflation that continues to persist.
So there's underlying conditions that I'll mention, but the point is you get them in place, and then the process of inflation moving down will take a significant amount of time. And we've been consistent in saying that. And the conditions I mentioned would be, first, we need economic growth to be slower than, to be modest, and it has been at modest levels, so that's happening. Secondly, we need the supply chain bottlenecks to go away and get better and improve. And thirdly, we need the sort of mismatch between demand and supply in the labor market to diminish. And that has been happening. So all of those things are happening much later and much more slowly than we would hope. And my committee and I do believe that the process of bringing inflation down is going to be a relatively lengthy one, longer than we expect.
Well, it's clear that the spending on consumer services, for example, a car oil change, a haircut, or a concert ticket, remain almost unresponsive to rate hikes. Do you have a projection for when we might see this spending go down?
So non-housing services, the broad service sector is
Right.
famously less responsive to and less focused on rate hikes and the cost of capital. So what we think, and that's about half of core inflation, a little bit more than. So we think, and I think broadly, this is what forecasters think, is that it will take some softening in labor market conditions, because in that service sector, it's very labor intensive. By far the largest cost for most service companies is labor. So what you want to see is rebalancing so that demand for labor and supply, a lot of that can happen through fewer job openings and things like that, and we do see it happening.
The Consumer Price Index, or CPI, which measures the price of everything from groceries to cars to rent, has in fact declined from its peak. But this personal consumption expenditures, this is the PCE index, which measures, as we were talking about, consumer spending, remains historically high. How else can you account for this difference when it comes to a rate hike pause?
Well, we never used the word pause, and I wouldn't use it here today. What we did was we agreed to maintain the rate at that meeting. Almost every single of the 16 of the 18 participants on the FOMC wrote down that they do believe it'll be appropriate to raise rates, and a big
Yes.
majority believes raise rates twice this year. And I think that's a pretty good guess of what will happen if the economy performs about as expected.
Yeah, I think you're right. More rate hikes likely are needed to bring inflation back down to the 2%. And, we're concerned about a hard landing, about recession. So anyway, my time has expired. And I now recognize a gentleman from Illinois, Mr. Caston, for 5 minutes.
Thank you, Madam Chair. Thank you, Chair Powell, for being here. So in June of 2021 at the Green Swan Conference, you said, climate change poses profound challenges for the global economy and the financial system. In October of 2021, FSOC's report on climate-related financial risk for the first time identified climate change as an emerging threat to U.S. financial stability. And in December of last year, the Fed released climate supervisory principles for large banks that said, quote, "The financial impacts that result from the economic impacts of climate change and the transition to a lower carbon economy pose an emerging risk to the safety and soundness of financial institutions and the financial stability of the United States." You've made many comments today that I think are broadly consistent with that in your role, and I appreciate the comments you've made in that capacity. Can I safely conclude that in June of 2023, 6 months after that release, that the Fed's position is still that climate change presents a risk to the global economy and the financial system?
Yes, I mean, I hasten to add, though, that our role in this is an important but quite small one around bank regulation.
Understood, and I'm not asking for the role, I just want to clarify that. The reason I asked that question is because on May 11th, your colleague Christopher Waller at a speech in Spain said, quote, "Climate change does not pose a serious risk to the safety and soundness of large banks or the financial stability of the United States." and went on to say that the risks posed by climate change are not sufficiently unique or material to merit special treatment relative to others. Should we understand as we sit here that Mr. Waller was speaking in his personal capacity and not as a designee of the Fed, if indeed Fed policy hasn't changed since December of '22?
So I don't comment on what any the things that my colleagues say.
So I understand, but you understand the concern that if markets and regulators are to understand that the Fed has a consistent policy, and one of the members of the Fed is saying something that appears to be directly opposed to Fed policy from 6 months earlier, that's a concern.
Again, it's governors have always had the ability, and Reserve Bank presidents as well, the ability to have their own views on things, and that's going to happen, and that's probably a good thing that we have a diversity of perspectives. I think there may be less in that difference than you suggest. I mean, what I'm saying is that banks, to the extent we have a role, it is to assure that banks understand and can manage the risks that they do face from climate change.
Okay. Well, I don't want to create internal tension, but I think we're all aware that you, above anyone, is aware that your words are closely scrutinized, and we were concerned with the words of your colleagues there. Madam Chair, I'd like to introduce for the record a working paper from the European Central Bank, The Impact of Global Warming on Inflation. I don't know if you saw this report that just came out recently, but it says, among other things, that climate change poses risk to price stability by having an upward effect on inflation, both food prices and headline inflation. And what I wonder, without opining on their math, if in fact we are looking at a world where climate change, per the European Central Bank, is going to increase inflation, and we were to find ourselves in that world going forward, would the Fed or other central regulators say we have tools to address this, or are we going to say, well, that's non-core inflation, what are we going to do in hindsight? Because it feels to me like we've got a major bank regulator saying climate change is running the risk of inflation, but I don't even know what tool you would use to address that.
I can just say, for now, this doesn't enter my thinking in any way that we would, in the near term, change our inflation goal because of climate change or the need to deal with it. There's a lot of thinking and research that over a long period of time, really the process of investing very large amounts of money in a green transition could drive inflation up, but that's not something we're thinking about today. We are not, during our FOMC meetings, we are not thinking about climate change as something that's relevant to the current inflation or to current monetary policy, and that is very much our focus today, is inflation today.
Yeah, and I guess what I'm struggling with is that if we agree that this is a systemic risk, if we agree that this leads to inflation, and we don't really know what role you'd have with tools, there's a concern there. Last thing I just want to end with, in April of '23, the report on SVB, one of the lessons that was noted in the Fed review said that this is an opportunity for regulators and bank managers to be more willing to adopt a precautionary perspective, and that the Fed must strengthen its supervision based on what we've learned. I'm trying to figure out with climate change, if we agree that this is a forward risk, how do we get the Fed the tools to apply a precautionary perspective?
The gentleman's time has expired. The chairman can submit an answer in writing to the record. And I now recognize myself for 5 minutes. Chairman Powell, in March, you confirmed to me that the Federal Reserve is a consensus organization built on garnering broad support before agreeing to any proposal. And given the breadth and scope of the potential changes to the capital framework that is under review right now, that consensus-driven approach seems to be all the more important. I am concerned that the Vice Chairman for Supervision is seemingly been given far too much latitude to act unilaterally, and especially in light of Section 1107A1 of the Dodd-Frank Act, which provides the Vice Chairman for Supervision authority only to develop recommendations for the board and oversee supervision and regulation. Can you speak to the process that's underway? Is the Vice Chairman acting unilaterally, or is that a wrong characterization? And if so, if it's just a recommendation, can you walk through the steps that the board will take from recommendation to a vote?
Sure. So I think what you see is very much the way the statute works, which is the Vice Chair for Supervision has the responsibility and the obligation to develop regulatory proposals for the board that will be considered by the full board. He's, as I mentioned before in another context, he's not the comptroller of the currency. He brings proposals to the board, and the board votes by majority vote to support them or not, and that's how that works. In terms of supervision,
is he including other members of the board currently as he's?
So I think all of us have been getting briefings on what's developed, but ultimately the job is to present something to the board for consideration by the board.
And how long will that, once he presents his recommendations, how long will there be debate, deliberation, and is that transparent for the public?
There will be a meeting, it could be a virtual meeting this summer to vote on these things. In the meantime, there's a lot of conversation going back and forth now, and we're sort of in that process now, but things are still moving around.
Our concern, Mr. Chairman, is that it seems like right now the vice chairman is writing personalized assessments of bank failures and results of new Fed climate scenario experiments without a whole lot of collaboration with other governors. And so, given that this new scheme could raise capital requirements by as much as 20% in an already well-capitalized banking system, and that the cost of such changes could be $100 billion or more in lost GDP, I am concerned with your testimony that this would only be a virtual vote. Shouldn't this be a more transparent public board meeting and a deliberative process that includes all members of the board?
It's really just a question of calendars and when will people be. It's the summer, and but that's something we haven't decided what form the meeting would take. Would it be virtual?
Well, given that it's a pretty big decision, and that the law requires the full board to make this decision and not one board member to act unilaterally, we would hope that the Fed would hold public meetings on the new proposal. Will you and the Federal Reserve Board commit also, when the proposal is voted on, to also include your economic analysis that would justify whatever capital changes are made in a quantitative form?
I don't know that. I'm not sure we'll have exactly what you're looking for, but we'll create a public record that supports the proposal, whatever it turns out to be, and the votes will be what they are, and it'll be subject to public comment and analysis, no doubt.
Well, in order for the notice and comment period to be meaningful, I think market participants will need to understand on a quantitative basis what the justification is for additional capital requirements, if in fact that's what the proposal is, given the fact that we already have a very well-capitalized system. I don't have much time left, but will you also commit to proposing appropriately tailored regulatory requirements based on the complexity and size of the financial institution?
So I will commit to supporting that. I can't commit to what the final product will be or what the vote will be, but as I mentioned at the outset, I do think we benefit hugely from a very diverse banking system, and I wouldn't want to do anything to jeopardize that.
Finally, earlier this week, the Wall Street Journal published an article that stated that, unlike your predecessors, you have not focused on fiscal responsibility. Would you like to correct the record regarding that?
I would, thank you very much. So it was just an op-ed, but it was factually incorrect. I mean, there are countless times, and you've heard me do this, I've said the same thing that my predecessors have said, which is that the United States federal budget is on an unsustainable path, which means that the debt is growing faster than the economy, and that we're going to need to fix this, and sooner is better than later.
Time has expired. Thank you. And the gentleman from New Jersey, Mr. Gottheimer, is now recognized.
Thank you, Mr. Chairman. Thank you for being here today, Chairman Powell. I'm particularly concerned that the current regulatory environment disadvantages small and regional banks. Specifically with First Republic's receivership, I'm concerned that the largest banks were given preference in the bidding process, just enabling the larger banks to grow even bigger. My understanding is that certain regional banks were unable to bid on First Republic because of an extensive and time-consuming vetting process put in place by regulators that put them at a disadvantage in the bidding process. Mr. Chairman, are you aware of a regulator-mandated pre-approval process that banks must complete to bid on firms going into receivership? And is there a notification process for informing banks that they can go through this process? Because I'm concerned that some who wanted to bid on First Republic were unable to.
So this is entirely something within the jurisdiction of the FDIC. We play an important role here, but when it comes down to selling a closed institution, that's just something the FDIC does according to their own procedures. To my knowledge, there were a bunch of regional banks involved in bidding for First Republic.
Do you know if, to your knowledge, if any were said they could not participate, or your understanding was that anybody
Honestly,
could
I don't.
participate?
I'm not aware of any, but I wouldn't be. That really is a question for, that's the heart of what they do. They have the lore, they have the people who have the experience and everything.
Thank you. Small and medium banks hold a large portion, as you know, of our country's commercial real estate loans. The Federal Reserve's May financial stability report stated that the higher interest rates may be increasing the risk that commercial borrowers are not able to refinance their loans, and that a correction in property values could lead to losses by banks that hold commercial real estate debt. I'm particularly concerned that such a correction threatens the stability of lenders and thousands of jobs in my district in northern New Jersey. How's the Fed looking at this and helping small, medium, and regional banks manage their portfolios or think about the risks of commercial real estate loans, and what guidance is being provided to banks given that nearly $1.4 trillion in commercial mortgages are set to mature in the next 2 years?
So following it very, very closely, and I think you've put your finger on it, this is a problem more for smaller banks, and not for all smaller banks, but it's the banks that have high concentrations. There will be losses, particularly in the office and in some of the mall sectors. And what we can do, there's a supervisory playbook, and so the supervisors are in there, and they're working with the company to help it preserve capital and do the right things to get through what may be a difficult time for some banks that have a high concentration.
Thank you so much. As was discussed today, there's concerns, obviously, that banks may be tightening their lending process and processes and tightening what's available. Are you concerned that higher rates and the recent instability in the banking system will lead to a credit crunch that can make it harder for small businesses to finance their operations and potentially lead to rolling blackout of loan defaults across industries?
So we're watching that very carefully. Bank credit conditions have been tightening for a year, and that's partly as a result of our rate increases. We're very alert to the possibility that the sort of shocks that happened in March might exacerbate that. We don't see a lot of evidence yet on that, but we wouldn't have expected to. So it's something we're going to continue to monitor carefully.
Are you concerned at all about the non-banks and what the crunch that could happen on that side?
Yes, I mean, the banks are obviously highly regulated and have capital and that kind of thing, and some of the non-bank lenders are in a very different place, and so, but we don't regulate and supervise them, and so it's something we're watching.
How do you think we as Congress should be looking at the non-banks? Is there any recommendations?
Where there is same activity, there really ought to be same regulation. You shouldn't be able to conduct the same activity. We regulate these things for a reason, and if we're not regulating them appropriately, then that should be changed. But if you can just go across the street and start a business that does the same thing without the regulation, then that's not going to be effective or fair.
With Basel III conversations up and running and obviously driving towards some conclusions, it appears, or recommendations, is that something that you've been watching? Obviously, you have Fed representation there. What are your largest concerns in terms of requirements and how you're thinking through that right now?
So I think these are going to be very important. A number of very important proposals are coming, and I mean, I would just put out a couple principles, and that is, our banks are strong and they're well capitalized. I think that's pretty broadly agreed, and I think we're going to want to understand how even higher capital is justified. There'll need to be a case made for that. Almost as important as that, or maybe more important, is that we need to respect the diversity of institutions that we have in this country. And I mean, we benefit from having banks of all different shapes and sizes, and we don't want to push regulation or capital, for that matter, to a place where only the biggest banks have a viable banking model. We're a long way from that. I just think we need to keep that in mind.
Or be disadvantaged compared to our foreign banks. Okay, thank you so much. I yield back.
Thank you.
Thanks. Mr. Chairman, we have two more members here, but unfortunately, you're hard to stop at one. Can we go over just by 5 minutes? Is that okay? Okay. No good deed goes unpunished. So we'll go to Mr. Davidson from Ohio for 5 minutes, and Ms. Garcia from Texas for 5 minutes, and then we'll wrap. Thanks.
Thank you, Chairman. Chairman Powell, thank you. Thanks for the extra time so we get all these questions in. And just picking up where my colleague, Mr. Gottheimer, left off, talking about non-banks and and banks and kind of the regulatory framework. Recently, you published online the list of master accounts that the Fed has. Are any of those master account holders non-FDIC insured entities?
Are any of them? I don't know.
Could you get that answer back to us, please?
Sure.
Okay, thanks. So when I think about some of the dynamics that are going on in the market related to banks, non-banks, securities, not securities, one agency in particular has been very activist in this place over at the SEC, and it's kind of tangentially related to the Fed, but crypto and digital assets in the U.S. has got a market cap of around $1.1 trillion right now. It's been there for a bit. Do you acknowledge that this asset class has staying power in the U.S. economy?
It appears to have some staying power. Of course, that 1.1 trillion was, what was that a year ago? A lot higher.
Yeah, it's had some volatility in large measure due to the lack of legal clarity, and so hopefully this committee will help that quite a lot here this summer with at least two bills, one on stable coins and one on market structure, and it'll be clear not just for Congress but for regulators, including Chairman Gensler, and obviously market participants, whether they're forming the ideas or investing in the ideas or participating in the activities in the space. But when I think about participating in activities, one of the core functions that has taken place for a while now is the reverse repo market. So it's hovered over just over $2 trillion for the first half of this year, and it follows kind of exponential growth that we've seen over the past few years. So what's your assessment on the implications that the reverse repo market has on our economy?
Not much. It's just a place where holds money on the Fed's balance sheet. It's like a mutual fund. I mean, in fact, it's as the Treasury has been issuing bills to refill the Treasury General account, we've actually seen the reverse repo overnight facility declining. So,
isn't there some sort of conflict with higher reserve requirements, liquidity, and lending in the market? Or is there any tension there?
I don't believe so. It's just a place where largely money market funds have been putting their money, and as rates normalize in the economy, we're likely to see the reverse repo facility shrink dramatically, and I think without particularly important macroeconomic effects.
If you think about the implications, the Fed had to intervene in September of 2019 to provide stability and liquidity to that market. The fact that the Fed needed to use an emergency facility to intervene in the market would normally indicate some cause for alarm. Do you feel like that was an aberration? There's no more cause? Everything's been settled?
Well, that was about suddenly finding ourselves in reserve scarcity. So we'd been monitoring the level of reserves really carefully and thinking that we knew where scarcity would start to appear. And the problem is demand can be very volatile. So demand spiked and there weren't enough reserves, so you had a situation where we had to supply reserves in big quantities. That's not what's going on with the reverse repo facility was at zero for a very long time, and I think it's shrinking now. We don't know how much it will shrink.
Well, I think the growth of it kind of highlights some of the related concerns for inflation and tension between liquidity and frankly, when you look at the requirements for capital. And the alternative returns in the market, there's a concern, well, all that capital can't be deployed in the same place. So when you have to pick places for it to be deployed, then it certainly has implications. So I would love to follow up with you on it, maybe align my own views with the thinking at the Fed and with some market participants. When I think about the Federal Reserve, of course we think about monetary policy. And we want Fed autonomy on monetary policy to some extent. A lot of non-market intervention that to me continues to be a cause for concern. Continued purchases of mortgage-backed securities, for example, prevent real price discovery. Is Fed's purchasing propping up prices, or is it holding them artificially low? It's a non-market influence. And I think it has some distortions. So as Chairman of Housing and Insurance, I am continue to be concerned about that. But the other thing is, really, the big concern is the regulatory side.
Gentleman's time's expired.
Yield.
We'll now recognize Ms. Garcia for the ultimate question of the day.
Thank you, Mr. Chairman, and thank you, Chairman Powell, for being here today. It always is a breath of fresh air to have you here to give us the latest report on from the feds. I first want to thank you personally for working on a topic that has always been dear to my heart and dear to the heart of the Congressional Hispanic Caucus. I know several members have already touched a little bit on issues related to diversity and inclusion, and you yourself said something, and I really was struck by the words you used, that when you look at setting the interest rates, you want to reflect that all Americans in the room when you do it. And in my view, the best way to do that is to make sure that the people at the table making those interest rates decisions reflect what America looks like. So I want to thank you again for last month joining you was Adriana Kugler, who was nominated as the first Hispanic to ever serve on the Federal Reserve Board of Governors in its 109-year history. It took a while, but we're there now, and hopefully that will help ensure that when decisions are being made, that all Americans are indeed in the room with you. And so I want to thank you and the President both for making sure that that happens. I know that in my district that is 77% Latino, we're really proud of that fact. But Mr. Chairman, I wanted to see if you could provide me an update on the federal workforce, particularly within the Fed system, because I think that area too, you may recall we've discussed it before in prior times that you've been here, the workforce doesn't quite look like America. So could you give me an update on where we're at with diversity and inclusion issues related to Latinos in the federal workforce for the Fed?
Sure. Well, I guess the place I would start is a good part of the story, which is the directors of the 12 reserve banks around the country. That's been an area where we focused heavily on diversity and inclusion, and I think met with a great deal of success. So relatively high numbers. We can give you the numbers. We'll be happy to. Relatively high numbers of both Hispanics and African Americans and other minorities, and majority of women. So that's been an area where we have a free hand to act, and we can do that. I think in terms of the workforce, we actually had a particular focus at the Federal Reserve Board on Hispanics and working hard, particularly devoting ourselves to a tight focus on generating more Hispanic contact and more Hispanic employees. And I think we had some success with that. We spent a whole year of that, doing that a year or so ago. And so, you know, it's a very important, the most successful organizations in American society, or it's not a coincidence that they seem to me to be the ones that have pretty advanced diversity and inclusion programs, so that they do have, you know, all different parts of America represented around the table.
Great. Another area of concern for me has always been affordable housing. I know that is a challenge for us in Houston, and also the challenge of combating the homelessness crisis across America. I know that the ranking member, Chair Waters, this morning filed some bills related to seeking increased dollars for affordable housing and dollars for tackling the homelessness problem. Do these issues impact the inflation rate and the work that you're doing to lower the cost of housings for all Americans?
I think they may have a marginal effect on inflation. I think more, I would point to things like workforce participation. So people need housing so that they can get to the place where the jobs are. And in many metropolitan areas, the rents are very high, so people are having to work to drive very long routes to get to work. And I mean, labor force participation has an important effect on labor supply, which has an effect indirectly on inflation as well. So.
How long have we had the 2% goal for inflation rate?
Unofficially for a quarter of a century, and officially since 2012. And other central banks.
What factors would have to occur for you to reconsider the 2% since it's been there for so long?
What would have to happen for us to reconsider it? I can't really think of anything. Nothing during my tenure will happen to cause me to want to reconsider it. if you come back in 100 years, it'll probably be different, but it's some unforeseen circumstance, I would say.
Thank you. Ladies, time's
Thank
expired.
you, Mr. Chairman, I appreciate it.
I'd like to thank the Chair Powell for his testimony today. Without objection, all members will have 5 legislative days within which to submit additional written questions to the witness through the chair, which will be forwarded to the witness for his response. I ask you, Chair Powell, and your team to please respond no later than July 30th, 2023. And with that, this hearing is adjourned.
Thank you.
Well, non-event. Well, a nothing burger. Kind of figured that. I want to see. I want to see what happens here at 2:00. Really curious what happens at 2:00. So, I'm gonna spend from now until then. I'm gonna sit here and I'm gonna go over and I'm gonna find whatever it is I gotta find through. I'm gonna just be scanning through charts. You had some inflation data this morning that came in pretty high. I don't know if you heard anybody speak about that or not. It cracks me up every time looking at this. Cheese! Everybody say cheese! Goddamn white man taking everybody's money. Fucking white man taking everything for everybody. And who's his assistant? Oh shit. I'm sorry. Netflix. There was news Netflix may try and buy Paramount. So I'm not sure how true that is, but that's what just came across the wire. Well, the story so far is we did not go green. We did not attempt to go green at all. We tried one time, and that was it. Come on, AMD, just bounce so I can short the shit out of you. Or take the long. Look at that setup. That's nice. That's such a nice bull flag. I love these. I don't know if you can see it. All right, so you have the Dow is up. The Dow is green almost. I mean, it's green on the day. It's just not green from yesterday's close. IWM, not so green at all. Let's see the Qs. Probably not so green at all. Not so green at all. So what does this mean? And the SPY is just stuck right in the goddamn center. It's just tech has sold off like crazy all day. All day tech has been selling off. I wonder when the SPY is going to make up its mind. It's literally flat, and all the other indexes are way down, or they're at least green on the day. Not green as in higher than yesterday's close, but from where they woke up and started trading today, this morning, the Dow is like damn near green. So I'm going to go try and run through and find what stocks are keeping, like what is it that's holding us down and what's going up. I want to see what stocks they are. I mean, we know Nvidia, AMD, and stuff like that, they're selling off. They were the leaders, they're selling off, so we're getting a pullback. But So it looks like all of our Dow stocks are just, you know, oil, energy, healthcare, industrials. It's about time, right? They've been, look at this, steel. So you want to take notice of this because this is actually pretty green out of nowhere in one type of, it's pretty much leaving one industry for the other. And you guys understand too is when they're taking profits and selling here, they're putting the money in somewhere else. They're not just taking the money out. Like if you really want to make money at this stuff, do this day after day after day. Just buy your things and notice sector rotations. You're going to catch your big run-ups because nobody wanted to buy it. Everybody was talking about how the market had to go down. All you had to do was just do the opposite of what everybody was saying and realize until there's an actual event that causes the market to go down, whether it's earnings, whether it's Powell, just keep buying. But yeah, this is probably a lot of this tech taking profit on tech and rolling some of that profit into UNH, XOM, Cortiva, whatever the hell that is. But yeah, you have copper, FCX. Maybe I'll be a month this right here. Maybe I'll be a month late on the CPI print. I mean, this is all your industrials, your utilities, railroads. Where is utilities? Because I was just wanting to look at them and they sold off. Look at Dollar Tree. That's so funny. I was literally going to look at Dollar Tree today. And last night I meant to, and I never did. Dollar Tree got wrecked. It's at such a good price. It's probably the outperformer of the day. Oh, my little baby snoring. Hello. I can't help it. I can't help it. They're the best of friends. They're the best of friends. Oh, shit. I better stop. Look at Tesla down 5%. Intel 4.9%. AMD 5%. CRM. ANET. What else do we got? So it looks like the semiconductor is having a profit type of day. They're taking profits on it. Alright, I gotta charge my phone. I'm just gonna keep looking. Maybe. I mean, is there something that could have told us this? I'm not sure. Oh, maybe this is how the rest of the market catches up. We'll have to see. Shit. See, I need that to hold up. I need it to hold. And Disney still just goes down. The whole market goes up, it goes down. It finds rotation. Everything just goes up but it. I don't know what the hell is wrong with Disney. I don't know. I don't understand it. They're always packed. You have a reverse Head and Shoulders. Why do I keep saying reverse? I've been saying it all for 2 years now. That's why. It's weird. I just think, what if there's something really wrong with Disney? I don't know. Look at this thing, man. It's gotten beat up. It's so beat up. It's so bad. What's the street know that we don't? That's not COVID. Is it? No, that's 08. I mean, you're talking about being at COVID lows, guys. Like, I don't know. I don't know. I don't know if it's the stuff going on with whatever it is they got going on with DeSantis or what. But that's crazy. I don't know. I'm going to go ride around. I'm going to go ride around the market and try and find a chart that I like. I know I like Bitcoin. You know, I want to see how... Is there a solution? Community Bank Trust. Oh shit. Yo, I can chart it on here. No shit. You're kidding me. I had no idea. What? Give me the... What? The fuck is this? Sam Bankman Fred. So yeah, that's my plan. It's pretty crazy the SPY can't get going. It just cannot get going. And Coinbase has its own issues too with the SEC. Yeah. So that's what I'm gonna do, guys. I'm gonna go run around this market. I'm gonna find me some opportunity. Now I'm still watching Bido and stuff like that. I kind of took my attention off of it today because I had Powell, and I'm just waiting to see if I can get a pullback. You had a little blow off top here. Let's see what it looks like on the daily so far. Yeah, it looks like a blow off top. You gapped up. You have a long tail up on top. But again, there's a clear rotation. Health, industrials, you know. I wonder if this is it. I wonder if this is the. You want to see if you can match it up with something like the IWM or the Dow. I'm trying to go through. I have another screen over here that I'm going through in this one to see if I can just do what I do to figure out what decision I need to make. So we just got fed Bostic news. I don't know where he's talking at or whatever, but he's he's there. He's making comments that he wants to give it more time. I don't know if this sends the market higher because you've already had such a huge run in all your semis and tech that I don't think it makes a difference that that's not going to change the decision making of the activity of changing from one thing to another and taking profits and putting it and rolling it into something else.
Let's bring in Mike Bailey, Director of Research with FBB Capital Partners, along with our own Michael Santoli, CNBC's senior markets commentator. Mike and Mike, welcome. Mike Bailey, let me start with you. I know you don't like the idea of trying to time the market. I'm not going to ask you to do that. And I'm not going to ask you to say that, hey, this tech rally is over. But you do see what you describe as the possibility of some downside volatility this summer. Why?
Absolutely. So, looking at the tech rally we've seen year to date, pretty impressive. You don't get these types of rallies very often. Question is, what's next? Could we see this rally continue, or are we at a bump in the road here, or could be a sort of a precipice with some downside? Sort of putting all these pieces together, we do see a bit of volatility coming up. We do look at market sentiment, sort of investor behavior. The VIX, or the fear index, is really plummeting. To us, that is a concern about investors getting complacent, so that we do have some worries there. A couple other pieces of the puzzle here. So look, tech stocks, again, had a great rally. They're just way more expensive now. We started the year at 20 times earnings. Now it's 30 times earnings. That's a tough hill to climb. And I think if you really want to see some more excitement out of these names, you may need another theme. Is it another AI, maybe a twist on AI? Or perhaps finally our earnings going to come through for some of these companies and really drive another leg of growth? So some questions there, but I think in general, I would expect more volatility as opposed to less as we start to get through the summer.
Mike Santoli, thoughts, reactions?
Yeah, I mean, we certainly had a lot of the factors aligned coming into this week for at least a breather in the leaders of this market, which has been the NASDAQ 100. A short-term trader sentiment gauge was at 93% bullish for the NASDAQ 100 entering the year. It just doesn't get much higher than that. I think the question is exactly what the choreography of such a pullback is going to look like. And today is probably the ideal orderly example of how things could play out. The NASDAQ 100 down 1%, the broader market flat, everything outside of tech is net positive. JP Morgan tickling a new 52-week high, that stock. So I do think there's a way for it to kind of release some of the pressure. Yes, we've rebuilt the valuations a fair bit. If I look at the NASDAQ 100 forward price earnings ratio, it peaked around 30 back in late 2021. It's back up to something like 27. So, maybe you have an optimistic call on how earnings forecasts will go, but that's still looking like it's pretty rich, although I don't think this longer-term trend, which has just reasserted itself to the positive side, it's too early to say that it's ending.
And so, Mike Bailey, is your call for people to move to the sidelines? Is fixed income more appealing? Small caps? Where do you think there's better opportunity?
So stay diversified. I think in general, if you've picked NVIDIA at the beginning of the year and you've had a great run, make sure you've still got a diversified portfolio. If that stock is a big chunk of your holdings, you want to be careful with that. Is NVIDIA going to keep ripping the rest of the year? Probably not at the same pace. To really just stay involved, I think the comment at the top was correct. We do want to be fully invested. We prefer to avoid market timing, but just make sure you need to rebalance and see what else is out there. There's some great names in tech. Tech earnings are growing. You can look at 2Q earnings estimates. A lot of the big tech companies, you're seeing some significant growth faster than the market. So I think you want to participate there, but just make sure you've got some other stuff in staples, healthcare, in case we hit a recession, so you've got some offsets to the big tech growth.
One of the great names in tech that you mentioned in our briefing note is Amazon. Tell us why you like it and put it in the context of this federal suit against Amazon with regard to how it markets Prime.
Absolutely. So certainly a lot of these mega cap tech names, they're under a lot of scrutiny. So there are investigations going on all the time. I'll kind of start out on Amazon just looking at the broader growth drivers. So e-commerce, that's really a big theme for us. They overspent big time. I think they created a UPS on its own in 2 years. They've overspent on that. Now they're just rationalizing that. You're going to see a lot of growth coming and profit growth coming out of e-commerce. Advertising is still growing. Look at cloud computing, still growing. So we like the business in general. Stock is trading at a relatively low PE for Amazon, and the stock's actually underperformed the broader market for the last 5 years. We still see a catch-up trade. That's sort of the big picture view. Now let's take a quick look at this FTC.
Look, there goes the SPY. That's it. It's going up. I want to see if we can I want to see if the SPY can go green. I just don't know if I trust it. It's just a sideways day. It just feels like I don't need to be in the indexes.
Pair of mics, thanks very much. Bailey, Santoli, we appreciate it.
Now to some new comments from Atlanta Fed President Raphael Bostic. Let's bring Steve Leisman in for those details. Hi, Steve.
Yeah, Kelly, actually two Fed presidents weighing in with a more dovish outlook on rate hikes after testimony by Fed Chair Jay Powell suggested the Fed may raise interest rates 2 more times.
Bostic saying in an essay that he just released, he's putting himself firmly in the wait-and-see camp when it comes to raising interest rates. He said the Fed should let rate hikes work through the economy, see if they bring down inflation before deciding what to do next. Good reason, he said, to expect policy tightening to be more effective in coming months. The real effects of tightening, quote, are only just beginning to take hold. Chicago Fed President Austin Goolsbee, while Powell was speaking, saying he had not decided what to do in July, but that it was reasonable for the Fed to be on a reconnaissance mission now. He agreed with Bostic that the Fed had raised rates a lot and that those rate hikes needed some time to play out in the economy. He indicated he wanted several more months of data before deciding what to do next. All of that seems to contrast at least somewhat with Powell, who suggested strongly that 2 more rate hikes is a pretty good bet if the economy performs as expected. So something that's divided in the committee we have to watch now among those sure they want to hike and those who want to wait and see until there's more data before making that call. Guys?
So I guess we kind of know now, don't we, Steve, where the chairman fits in that spectrum of votes that was taken last week about how many more rate hikes were expectable.
Yeah, when it comes to those forecasts, that's a very good point, Tyler. We didn't really know. He was kind of speaking kind of like, well, the committee is saying these things.
Yeah.
Kind of put himself in that camp among those who think 2 rate hikes are a pretty good guess, is the exact terms they used, if the economy performs as expected.
All right, Steve, thanks very much. It was just a week ago we were together down in D.C. All right, Fed Chair Jay Powell sounding pretty hawkish in his comments to a Senate committee today. So let's get reaction from Chicago, where Rick Santelli is talking to traders. Hey, Rick.
Hi, Tyler, indeed. And before we get to the traders, I think we should kind of sum up how the markets responded to Jay Powell in front of the House Financial Services Committee. Look at a 2-day chart, a 2-year, very sensitive to Fed policy, pretty much sideways, not a huge effect by our chairman as he was answering Q&A. As you look at July Fed Fund futures, they start on the day that we had CPI. The next day, we did not see a rate hike. And you see it's basically been going sideways. So percentages, 70+% that they're going to hike a quarter in July, but cold, 20%, a little less than 20 for September. The dollar index is where all the action was. Look at what happened at 10 o'clock Eastern. It did a swan Acapulco dive right off the charts. All right, action here, but quickly, let's talk about Jay Powell. Okay, I didn't see the percentages change, but what do you think the markets heard when he was talking today in front of the House Financial Services Committee?
I think they heard he was just buying time. He could have raised rates, chose not to, just buying time. It would have probably been a better idea if he did. He put it out there. Oh yeah, we're probably going to, raise rates in the future that we're not done.
It hasn't really changed. Hasn't changed. Same as last night.
You know what? Actually, that's the best answer to a question that everybody's asking.
Yeah, I'm a smart guy.
The 14th. Since the 14th. He sounds like he wanted to raise rates. They all voted unanimously not to raise rates. It sounded like they had a little bit of non-raising.
CBOE, the Chicago Board, Options Exchange.
And I agree, he's buying time. So let's play a game here. Let's say we know 1 year from today, inflation's going to be at 2%, the inflation target.
Sure.
What should the Fed do between now and then?
Probably nothing. They shouldn't do anything at all.
Probably nothing. I almost feel like we should just stop there and call it a day. Yeah, because to me, that's the only correct answer. And longer, higher for longer fits right in with the logic of that. Exactly. And that's why the market...
Higher for longer. What's higher? Higher would be 5 1/4, 5 1/2 longer. But they're not doing that. They just went to 5 and they're going to stop possibly. It's crazy. Drops on Powell's Q&A. Dollar's been dropping for the past month. Well, it's actually been dropping for a while.
Or they go too far too fast. And maybe they just need to calm down and just do nothing for a little bit.
David, it's always fun to talk to you.
My man.
Thank you, buddy. Kelly, Tyler, back to you.
Not enough energy there. Not enough energy there, guys. Thank you, fellas.
Because it's lunchtime. Everybody's just waiting. Well, it is 2 o'clock.
We'll speak to the CEO and Tech Check about that next. Plus, infrastructure has a speed limit in this country. Bills, funding, construction, it all takes a lot of time and money, thanks to red tape. Yet the I-95 repair hits...
That's Philly for you. It's Philly for you. So, if debt leads bonds and bonds lead equities, Amazon saying FTC claims are false. About look at TLT rally its ass off today, guys. It looks like a rally, but it's not that big.
Welcome back. Time for today's Tech Check. Dropbox unveiling 2 new AI-powered products today, including a universal search bar called Dash that connects major platforms like Google Workspace and Microsoft Outlook. Shares are fractionally lower, though. Here with more, let's get to Deirdre Bosa out in San Francisco, joined by Dropbox CEO Drew Houston. Hello to both of you.
Hello, Kelly. Thank you. And Drew, thanks so much for being with us here in person at One Market. Before I get to the product news, I want to just sort of get a status on the business overall. A few months ago, you made that difficult decision to lay off about 500 employees. You cited slowing growth and the urgency to be at, quote, the forefront of the AI era. How are you doing on both of those fronts?
Yeah, it was a difficult decision, but like a lot of companies, we're responding to the macro environment and then also investing more in the future. So investing in early product development and AI and some of the launches that we're announcing today.
And how are you on the growth side? Has that helped yet, or are you still waiting for that sort of to trickle through?
Well, we're launching these products are just hitting today, so we're really excited about them. We think it's a huge opportunity.
Okay, let's talk about them. I want to talk about the more major innovation. It's something called universal personal search. Explain to our audience what that means, why they might need it.
Sure. So one of the products we're launching today is Dropbox Dash, which is AI-powered universal search. And the idea behind this is, or it started with just this idea, like, why do we live in a world where it's easier to search all of human knowledge with a Google search than your company's knowledge or even your own stuff? And Dropbox has helped our customers organize.
All right. Let's see here. I want to see if the spy can really get going and get some legs. Wonder if the banks got hit today. Usually, you don't. So like this whole time, like throughout this bear market, we've had usually it's TLT and banks are inverse. Okay, like you could be long banks and short TLT, or long on both, and whichever one takes the long side, you cut the loser. Not just randomly buying it in the morning, but
Second, it's a natural evolution of what we do for our customers. So millions of people, millions of businesses already trust Dropbox with their most important information. And so going from files to all of your cloud stuff is a natural evolution. And that trust and privacy
privacy piece is really important. And so everybody's excited about AI and what it can do. Everybody's concerned about the negative impacts. And so in the brave new AI world, it's more important than ever to have a service you can trust, and that's what Dropbox can provide.
Right. So in this brave new AI world, there's a lot of products, not as much monetization. Some analysts have pointed to your pace of monetization, paid users on Dropbox. Do you expect this to be a major profitability lever for you guys? How do you think that's going to impact the monetization of, Dropbox Premium?
We think this is just a
I may not get the entry, but if AMD does get back up here to 114.50, shit, I'm gonna, see the SPY is decreasing, but look, now there was a whole lot of volume that just stepped in there. Shit. Just trying to figure out what I'm gonna do. I'm gonna get my stuff in order, and then if I get into something, I will let you guys know.
Since then, a lot of companies have actually been leaving San Francisco. There was Westfield giving up its mall recently. That news. We've got the highest vacancy rate of any large American city. You're still here. A lot of folks working on AI are still here, or they're coming back. Why? Why San Francisco?
Well, San Francisco's been a great home for us since the beginning, and it's still home to a lot of the innovation and a lot of, when you think about all the great things happening in AI.
Gotta wait for a pullback, though. Gotta wait for a pullback.
And I think it speaks to, when we think about internet companies, we talk about network effects and just all the benefits of when you have great companies, great talent, great schools all in one place. That's not changing. But for sure, I mean, San Francisco, like a lot of cities, has its challenges and these humanitarian crises. And I think everyone wants it to be better.
Well, I'm glad you were able to come visit us in person at One Market. Drew, thanks so much for being with us.
Thanks for having me.
Drew Houston, CEO of Dropbox. Tyler, I'll hand it back over to you.
All right, Deirdre, thank you very much, and thanks to our guest as well. Up next, an ESGOP fight. Anyone with a 401k needs their retirement fund to grow as large as possible. Republicans say ESG interferes with that goal. We'll explain how they are targeting it next. Plus, details on how worsening weather patterns could threaten to drive up already high prices for soft commodities. Our Lunch will be right back.
I feel like it's not going to give us the pullback. I feel like it's not going to give us a pullback. Shit. Look at these tails. I started to go long here. Whether it was a scalp, it was probably going to be a scalp. But, it's like it wasn't breaking down that we finally retested this area, and then that was it. It just took off and said, yeah, we got to go test yesterday's close. Where is yesterday's close at? Right there. Could we, there is a small gap here. Could we head up to 440? I just randomly bought it, so it's gonna pull back. Why did I do that? I need it to come back down. I need it to come back down. God damn it. Yeah, that was not a good idea. I'm still green though. Oh, there's the test of no, keep. Shit. God damn it. Why'd I do stupid shit like that? Why do I do stupid shit like that? I don't want it. I don't want that. I don't want that. That's too high, too quick. Yeah, I had to get rid of that. I had to get rid of that. Look at this. I don't know what to do. I mean, I do know what to do. I need a pullback. I gotta be a buyer down here. We're gonna pull back here. I wanna get a pullback into here roughly around 436. And then I can be a buyer. Watch it put in a flag. Look. See if we put in this flag. See if we put an ascending wedge. I feel like it wants to put in a wedge. It's 224. Look at that. God damn it. Look at that sell volume, gang. Team, gang, fam. Yeah, that should be it. This should be it. We're overextended. That's it. If anybody has calls and bought calls on this rocket ship, you better watch yourself because it might make it sharp. Look at this sell volume and like, look how little that was, and it literally just ripped. Oh, really? Jesus Christ. I think she's new. Did a great job, girl. She's new. He's making it. Maybe she's not new. Maybe it's me. But unless she was a writer this whole time, because I seen that article she's bringing up. There's got to be a way I can hold this. Or like, you know what I mean? Like where I can still type in the box and everything and not have it go away. Nah, man, I'm not in anything. Dude, if I'm not in something early in the morning and catching this volatility, I'm not, unless there's breaking news, I more than likely won't be in anything unless I have a swing trade going on. You know, there's no reason to be anything. I just took a SPY long. I just went long the SPY, and that's I sold it because of this. Look at that. And then you had these little ass, you know what I mean? So I want to be a buyer. I just want to see it pull back. I want to be a buyer. God damn it. I need the pullback in this area. So I will get long again if it gives it to me. But look how extended we are. Like, you want to look at like 3-minute and 5-minute charts. Hell, even 15. Look at it. It's going to go. It's not going to pull back. Wow. There was just a lot of selling in there. Is why I got rid of it. Like, this, we just whoom. Like, we just took off. and I had to take some off. And then I was like, no, I can't be that stupid, because I got in like here. I think I got in right here on this candle, just above these highs, and then it just literally just ripped. But I do want to get long again. I want to get long again. I just want to pull back. I just want to pull back into here. Just want to pull back. That's all I want. And I am looking for, there's AMD. AMD is back up at VWAP. We could see them start stepping back in on this thing and rejecting VWAP, especially if they try to take it higher. Man, look at that. This is crazy. See, if I would have held it, it would have just... I think they're scared to not get long. Look. Fuck. It broke out.
S&P futures continuing higher now, 44.2875. Down 6.50.
Bragged about it in a chat group on the Telegram platform. Miami police are investigating Dolphins wide receiver Tyreek Hill for an alleged assault and battery Sunday, but they're being tight-lipped about any other details involved there. The Dolphins, though, released a statement saying they're aware of the situation. Congressional leaders are planning to unveil today the official design for a new stamp honoring the late civil rights leader and congressman.
I gotta get a picture of my little girl. And, God damn it, I forgot what I was gonna say after that. Oh, I think I'm gonna... Highways and byways. The bridge was on that Fetty. Which y'all know about Philly. The bridge was on the Fetty, and, you know what I mean? It took too much. Took too much of that shit. The bridge OD'd. That's what happened. What are you doing? Oh, I know what I was gonna say. I wanna take a picture of my little girl. Put her on the thumbnails. Look at this thing go. Man, you fuck. You're kidding me, baby. There is no room up there. I'm sorry. There's no room. Right? Jesus fuck. This fucking thing literally just... Look at it. Look at it go. Of course the volume comes in now. They couldn't bring it down. Unbelievable. See, I like to buy pullbacks. Like when people don't, when your mind is telling you that you shouldn't be buying it here, or... It's not even really that. It's just my risk to reward. So if I get long up here, this is what I mean. So like if I get long up there, which I did, I got long up there, and it was odd because the options contracts. So if you guys get into options, and you'll start noticing like after you do this for a while, like so I noticed as we were coming up here. on the pullbacks, the options were not like losing value. They were literally holding the same value as they were up here at these wicks. And on these pullbacks, it didn't come down at all. And that's like a sign where you can read the options, and it's telling you in a way that they don't want to give it up because, you know, like it's not going to devalue. And it's telling you that like it's holding its strength for a reason. Like it technically should have pulled back a little bit. It should have been down like a few cents or so, like you know, depending on. I can just read it and tell. Like usually you'll get one, like it'll stay up there and it'll still lose value on you, because like if you bought this high and it pulled back and just, even though it pulled back and just stuck it, the fact that it just didn't continue higher because of the speed and momentum, because of the volatility to the upside, it'll usually lose, like you'll lose a little bit of IV there. And it didn't. They literally just stayed there, and I'm like, yeah, I got to get out of this, because I just, you know, like, look at the 5 minute, look at the 15 minute, look how extended we are. Doesn't mean it has to, but I want to be a buyer right here. Maybe we'll get it here. I don't know. Maybe we're going to go touch this close and then reverse it. I don't know. But I'm a little upset, though. Is that? Looks like we have a small dude, that's a bullish pattern. This inverse head and shoulders that I told you, it looked like we were starting to form early in the morning. On the 5 minute, it looks better. There's your left shoulder, head, right shoulder. But usually you'll break up and out of the neckline right here, and you'll retest it. Wait, what? Oh, yeah? What do you mean? Like, on what? I don't remember what I was saying to, like, kind of conclude with what you're saying. How? $25 to $30 million. So that's all right. So if you guys want to, like, I could, like, if I look in a construction magazine and Yeah, but it was such a small area, though. It's like I don't see how it could take that much money. I I mean, I guess because of inflation. But they were doing stuff on. So they were doing like huge projects and stuff in different states on like 20, maybe, I wanted to say 20 million, 30 million though.
So I think there are a couple lessons you can draw. First is keep in mind that whenever there's an accident such as this, red tape is already cleared. That's part of federal legislation that has actually existed for quite some time. The second thing, though, is for those who believe that government can't do things or that we are somehow inevitably doomed to long delays and nothing getting done, we were able to prove that that's nonsense, that when we roll up our sleeves and all work together, we're able to meet an important task. So I hope that with this being really the remarkable success that it is, I hope we are now then able to apply it to future projects. Certainly when we talk about permanent
Um, what's that on AMD or the Spy? Or the Spy? I mean, yeah, absolutely. Because my target was 435. Was this area to be long? Well, really, it was this area right here to be long. I wrote it down this morning. My cat's laying on my notebook. 439. Yeah. Oh, I would have. Yo, get tomorrow's. You can get it. You can get a 440, 439 for tomorrow. Same price. It's just a little bit more. That's what I took on this run. Was it? I grabbed the 440. It was like $20 a contract when I took this long here. Sorry. Let me. So listen, tomorrow and or Friday is when I'm expecting something. So I'm gonna have a game plan for tomorrow. Like I'm gonna be ready to not necessarily hit it right off the bell, but I'm expecting some volatility tomorrow or Friday. I don't think it's gonna come from Jerome Powell because we got that today and it was just the usual like song and dance. We had a couple questions asked, but in a nutshell, it was a non-event. See, I want this retest and see if it holds. I might see. I want to take this out and I want to like really focus in on the SPY or the IWM. So let's do this. So what usually helps, is if you watch the IWM. So look at the IWM. It's up. It's extended. Where is it at? It's past yesterday's high. I'm gonna talk this out. So, in the Dow probably also. Not really. So this looked really good. I don't know if I mentioned it yesterday, but this break and hold, retest and hold. I just want to see other charts to kind of dictate what I can go off of. Stop, man. God damn it. I hate that noise. It's so loud in my ear. Look at the cues. They're I wonder if they're going to pull back. So that's yesterday's low. And it regained it. So that you still have a gap there somewhat. I love how I literally put out my levels and it just knocks it right to a T just about. What do we have? An hour. We have an hour. So this was a break. Resistance, resistance. Consolidated. Rose. Gold higher. Support. Broke support. Does this turn into resistance? So that's going to be key. And if it does, where am I at? 1 hour? Give me 30 minutes. It's like we're so overextended. I wonder if this could be the start of getting us back down to 357. He is a dictator. It's a communist country. Intimacy. Could have used a better word, my guy. Look at that level right there, guys. That's a key level. You guys need to write this number down. And I'm going to put it in. I'm going to write it down myself. Look at this level. Right here. Look at that level. I had it down yesterday, but I took it off. Let's see what happens here. This is the shift. Let's see what happens. And look, we're starting to get an increase in volume on the 15-minute to the downside. Baby girl. If you guys could see my cat. She's just so. No, don't. No. Yeah, you don't have to. She's so adorable. Oh, shit. I mean, really, the SPY hasn't moved at all today. It's literally moved a few dollars. But I'm just trying to get... I'm trying to... Man, it's telling me to... I'm telling my stuff... My instinct is telling me to buy the dip. So I didn't talk about it last night, but the psychology of what's going on here. So you have... And what's funny is I did the live stream last night. And I wanted to talk about it because I was going to get into the IWM here and how it hasn't rallied in small caps. And fund managers being stuck between a position of, wanting to be long this market, but they don't want to buy the longs that are up here, like the Metas, the Nvidias, if they haven't really gotten in. But they also don't want to buy some of these small cap companies that aren't making any money because of the environment we're going to go into, where they don't have any free cash flow or any cash flow enough to pay for operations. And then when they run out of money, what are they going to get that interest rate at? I went into that idea a while ago, and I was wanting to bring that up last night, and I think I forgot. And it's just funny how we are like, if they just made a decision to buy some of these things up, I don't know. But there is, I don't know, maybe we just stay quiet for a little bit, because guys, believe it or not, we have earnings the end of the month, or in the end of month in July. It's about 6 weeks away. We already have earnings again. So we'll have Q2 earnings. Let's see here. Boom. I was hoping to be able to wake up to some kind of news today. Like, oh shit, also. Was it NPH? It's so loud, guys. I apologize. Look at Apple just ripping right back up to the upside. My hand is stinging. My fingers. What do you guys think? Do we rally or do we get a pullback? Oh, my finger. It's so weird. Just gotta be a way I can get rid of that noise. AI is down 10%. It was 11% here. Missed that one. I wonder where Carvana's at. It's probably getting shorted again too. Look, it probably broke that level. Doesn't mean to get long. Like, look at Carvana. It's actually up to the upside. Wow. Look at that break and retest on Carvana, guys. That's a good play. Check this out. That's a nice setup, actually. Damn. Wow. I might get long Carvana real quick. I don't think anybody's talking about this. Look at the tape going nuts. There's 1,000. I thought I just seen a 3,000 buy order. There's a reason why it's cheap. I wonder if we can get back up here, guys. I'm really curious. Oh, look at the pennant. Look at the pennant. You know what it's doing? It's gonna probably retest this. Like, it might come back to retest it. No, I don't. Shit. That's why I do it. There's a rejection on the SPY. I'm gonna put. I want to see the volume. So I'll use 1 minute, 2 minute, 3 minute, and 5 minute, 15. I use them all, but you want to see the volume. Like, does it? Are they really selling the stock, or are they really buying it? This tells you there. They're really buying it. Now, if you get something to where you close, like, let's say like this 1 minute candle, right? We get from 0 to like 50 seconds, and the last 10 seconds, you get like this sharp reversal and massive volume on it, but it still closes green, and they sold it off. Well, you got to remember that they were there. The candle still closed green, but in the last 10 seconds, at whatever price it was, it went back to, the sellers really jumped in, and you'll start to see those kind of things from time to time where you'll have a massive like the candle will just be getting ready to close, and then this surge in volume comes in, either whether it's to the buy side or to the sell side. The last like few seconds left of the candle's life here for the volume, and it'll still close green, but there's like a lot like that volume bar is actually got a lot of selling in it, even though it's green. You'll just start to see those things from time to time. You really saw it during the last bear market. You would see it all just about every day. And sometimes people will have these candles where it's both. It'll show them the buy and the sell part of it. But I mean, like this candle here, like we know. See that candle? See how that has that long wick? How much buying? There's probably a lot of buying in there, but it's still red, so it kind of throws you off because it didn't close above where it opened. That's a perfect example right there. I feel like Carvana is going to squeeze into the close tomorrow, or into the close today. Maybe that's a failed breakdown. Look at Carvana. Well, I think I missed this one, folks. I think I missed that one. Gotta be quicker than that.
Trapped people into recurring subscriptions, which could only be canceled by what the FTC described as a 4-page, 6-click, 15-option cancellation process. Amazon responded to the lawsuit, saying the claims are false, and the company was in talks with the commission staff to provide context about its Prime service. I use it a lot.
Yeah.
I've never tried to cancel it. I don't think I will.
I did cancel it for a little while. It didn't seem that hard. This was internally known as Project Iliad, and the stock barely moved lower on the news. Be it what it may. One thing fueling the tech rally this year has actually been layoffs, generally seen as helpful for companies in the short term. Buzzword is efficiency, but add that to work from home, and we're seeing a lot of empty office space in and around Silicon Valley in particular. Vacancy rates above 20% in Menlo Park and Mountain View.
Time of sale is just painted red. It just turned 3 o'clock too. Look. See what they do. We still didn't get the pullback to where I wanted it. Okay? I'm not going to settle. Like I said, you make the market work for you. You don't work for the market. The week would be my guess. Maybe get back up. That would be cool. I'd be down with that. I'd like a rally. So what I'm going to do is, like, when we start, like I want to look at the daily candle, right? So if you look at the daily candle, we have a second day of indecision. Do you see how it's like we're right where we closed? Yeah, we've gapped up. Oh, we just flipped red. Tomorrow is like don't use all your bullets in one shot, because tomorrow or Friday, like Friday, we're getting inflation data, and it's going to be a big day either tomorrow or Friday. I want to assume Friday. We're going to get, usually one day a week, we get a nice continuation, and it's usually on a Thursday. So, and you'll get like where you'll just get this huge continuation. Is this Josh Brown? I think it is.
Fed head is giving a speech, and actually Powell's going to speak tomorrow again, and I doubt it'll differ very much. So this looks like it was in the realm of expectations. Nobody is shocked at all by the news. But even if they were, you look back at the last 6 months since the year began, and pretty much every quote-unquote Fed speech shocker has been a great buying opportunity. I don't think the Fed has the ability to scare markets lower with what it wants to do with overnight rates, especially when you consider the way we're seeing, number one, economic data surprise to the upside. I can't believe it is, but it is. And then number two, the intermediate term and long-term rates are not really moving on what the Fed has to say. And I think that's indicative of a market that understands that the balance of 23 may not be super red hot, may not be ice cold, somewhere right down the middle. And in that environment, American corporations have already demonstrated that they have enough levers to pull to deliver earnings at least meeting expectations, if not exceeding. And that's the bigger story this year, not what happens with overnight Fed funds rate.
Feels like the bulls are starting to come out of the woodwork, okay?
Price has a habit of doing that.
Okay. You're not wrong.
Okay.
Savita Subramanian takes her most bullish position in at least 10 years. KKR's Henry McVeigh, the time to be negative was the end of 2021. Others talking about FOMO, there's more room to run. Do the bulls, in in your mind, have control of this market now?
I think they do because the things that you would be expecting to see if the Bears were going to take control just haven't materialized yet, and they could. So I would never tell you that something can't happen in the economy. But what are the things that most people are focused on to try to understand if there's going to be equity market stability? Well, the number one thing is how is the consumer doing? And we know that the consumer has somewhat downshifted, but the household balance sheet of the consumer is not an issue. And after 525 basis points worth of rate hikes, you would have thought that those chickens would have come home to roost. Then you actually look at what's going on. And
Well, you had the government handing out $300 checks every week. The checks that they gave them sent it home. Like, all kinds of reasons why they didn't have to do anything. Look at that sell-off. This is why you gotta just wait, be patient. It will set up. It will set up. It's just trading in the range right now. It's consolidating. I wonder if that was the pullback. Should have grabbed.
bull market that you could look at historically where you didn't have some follow through from the AD line. It took a while, but we got it. I don't know if it lasts. Again, we've got a situation now, though. I love this tape because you don't have to be in tech to make money. You don't have to be in the big seven names. Let's just look at a day like today. Tech is cooling off. Actually, it's the worst sector in the S&P. What's the best sector? An area of the market that's been in a slumber for a really long time. Energy. Okay, so let's take a look at what's going on. The semis are taking a breather. You got Intel down 4%, AMD down 5%, Nvidia off 2%. 96% of the SMH names are above their 200-day moving average. Almost 100% of the index was there a week ago. So it's cooling off. That's great. What happens? Are people running to money market funds? No, they are not. They're taking a second look at a laggard sector, and energy's having an up 1% day today. Actually, that's coinciding with crude oil at 72. And keep in mind, the high is 75 from May before energy came in. We might take that out to the upside and all of a sudden get energy participation in this bull market. You can't tell me it's 7 stocks if all of a sudden all of those XLE names start moving. By the way, 0% of the XLE components are at highs. So there's plenty of room and plenty of opportunities. So when I say I love this tape, it's not that I think it goes unidirectionally higher. We're not even doing that well today. It's just that there are opportunities everywhere you look. You could talk about housing. You could talk about energy. You could talk about communications. There are just different ways that different styles of investing are working this year.
You're still getting big inflows, too. Bank of America says the biggest equity inflows since October, driven mostly by hedge funds and institutions. 6 of the 11 sectors saw ETF inflows led by tech, and that's for the second straight week. So the money's going to where the money's been made because people think that the money's still going to be made in the biggest sector in the market because it's been the biggest and best story of the year.
Think back to one of the inside jokes we all had in the January to April period. Anytime the market did something crazy, like you would say, what's going on? Why is it up? Or what's the news? You say, oh, it's just positioning. But it's true. The positioning was as bearish as we had ever seen, like historic, going back decades, coming into this year and at the beginning of this year. And there were a lot of good reasons for that. That has to get unwound if the story of a second half recession is not going to materialize. So when you see flows like that, understand that's not just people making fundamental decisions. That's sometimes professionals making career survival decisions and doing things for reasons other than what you would think. Unwinding bearish bets or getting more exposure in a market where the NASDAQ's up 38% year to date, the best start for the NASDAQ ever in the first 6 months. What are you going to do if you're managing money for other people that then you have to answer to? So it's not shocking to see us heading into the end of the second half of the year with money chasing what's already taken place.
But you also, you know, perhaps have a bit of a knee knocker market from those people who see a NASDAQ up 38%.
Yeah.
And are like, I gotta get more invested. My positioning's been off sides, but do I really want to put money into stocks that seem to be pretty overbought? You look at things like RSI to tell you whether sections of the market are overbought or not. How do you view that?
I'm glad you said that. That's why I love this tape, because for every underweight professional investor who looks at what's gone on and says, look, there was no way I'm buying Apple up here. And there's a lot. That's why all of a sudden you catch a bid in the transports, catch a bid in the housing names. Now I think oil is next. Catch a bid there. There are big liquid stocks in these other sectors that professional money managers, hedge funds, asset managers, they can play in those stocks without moving them too much as they try to put positions on. That's the opportunity, and this is really important. I want to get this across, and we've done 5 or 6 blog posts about this already. One of the things the bears will always say during the early stages of a rally is that there's not enough participation. This is like a trope, and they're right, statistically. The thing is, over the last 10 years, if you have used that evidence...
I want to see the volume on Carvana and for it to dictate what it's going to do. Because this is either going to be a really nice breakdown, or it's going to break up and through here and extend on a rally. So I'm going to look and see when they have earnings next and see if that gives us an insight on like timing, because I feel like Carvana's it's not for a while. It's not till August.
Fed that's more aggressive than even we think or even they say? Is it the next CPI doesn't cooperate? Is it earnings, which aren't that far away, are the beginning of what is a disappointing period, as some bears like Mike Wilson would say is just a matter of when, not if, is coming?
Mike Wilson's note this week, I think, made the best bear case, which is that a lot of the quote-unquote revenue growth that we've seen in the market over the
Coming into an environment that has that, like, there's a whole lot of unknown, and I feel like I don't know, man. I want this to have some volume. It's got real low volume. It had a nice breakout today, so I want to wait. If it doesn't get back above this, then this is going to be a short for me tomorrow. If it does it tonight, then I'll get short tonight after hours or something. But we'll see what happens.
clearing out the channels of inventory. If that's what's coming next, which it sounds like Mike Wilson, when he's looking at PMIs, et cetera, that's what he's seeing, that might be a negative shock to revenue and therefore eventually earnings expectations. Maybe not in Q3, but in Q4.
It even makes the argument that people are underestimating the amount of AI spend that the AI leaders are going to have. They're underestimating the amount of money that these companies are going to have to spend, and that's going to hit on margins. That's part of his note this week too. Everybody's focused on the hype and the sizzle, but the amount of money that you have to pump into the system to develop and build out your AI systems are going to cut into your margins.
Great question. Is AI a growth center or is AI a cost center?
It's both.
For the S&P 400 that aren't tech stocks. It's both, but let me let you know a little secret. It almost doesn't matter, because the earnings growth and the weight of earnings within the S&P is predominantly concentrated among companies that are going to find a way to make money selling AI solutions like Microsoft, Apple, Alphabet, NVIDIA. These are the big wheels. So I get the premise, like, oh no, all of a sudden. The other thing I would say is I actually think the market would be okay if companies were getting aggressive and spending on R&D, on growth, if they could back it up with revenue growth. So the crux of his main argument, which is that the economic slowdown is going to be the thing that makes earnings estimates unattainable, that would be the thing that would be worth worrying about. But again, the thing is, outside of looking at year-over-year PMIs and things like that, there's just not a ton of evidence that that's going to necessarily bear out.
You ready to broaden the conversation out?
Why don't we?
All right,
let's bring in Jessica.
Let's bring in Jessica Inskip, Director of Education and Product at Options Place. Nice to see you again. Educate us on your own market view in the here and now.
Sure, and I agree with you, Josh, so very much. I think it is important to pay attention to the operating costs that will come in with implementing AI, and that's something that will come to fruition, and it may not take, even though you're increasing that operating efficiency through automation or whatever it is, you may not see those enhancements translate over into earnings, and it may take a couple of quarters. So this is the next quarter that I think is something to be concerned of. Now, what I am paying attention to is the labor market, especially listening to Powell today. We have been talking about labor market imbalance and recognizing AI and automation as a solution to that imbalance, but just looking for cooling or that gap to really narrow. He mentions quit rates and participation, and I think that is important to take a note of where that's coming from. So quit rate is on par with pre-COVID levels. Participation facing resistance because what we see participation levels at are also on par, or modestly above rather, pre-COVID levels, and that's from prime age and those 16 to 24-year-old working group. So, and there's a shortfall from 55 plus, and I don't expect those to come back. So meaning, if we're looking for that uptick in unemployment or looking for any more aggression or moderation within the labor market, unless there's a larger influx of immigration, I see that as being a wall and a headwind that I want to be cognizant of. And yes.
Yeah, the Fed has seemed to underestimate the durability of the labor market, and that's obviously, I think, a great understatement, just by virtue of where the unemployment rate still remains and the fact that they haven't been able to crack it to any degree, even close to which they thought they might be able to some 500 basis points ago. Now, let me ask you this. Do you feel like right now the market is vulnerable or strengthening?
So there's growth, but I think it's...
Look at that. If this thing gets going, I don't know the float offhand. But if... Let's go to the daily chart. Did UCAR just IPO or something? It must have. It only has the 20-day moving average on it. So 896 is the level.
Some uptick off the lows. Obviously, that should be expected. The government stimulus programs were now a long time ago. But it's not showing up in such a way that you would change your expectations for how the second half goes. It's very, very difficult to manufacture a pronounced...
Look at the sell-off. It looks like a sell-off, is it? No, it's not. Okay. It's a little misleading. Okay.
You could barely see it. You have to squint, and you have to really get specific on what data you're looking at. But the jolts is cooling off. This game where I quit my job and the next day I get a new job for a 15% raise, that game is now over. You're just not seeing it. But you're also not seeing all of these headlines that we're reading about layoffs, whether it's Google or Goldman Sachs. You're just not seeing that in the bigger aggregate numbers, which I think speaks to the dynamism of our economy.
Well, also because the companies that appear to be the most bloated on the backside of the pandemic have already self-corrected.
Yes.
They've already found the years of of efficiency, and they've done the dirty work before the Fed had to weigh on them to do it.
I would argue tech's recession started last year. Certainly venture capital's recession started last year. There was a ripple effect. It started with smaller companies being told to batten down the hatches, and then investors stopped writing checks. And then that translated into a slowing enterprise sales environment for the public software companies. And here's where we are. It's already over a year of that kind of cost cutting.
All right, we're going to leave it there. Josh, thank you so much. Appreciate that conversation.
My pleasure.
Here in person at the New York Stock Exchange. Jessica, we'll see you soon. Thank you as well. Jessica Inskip. Let's get to our Twitter question of the day. We want to know how many more hikes are coming from the Fed this year. What do you think? 1, 2, more? How about none? Head to @CNBC Closing Bell on Twitter to vote. The results later on in the hour. Let's get a check on some top stocks to watch now as we head into the close. Christina Partsinevelos is here as always with that. Christina.
Yeah, I want to talk about Madison Square Garden Entertainment. It's firmly in negative territory as Sphere Entertainment plans to sell almost 5.3 million shares of the stock. MSG Entertainment spun off the Sphere segment just last month and says it will purchase around $25 million worth of that offering directly from Sphere, which really, if you do the math, is only a small portion of the second offering, resulting in what else? Stock dilution. That's why you're seeing shares down almost 11%. Let's talk about Peloton under pressure as Wolf Research downgrades the stock to underperform. Analysts say they lack confidence in the company's pricing power, its recent strategic initiatives, and of course, demand. Everybody seems to have a bike already. Shares down over 7%. Scott, you have a bike?
I do not.
Me not.
She said, Scott. He's like, it. She's like, you got a bike? Oh, you fancy, huh?
Derek Johnson is back. He's raising the red flag again on some big risks he's still seeing. He'll join me at post 9. He makes his case. We debate it next. You're watching Closing Bell on CNBC.
I'm trying to find. I'm just going through the scanners right now. Just going through the scanners and seeing what is setting up, whether, like, first the daily, this is through the 50, 100, attempting the 200. So if I look and I say, hey, you know, it's broken its resistance, it's got a couple bucks left on it. Okay, good, great, grand, wonderful. We're gonna play it, you know, or I may, you know. Tomorrow, again though, tomorrow is the day that I'm going to be looking to take advantage. May just be Friday, because we have inflation data. We have a lot of inflation data out on Friday. You okay? You okay, Bean? There is our retest of 435.89. I want to hold off a minute. Why do I not just go long right here? Why is it? Why do I not just go long? So first, there's the setup's there. Honestly, you know what? The setup is there. This is support. Let's go with one tomorrow. Let's go. We're gonna go. The thing is they know. See, those have already came down to 14 cents. there's just not a setup. There's honestly just not a setup. Because what happens if we just come down here to test VWAP? VWAP will get pulled up right to this 435 line. Let's look at the 15-minute. You gotta use longer time frames, and it gives you the bigger picture. And obviously, like, because with the SPY, it's so liquid. Like, your time in sales and your level 2, it's not really something you want to use for the SPY for intraday trading, because it's not gonna, like, there's different reasons, like, because it's so liquid. There's so much liquidity and positions, money being bought and sold at one given time that it's like you don't know why somebody is doing what. Are they just scalping and just, you know what I mean, shorting the shorting at resistance, and like, are they doing, like, I don't know, 20, 30 positions in a day, just at catching every little 10 cents. There's just a whole lot of reasons. Are they using the SPY to back up a stock, like, to hedge? But it's not moving much today. So that's like different, like with Carvana or like a random just share price. You can use the level 2 and the time in sales, because you're going to see at certain levels, you're going to see like the level 2 just flip green and go like at the support level, because there's a lot of buying. You're not necessarily going to use like a stock that has hedging, like at this area. You would see the tape speed up, and the speed of it's important too, because it's just ripping down the screen. It's a lot of orders, and if it's really slow, like this one over here, like GLD. See how fast this is moving compared to this?
Prior bull markets have been declining employment, where you start a bull market in 2010, the unemployment rate's 10%. You can then add jobs to the economy and grow the economy. Same thing happened in the late 90s, right? You were adding jobs. You have not seen bull markets start with full employment. In fact, we've been below 4% unemployment rate 4 times in the last 75 years. Each of those ended in a recession. Why? Because you ultimately need a cleansing in the economy to then start the next cycle.
But as I said to Josh, maybe the cleansing happened in the most bloated areas of the economy, the tech economy, okay? That's number one. And maybe the labor market is just...
She's holding this 435.84, and that was my 435.28 was my number. There she goes. There she goes. It's a liftoff. She's trying.
Than I think and that others think. But I think if that happens, we are going to have subpar economic growth. And the reason is simple, right? Ultimately, economy is to grow or decline based on jobs. You add jobs, the economy grows. So I think that is possible, that we could stay at this 3.7% rate for a while. But I think in that scenario, growth is going to be very subdued, and it is not going to warrant then a 19 multiple when you can have a money market fund at 5.25%, right? Because rates will stay where they are, right? Long end rates probably go higher in that scenario.
Not if inflation continues to decelerate and come down. I mean, obviously the Fed is eventually going to move rates lower. They're not going to just keep the terminal rate at 5.25 or 5.5 or wherever they go to for forever.
I mean, there's an argument to be made that, and I would argue that if the S&P is at 4,400 and the unemployment rate's at 3.7%, inflation's not going to come down to a reasonable level that will be palatable to the Fed. Now, it might take 6 months, et cetera, to get there. But the point is that when you have full employment, inflation is going to stay sticky, especially with asset prices where they are right now.
Did you think that the market, or that the economy, I should say, would be weaker by this point than it is?
Yes.
You did?
Absolutely.
Did you think that the labor market would be weaker by this point than it is?
Absolutely.
So what are we missing?
Sure. Here's the big thing. We have a $2 trillion budget deficit. That is a $2 trillion annual stimulus package that we have that is more or is equally offsetting the monetary policy that we've had in
place. I've been shocked that Powell hasn't talked about this more. But that's a massive offset. It's looking like the deficit's going to be $2 trillion this year, right? If you pay $1 in taxes, the private economy gets $1.50 back. That is a 50 cents that's going to the private sector, and that's exactly what's happening. The second thing that is the liquidity flows, right? We all know the Fed is in QT, okay? However, the Bank of Japan, right, 6 months ago was growing their balance sheet. And so the liquidity flows have actually increased by $1 trillion since the October lows in the market. So those have been tailwinds for the economy and for multiples that have been there. Now, we think the liquidity flows are going to inflect.
What about the idea of, a market that was pretty top heavy, obviously, is no longer, and it's coming a little more into balance.
There's a share takeover at $19 a share. Share price is at $6 right now. You might see a rally in the stock here. It's actually, I think, halted. Man, if I could have got that news a little earlier. Yeah, I think it's halted. Yeah, it's halted. Guys, look at that. Free money. Doesn't happen all the time, but there was just an announcement of a buyout at $9 of Root Incorporated at $9 and something a share. You'll get companies to do that, especially for whatever they just want to buy out their competition. And there's VWAP. It's got to make a decision. Look at the speed of this time in sales here. Look at this time in sales. Do you see, like, once it got to VWAP and broke that level, do you see how fast it's ripping down the screen? Look, just tried to turn it into resistance. Let's see what happens here. There's a 2,000 sell share order. Another 2,000 with another 1,200. So that's a 31,000. 3,100 sell share. Look, I can't even. It's going so fast right now. It's like the bulls. What's. So the Qs were not able to get back up above this level of 350, 364. I want to say that was like yesterday's low. Yes, it was not able to reclaim yesterday's low. This could be a. You could just start to see some selling into the close. Could see selling into the close. The open is 436.19. So another indecision candle like this is really gonna give the market some indecision. And maybe we start to get small caps. If the market slows up, we'll start getting some small caps. We could. Look at it. Look, I told you guys, see the speed of the time in sales, and that gave you the momentum to the downside. That's why it's important, because when you really see it active like that, like it was like to the point where it was above normal on an active day, if you guys know what I mean. Like the first hour or two of the market, it was way, like it's just going so fast. It's going so fast. I wonder if something's going on. This is what I mean. It was going fast. Look at it, just ripping every level. This is why you guys gotta be patient. Wait for the setups. Fed Bostic. Baseline to hold rates till year end. Where? Why did my thing not say it? Okay, Turkey, hold on. I'll get it.
loses some steam. My next guest says uncertainty around rising interest rates has elevated risk management from
Those 440s for tomorrow are 8 cents. 8 cents, 7 cents. I need to look at the futures and see.
Fed's Bostic says if economy does not slow down, we'll have to reconsider.
All right, you're late. You're late on that one.
Bostic said Fed should do all it can to avoid significant economic downturn. That's rates should stay where they are for the rest of the year. That's in a Yahoo interview. That's Atlanta Fed President Bostic.
So it looks like they want to go to 440. Or they could test this thing at 438 on futures. Okay.
Coming up after the close, earnings from
Whoa.
KB Home.
So that is the level. That.
Coming up at 4:30 p.m. the API weekly crude and gasoline stocks.
I mean, it's hard to do it, guys, but. And look, it's breaking it now, so. Is this our target? 433 to. We gotta fill this. We don't have to, but I want to get down to fill this gap.
Fed's Bostic says don't see a rate cut for most of 2024.
I'm still going with that talk from Bostic.
For those who have not seen it, he seems to be taking a pretty good shot at you guys in terms of the stranglehold he thinks you have on the Treasury futures trading market, calling it one of the great monopolies in America. Now, he obviously wants to shake that up with a rival marketplace, but how would you respond to Mr. Lutnick?
Completely inaccurate. In order to have a monopoly, you can't have competition. And Scott, as you well know, there's many highly correlated products to the U.S. interest rate market around the world that compete with U.S. equities, so it's not a monopoly. What it is, it's a pool of liquidity that creates efficiencies for the end user at the most cost-effective way. What Mr. Lutnick is proposing, and I've known Howard a lot of years, is a Me Too strategy, Scott. In the year 2023, Me Too strategies don't work. You need to have a value-added proposition in order to attract clients away from efficient pools of liquidity. It's not a monopoly.
I want to see if this rejects here. I want to see if it rejects. Look at the volume. But it's all mostly buying.
Your last guess, I think, works for Howard, talking about the Japanese bond market. That can have a competing effect on U.S. markets. You look at what's going on in the UK right now with the way the markets are trading over there. There's a high correlation here, Scott. So people have alternatives, and when they have alternatives, it's not a monopoly.
Maybe we'll have to have you and Howard on this program to have this conversation.
I would love it. You know, he's a tough one, though, Scott. He's a tough one to hang out with, man. He goes hard.
Our producers are already hard at work. Terry, thank you. It's good to see you.
All
Be
right.
well.
All right, buddy.
All right,
Thanks, Scott.
That's Terry Duffy of the CME, of course. Up next, we are tracking the biggest movers as we head into the close. Christina Partsinevelos is standing by with that. Christina.
Higher priced items, higher wages, revamped stores, the latest promises to turn around outdated Dollar Tree locations. The market likes it, but will they make it happen? We discuss next.
I think there's just a lot of indecision. But those remarks definitely rattled it a little bit. But we had already started the day out. Just long oil, healthcare, industrials like steel. And that's going to, the decision was already made. So. See how cybersecurities and whatnot are doing. I'm gonna go through a rotation of all the. Yeah, it was. That's what I mean. It's just indecision, man. It's actually making for a good range. Just don't get caught holding the bag. It's really not that much. It looks like a lot, but it's not much. It's really not much at all. It's just there's a lot of indecision because we have inflation data on Friday, and it's at least the S&Ps are telling you that it's going to wait for that inflation data to come out to dictate what is it that the Fed's going to do. But if you didn't hear though, it was Fed Bostic saying that they want to keep rates up at these levels till year end, in a Yahoo interview. But again, that's what I say. Like it was already decided on what was going to happen today.
About 15 to go before the closing bell. Christina Partsinevelos is standing by once again with the stock she's watching. Christina?
Well, I want to start with Tesla. Barclays raising its Tesla price target by $40 to 260, but downgraded the EV maker to equal weight, saying the recent rally is driven by AI and ignores near-term problems with margins and demand. They like Tesla long-term, but right now they're going to move to the sidelines. And that's why you're seeing shares down almost 5%. Let's talk about Dollar Tree right now. Dollar Tree is planning some major upgrades to its stores, with the CEO even acknowledging the decor is, quote, right out of $19.75. The company also projected earnings of $10 per share in fiscal 2026, which is above expectations. Market likes that. This turnaround plan comes after activist investor Mantle Ridge took a stake in the retailer just about 2 years ago. The stock is off the highs of the day, but it did actually have...
So what is this, the second, third day in a row we've closed down, that we've closed red? Third day in a row.
We asked how many more hikes are coming from the Fed this year. 1, 2, more than 2, or none at all. Head to @CNBC Closing Bell on Twitter. The results after the break.
Watch just getting puts or calls end of day, guys, going into tomorrow, because you're just going to get hit with theta. You're just going to get theta burned all over them contracts. You're going to be like, man, I don't want this. That was a bad decision I made. This ain't cool. The market's rigged. No, you just don't. You just need to know what you're doing. Okay? Just need to know what you're doing. Yeah.
Twitter question. We asked how many more hikes are coming from the Fed this year. The winner is 2. Taking Jay Powell at his word. 41.6 at this very moment. After the break, we're setting you up for KB home earnings. The home builder reporting results in just a few minutes into OT. When we take you inside the market zone. And a programming note, do not miss CNBC's newest documentary, China's Corporate Spy War, focusing on the risks U.S. companies face when they rely on China for their supply chain and their revenues, like Starbucks, Apple, and Tesla. Premieres tonight, 10 p.m. Eastern. We're back right after this.
3.2 billion on the buy side, market on close and balance. You guys have a great night. I'm going to leave this up for a couple minutes, but I'm going to get out of here. You guys, hope you guys had a great day. I might have a video that'll be recorded, possibly. I'm just going to cover some charts, going to cover some data. So thank you guys for joining. Thank you guys for hitting the like button. It's greatly appreciated. Hope you guys had a good day. Alright, don't rush the trades. Let them come to you. Don't live in regret either. Talking about wish I would have sold, wish I would have bought. Listen, it could have very well went the other direction. And you'll be, it's going to happen. I've got to feel, you know what, let me take that back because it's only human. I've done it. Okay, I will still do it and be like, man, I wish I held. But again, you just make it yours. Just make it yours. It's not yours until you take it. So it's another 0.5%. We close to the downside, guys. So tomorrow's going to be so important. Tomorrow and Friday, we're going to get a movement. We're going to get direction, I feel. I mean, price action is all, man. They're selling it off. This is our third day in a row of a sell-off. I want to see where we open tomorrow. I'm going to get myself a game plan together here. But I will be ready and focused to take advantage of stuff tomorrow. After this rotation, this is what you gotta look for, is the rotation, things like that.
We're in the closing bell market zone. CNBC senior markets commentator Mike Santoli here to break down the crucial moments of the trading day. Plus, Christina Partsinevelos on Intel and the sell-off in chip stocks today. Diana Olick on KB Home ahead of its earnings in the OT. I'm looking at NVIDIA. I want to start there. The stock got down to 420, right? It was part of the NVIDIA and Tesla and some of these other stocks that high flyers coming a little bit back down to earth. Bid right back up. It's barely down now, 432.
Yeah, the market in general does not act as if people feel overloaded with equity risk. Now, you would think that maybe people should, because we came into this week, everything was pretty much in place to have at least a standard pullback, and it's still pretty much in place. Very overbought indexes. The leadership of the market in particular running red hot, like NVIDIA and other names like that. Seasonally, last 2 weeks of June, typically are weak. We're up 25% in the S&P in 8 months. All of it fitting together. Sentiment starting to get a little more optimistic, if not overly so. But yeah, it feels as if there is a latent bid. You've seen traction in the breadth numbers today too, where you actually had about 3/4 of all volume to the downside at the beginning. Now the majority's to the upside. All that being said, it feels like a much more symmetrical bull-bear outlook in the short term than it did for a while. We've chewed through a lot of the big perceived risks, and now I feel as if people are trying to find a reason to warm up to the market. Yeah. I don't think that's wrong. I think there's a lot of room to go from where we are to outright greed-driven FOMO recklessness. But you also, you have to sort of allow the market to relax a little bit to the downside perhaps, even if it just happens through rotation and going sideways and churning.
Josh Brown's point was in why he likes the tape where it is, pointing to energy, for example, which has been such a dramatic laggard leading today. It's just one of those sectors that after doing nothing is actually showing some signs of life.
Yeah, June has been a month where you have had people reaching for things that haven't participated. It's been about mean reversion. That could be a bit of a reflex. It could be that sort of end of quarter, let's rebalance and make sure we're not leaning too heavily in any one direction, and you can kind of spread your bets a little bit more.
It's weird, guys. The VIX is also down with the market. That's weird. I didn't expect this. Usually you don't see this. You don't see the market, pulling down for a day or two or three, and look at the VIX. It just dropped. It's just dropped off a cliff. It feels. Wow. That's so weird. Stockholder meeting for NVIDIA tomorrow. Keep that in mind.
With the device business. That means treating Intel like a third-party customer. The goal, though, for Intel is to become the second biggest foundry in the world, of course, after TSMC, Taiwan Semi, and post cost savings of roughly $8 to $10 billion by the end of 2025. Today, Intel said they will sign up their first foundry customer by this year, but we didn't get any names. Investors aren't really loving that, as well as the fact that it'll take Intel time to ramp up utilization rates at this foundry, cut costs, and of course sign up these new customers. It not only drove Intel lower, to your point, Scott, which is over 6% lower, but also AMD, which is down about 5.5%, even though AMD is a fabless chip maker, which means it doesn't have a foundry business. So all of this, though, the news today from Intel is a step in the right direction, it seems, from street reaction thus far, but it's an uphill battle, it seems, for Intel to regain leadership, especially because they want it to happen very quickly. Now.
All right. Yep, Christina, thank you. Christina Partsinevelos on what's happening in the chips. As for what's happening in housing, Diana Olick, KBH, man, what a run. 42% for that stock in just the last 3 months.
Yeah, the builders have been on a tear for sure, Scott. But this was a tough quarter for the housing market because mortgage rates started in early March over 7% on the 30-year fix, then dropped back a little bit, but then shot back up over 7% at the end of May. KB did report in an update just after its last quarterly release that net orders were down 24% year over year in the first 2.5 weeks of the quarter about to be released. And
That's it, gang. Good game, good game, good game. Look at the sell-off. Quickly sell it off, sell it off, sell it off. Just to reverse it. Just to reverse it. Don't get the FOMO. To my baby girl. You want to eat?
Perking up a little bit. The 10-year has remained kind of still in this downtrend. People looking at that 385 area. We haven't broken above that.
Have a great day, guys. I will see you all tonight.
The inflation job much easier, but it shows you the capacity for the bull case of rolling downturns within the economy that doesn't all strike at once and spares, the overall economy from an outright recession. So we'll see if that can take place. It just feels as if there's enough in terms of household balance sheet, demographic demand for housing, and if housing's not really on the down and oil hasn't really done anything in the last year, those are usually the preconditions for a recession. I mean, among all the ones that are in place, those are two that are not in place, at least at the moment.
So you're going to have the bell in a moment, and the Dow right now is down triple digits, about 100 points or so. S&P 500 down near 24. So it looks like we're going to have a finish here that's red across the board. Yields, as we just said, looking pretty green across the board as well. I'll see you tomorrow. I'll send it into overtime now with Morgan and John.
And we will take it a third straight day of losses for the major averages as tech stocks led those losses today. That's the scorecard on Wall Street, but the action is just getting started. Welcome to Closing Bell Overtime. I'm Morgan Brennan with John Fort. Coming up this hour, breaking earnings results from KB Home, giving us a window into housing as Fed Chair Powell tells Congress that supply and demand for homes is getting back in line.
Plus, we will talk to former FTC Commissioner Moselle Thompson about news today. The FTC is going after Amazon over what it calls a deceptive process for Prime signups and cancellation.
Let's get straight to the market action. Joining us now, Sahak Manuel.
especially since at Bespoke you're the chart master, or at least you put our Mike Santoli, you give him a run for his money with some of the charts you put out. What are you seeing right now, especially as we do see an S&P settling down about 0.5% right now, 43.65?
Well, no one gives Mike Santoli a run for his money, so let's just get that behind us. But echoing what Sahak was saying, I think what you've seen is you've seen a very overbought market here, especially in the face of what you saw is any number of reasons why the market should have gone down and it didn't go down. So that's really important. The market was bucking the trend of the conventional wisdom. You can measure levels of short-term overbought in many different ways. One way we look at is just standard deviations above the 50-day moving average. We were the highest above the 50-day moving average measured in those terms since 2004, right after the second George Bush got reelected. So that's a long time ago. And what you tend to see during these periods is short-term returns can be mixed as the market either pulls back a little bit or just pauses. You can have corrections in time or price. But when you've seen these really big upward thrusts in the market, what you have seen is longer term going out 6-12 months, you've seen better than average returns. So, I mean, I think, we're flat now over the last week in the market. So we're sort of digesting these gains, but over the long term, this strong demand for stocks is an encouraging signal.
Okay, well, so Sahak, if we're lucky enough at home or smart enough to have been invested over the period up to now, I guess the question is, what do you do next? So how should we think about international exposure in this market, whether it's from U.S.-based multinationals that might have exposure in certain geographies or even from companies that are based, say, in China or in India?
Yeah, good question, John. I think for international exposure, any of our multinationals that have exposure overseas, those should start to perform a little bit better. We've seen the dollar index abate significantly since last summer. We were, 115-ish to about 103, 104 area today. So our multinationals should act better, should trade better, and those should start to show up in Q2 earnings and so forth going forward. Aside from international stocks, I think really the playbook, if you will, into the second half of the year will be more about small caps and some equal weight S&P as opposed to the leaders that we've seen the first half of the year.
Okay, so Paul, what does that action in the dollar mean for small and mid caps, which tend to have less international exposure if they're domestically based? Is that something that you have in mind, and how you expect those to perform relative to some of the biggers?
Well, I would say a broadening out of the rally you could expect to see. I mean, obviously these mega caps can't go up forever at this pace. But what you've seen is it hasn't necessarily been this narrow rally. The cumulative AD line of the S&P 500 is at new highs. You've had a quarter of the S&P hit 52-week highs since the start of May. And what you want to look is for maybe what would lead to a more broadening out of the rally. Well, you look at the financial sector, which is about 75 companies out of the 500 in the S&P 500. It's had an awful first half of the year relative to other sectors. But the thing is, they've shown some stabilization since the pullback in March or the outright crash in March of these stocks. And when you tend to see that negative sentiment also remains negative. You can't find much to say positive about the bank stocks right now. Even in the congressional testimony that Powell had today, some members of the House were talking about how the banks are in such a bad shape. When there's nothing good to say about a sector and the stock prices have stopped going down, that's usually something you want to notice. You can say the same thing about the home builders last year at this time. They were right near their lows. There was no good news for the sector. And we're talking about KB Homes reporting today. The sector's up 80% since last year in the face of what looked like at the time the most horrendous backdrop for home building stocks that you could imagine. So when everything looks bad and the stock prices stop going down, take notice.
All right. Paul, Sahak, thank you. Great way to start. Now let's bring in CNBC senior markets commentator Mike Santoli, who I think has got a chart. He's taking a look at the tech sector. Mike?
Yes, pretty bankable there, John. I do, and actually a picture of how somewhat out of balance the market has become, skewed toward technology relative to the rest of the market. That ETF there is the S&P 500, excluding the technology sector.
what's interesting to me here is that tech itself essentially went up and threatened its late 2021 levels. Didn't quite get just every penny of it, but almost did, and is now started to pull back very modestly from this. We should also note that the tech sector does not include everything. It includes Microsoft, Apple, NVIDIA, clearly not all like Meta and the others in communication services. So it's really semis, Microsoft and Apple is pretty much gets you to it. But you see that huge gap that has opened up. So in theory, it should probably close a little bit. I don't think you have to unwind everything. Tech is still leadership at this point, valuation-wise. It's getting up toward those November highs, but not November 2021 highs, but not quite there. So it's rebuilding some of those animal spirits. The chase is on. We'll see how this settles out, whether the overall market can absorb any further pullback if we do happen to get that. Now take a look at the next picture here of Amazon in particular relative to the overall market. That news today, the FTC suit, not too much of an impact on Amazon. But what I find interesting is this goes back to the end of 2019, so right before the onset of the COVID pandemic, and you saw the massive outperformance of Amazon, then gave all of it back relative to the market, and now kind of neck and neck. It's been struggling to return. I think it's a good reminder that a lot of the traditional FANG stocks have really just been in rebound mode. They've not been carving out nearly new highs. Meta's in this position. Netflix is in this position too, of really being well below all-time highs. So there's a good mixed bag within the mega caps of the NASDAQ. Not all of them have been really making new highs and getting stretched on the valuation or sentiment side, John.
That's so interesting. A reminder that not everything that we talk about as tech gets categorized as tech. Does that have any implication for the back half of the year and how tech tends to perform versus other categories?
I'm not sure if it's about the back half of the year seasonally, but I do think that our tendency to lump all these things together, it's an evolving definition of what we consider to be the leaders of mega cap growth, let's say. Amazon has sort of fallen by the wayside. It's neither fish nor fowl. The retail side, people have lots of concerns about the cost that it's assumed, the logistic issues. And then on the cloud side, obviously a better business, but also not getting full credit for what it might have as a role in the AI excitement. So I do think that there's a little bit of a good debate to be had on some of these names. It's not all about how high can NVIDIA go tomorrow.
Yeah, you could probably throw Tesla in the mix too in terms of this debate. Mike Santoli, the CNBC chart master. Thank you. We'll see you later in the hour. After the break, a prime target for the FTC? Well, we're going to talk to former FTC Commissioner Moselle Thompson about the...
Have a good night, guys. I'll see you guys on the live tonight or the recording. We got to pay attention. We keep closing below, okay? Follow the trend. So far, this is, 2-3 days that we've closed lower. So you guys got to keep that in mind. Right now, the trend is down. I want to see if we start putting in a range, though, because this area is still holding somewhat pretty tight. It's 434, 435. This is your last area of defense, is the 433 area. It's your RSI is still let's see. Double MACD. So the RSI did get pretty overextended today. Look how much. Look at that small little uptrend, and then it took it up. So we'll just have to see. KB Homes has earnings. Okay.
For your housing revenue of $5.8 to $6.2 billion.
Look at that, breaking out. KB Homes. All right, guys, have a great night. I will see y'all later on. Peace. Thank you so much. Like, share, subscribe. Any questions you guys want, think about them, post them. We'll go over everything, guys.